Ooh, sweet cherry gum. La 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 la. Alrighty. Before I get out, I'm going to do a little. I got time? Yeah. Not very much, but. Okay. What was that other one this morning? Was it MTCH?
Bank of America?
You know, Bank of America is a great company, unquestionably, but as I think we've talked about in the past, they've had a lot of unrealized losses in their mortgage-backed security. Now, the losses themselves are just not a real investor concern at this point, but they do tie up capital and liquidity, which means, in our view, the company just has an incremental headwind on NII progression that others lack. So a little bit more of a company-specific obstacle than others, but unquestionably a great company over time.
Scott, you got a particular reason for liking KeyBank. It has only to do with the bank itself.
Yeah,
what is it about Key,
exactly
and why is that a play here?
Yeah, thanks, Steve. So I actually have a few different reasons. I think they've got a lot of company-specific opportunities. So one, they had gotten kind of sideways with their interest rate risk management over the past couple of years when rates were at zero, and a lot of the that were, again, very company specific are actually rolling off now. They had a lot of swaps and a lot of low yielding treasuries that they bought. So those are rolling off, and they'll have about a $1 billion revenue benefit that should come by the early part of 2025. So that's an enormous company specific factor. They're also really well geared to take advantage of any capital markets recovery. They've got a good cost outlook that puts them in position to generate positive operating leverage, which most other banks will not this year. And we like the valuation. So we think that's a particularly interesting one as we look into this year and next.
Scott, we got to go, but as the econ reporter, I got to ask you one question. Have banks over-reserved, under-reserved, or are you neutral on the amount that they put aside for potential delinquencies in their credit portfolio?
Yeah, great question. That's sort of the $1 trillion one. I think they're fine based on what we can see. However, if we don't generate this soft landing, then it's sort of all bets are off.
All right.
No, soft landing, I've heard it for 2 years.
All right, coming up, Walgreens set to report. We're going to bring you the numbers and the reaction on Wall Street straight ahead. Squawk Box coming right back.
Steve Leisman. Hey, little sister, what is going on? Yes, I used to sing. Walmart's bounced. this. Look at that one. We got out of yesterday, which was a good decision. Okay, well, I'm gonna head out again.
NBC.
Good morning, everybody. Dow component Walgreens set to report results. We will get the numbers and the market reaction. Another day, another downgrade for Apple. This time, Piper Sandler going from overweight to neutral. Can the tech giant hold on to its status as the most valuable stock? And
Yeah, you
tension
pumpers.
in the Red Sea boiling over to the oil markets in yesterday's trading session. We'll break down the move with energy and commodity follower Jeff Curry as the second hour of Squawk Box begins right
Talk
now.
about how you tried to pump it. On bad news. Please. I beg you.
Good morning and welcome back to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Mike Santoli along with Becky Quick and Steve Leisman. Here are the equity futures. They're firming up a little bit after about 3 days of selling. Yep, first 2 days of the year were down. S&P now just below the flat line indicated, and the Dow indicated.
We're about to hit my
34.
first
So
support.
no major moves here. The context is up 9 weeks in a row.
I think we did hit
This week
it.
Up about 16% in the S&P. We backed
Yep.
off less than 2% from the
We might get a
high
bounce
in
today.
December. Take a look at treasuries. Yields there also kind
little
of
one.
just drifting in the same range we traded in yesterday. The 10-year did touch 4% briefly yesterday. We got the Fed minutes that came out 2 o'clock yesterday afternoon. No real adverse hawkish surprises, maybe not a lot on either side of it, but the 10-year now at 396 and change.
Really narrow, isn't it, Mike? I mean,
Yeah.
we were trading like in this 4 3/4 to, people thought 5.5% was the top on that. It never really got there. But now it's like 390, 388 to 402.
Briefly got below 380, and
Right,
basically
right.
the 380 is the low, and yeah, and 4 has been the bound for a while now.
All right, well, Walgreens out with quarterly results, but the Coombs joins us now.
Bertha.
The numbers, Miss Coombs.
Hey, Steve. Walgreens' first quarter results better than expected, with adjusted earnings of 66 cents a share, 5 cents above consensus, on 36.71 billion in revenues. That's about 5% above estimates. The company also announcing an almost 50% cut to its dividend. Now, in terms of the quarter, U.S. retail pharmacy sales of nearly 29 billion, that topped expectations. Despite the fact
These
that it
idiots
had
never
lower
put the ticker
vaccine
on here.
volumes. Higher brand drug prices drove pharmacy strength, offsetting weakness in the front of store, which saw same-store sales down about 5%. International sales of more than 5.8 billion also beat on strength at Boots UK, while the U.S. healthcare unit revenues, which includes Village MD, came up light at 1.9 billion. As for that dividend,
what I hate
cut,
about this
Walgreens CEO in the
bullshit.
release, he just started back on October 23rd, so he hasn't really even been there a full quarter. He says that shareholders want them to be really very robust when it comes to their capital.
Now you finally get it up there, you idiots.
Outlays, and the company right now is really focusing on trying to get growth, but also really be very judicious about cash. They ended the year with a 7% yield, making them the highest yielding stock in the Dow. Now it will be closer to about 4%, which is still in the top 20% of the Dow. And
I'm gonna put an alert off that support of 24.57.
In over 45 years. Back to you.
Yeah, remarkable, Bertha. A 7.5% indicated dividend yield at yesterday's close, which is in a way the market's way of expressing doubt that the dividend is going to be maintained when you see the yield.
Which is the only reason you
get
probably
that
see the
high.
stock up on announcement
Yeah.
of cutting the dividend in half.
And and beating lowered
Exactly. So
expectations.
this
doesn't
wasn't
hurt.
unexpected.
Yeah, and CVS, for comparison's sake, has got a sub 4% yield, so it brings it back in line, Bertha. Thanks so much. Our next guest has been described as one of Wall Street's biggest bulls. He expects the S&P 500 to end the year at a level of 5,200. That's more than 10% rise from yesterday's close. And
Okay,
he's
well,
one
see
of
y'all
the
later.
veterans that also believes the S&P will surge to new highs this year. That would, by definition, we're just a couple percent away, right? Here with us now is John Stoltz, Chief Investment Strategist at Oppenheimer Asset Management. John, good to see you.
Good to be here. Thanks.
So it's interesting, on one level, you kind of think we can have a pretty good year. On the other hand, when the biggest bull on Wall Street saying we got maybe 10% upside, it suggests overall sentiment maybe is somewhat subdued. How did we come into the year in terms of maybe everybody expecting a soft landing, and which direction the surprise is going to go?
Well, like I think actually, in December when we put the target in, it indicated 13% upside.
Yeah.
But that would still be about half of
I was
what
gonna
the
say, what
market did
happened to
last
your
year.
13?
We can't help but
I've
think
heard
a good
17.
idea to be conservative in here, moving into
We've got a
this
double
year,
bottom on
in
the
sense that
SPY.
we do expect things are getting
So that
better.
might be a
We're moving
reversal idea
towards a
for today.
normalization, stabilization in interest rates. And with that, the thought is still we've got plenty of volatility out there in terms of uncertainty in geopolitical risk that could actually affect food and energy supply chains in a part of the world that's important. And so a lot of thought there.
We know that a slowdown should happen of some character, right? We had like a 5% GDP.
You did not know that.
Quarter. It's a question of how much, right? So yesterday
lied.
we got the job openings and quit rate data, a little bit soft. See labor market slackening a little bit. Manufacturing still not really bouncing back. And I guess the question is, are we going to be able to stay on that path of slower but not stalling?
We can't help but think that slower but not stalling. We think the Fed has been amazingly sensitive to the effects of it practicing its mandate. On the
WBA
economy.
has good results.
It's part of what we call the Ben Bernanke legacy, and we think Powell is practicing that. When you consider, what is it, something like 11 hikes and 4 pauses or something like that in so far, and no recession. The resilience that's seen in business and the consumer as well as in labor. All of this looks remarkably good, and we think the Fed is, we've said now for over a year, we might actually skirt a recession, and now we're even beginning to think perhaps we do get a soft landing, which would be remarkable.
John, most reports I see believe earnings have to come down, estimate.
Now, YouTube, I'm playing CNBC. You know I always argue and disagree with about everything they say because they're one of the biggest pump stations out there. But you can use that in your favor. They're always late to the pump, for one. They always react to news, and I do too. But a lot of these guys, they've always had it wrong. Their predictions are always wrong. They're pumpers, they're greedy. They just look for ways to raise up their portfolios. So they're always a bull case. And you always got to play the devil's advocate with anybody and do your own research, do your own homework, and go with your gut, not theirs. The psychological part of trading is you got to be a devil's advocate about on everything, especially when you're at all-time highs and they're pumping the market the way they are. They're only pumping the market, and they got a little reality check yesterday from Pow. They're talking 3 to 6 to how many interest rate cuts. They don't know. The only thing I know is that we're in an election year, and they want to do their best to keep this market up, to keep Obama in office. I mean Biden. You know what I really mean. Obama's running the show. There's no way Biden can even think to take a shit. And we got a lot of infrastructure, or not infrastructure, but a lot of this stimulus bill that they passed is going to be hitting in 2024, which is a catalyst also to keep the market at its current pace. So I'll catch y'all later. Tesla. BYD took the news the other day. BYDF. Tesla's got real good catalysts. They're shipping a lot of cars to Europe. I think the demand is bigger than what they're saying. So I did a video on Tesla a little while back if you want to go back and watch it. But Tesla, I'm a perm bull on this thing. We just got to look for like triple bottoms. Like right now we have a 1, 2, 3. And we could bounce up a little bit. Watch that tape. You start seeing $100, $200, $300 buys coming in here. I mean share contracts. I still got 234. We got a 5-day rule. Today's number 5. So if we pull back to the 234.11, I think that's a good opportunity to take this trade. That is if we break this solid support right here. So you got to, this is on the 1 hour time frame. So draw your trend line from that body right there to that body right there. And that's what needs to hold. Just a little bit under 237. If not, we'll drop down and hit that 234 area. And that's where I'd want to take this trade maybe. That's how I look at that, if that's any help. I've been trading this thing for a long time, so. The bears are in control. We got one more day. I played the 5-day rule on this sell-off. And if we hit that 1, 2, 3, that's going to be your support. Same thing with a SPY. SPY dips on down here today, 466.55. But we've also got the 3-day rule on the SPY, which means we could have a nice little reversal, small little reversal. I gotta go. Just watch that tape on that Tesla and you'll know if it's green. You'll see a lot of green and buyers are coming in. Like right here, we've got a triple bottom on the SPY. And if you really want to be technical about it, you want to look at that head and shoulders, and that's going to be your support resistance for today. And then the 200 on the 1 minute. And that's a big gap up, so I think they're going to be buying into the market today. They're bullish as hell, these guys, and they're going to take advantage of these dips. 3-day rule is very important when trading the SPY. back volume, so I thought it was on.
I mean, it's really an agency shutdown, moving to non-essential workers there. It was crafted to avoid a total government shutdown. And the dynamics are that the cuts in the debt ceiling bill that President Biden and House Republicans negotiate are real. And in this first year, they start to really take out the spending from the COVID-era pandemic that no longer needs to be in the budget. But these are significant, I think, reductions in spending. And so House Republicans and Senate Republicans want to be at or below the caps that were agreed upon. Democrats, I think, want to avoid some $73 billion in overall spending reductions in the non-defense area of that. I think that's what's made it difficult for both parties to reach an agreement on the top line numbers. You need those. Basically, what are the overall numbers that appropriators can work to and craft a bill? The clock's ticking, obviously, as you know. Can they reach agreement on those top line numbers? Can you craft a bill that both the Senate and the House can agree to? The clock's moving pretty quickly, so it won't be easy.
Congresswoman Moore, if we can get beyond the immediate issue of January 19th, $33 trillion of debt, the amount of interest we pay becoming one of the largest, if not the largest component of total government spending. Do you not find this unsustainable? Do you not think the Democrats need to do more in order to rein in spending and the amount that the American public is paying for interest on the debt?
Of course, debt is a concern, and Republicans only seem to be concerned about it when they're when they're in power. When they are in power, we had the Tax Cut and Jobs Act. I know Kevin is very fond of that piece of legislation, but it added a tremendous amount of debt. We've had, the Bush tax cuts while we were at war. I know that I don't have enough time to go through the whole history of it, but Google it. And you will see that the closest that we have come to ever having a balanced budget is when Democrats are in charge. Republicans, this is so hypocritical.
Congresswoman, I get that, but
and I do think these cuts are unsustainable. It's not just that it'll be difficult; it'll be unsustainable in terms of standing up, the world's power on the planet. You got people like Kate Granger, God bless her. She's retiring. She's the lead appropriator. I think she's leaving because, the next Congress, if these cuts go through, we won't be able to stand up, eliminate, stand.
Congressman, I get what you're saying. My point would be that you're in power in the presidency. You're in charge of the Senate. Whatever the politics are the politics such as they are, and that the spending level ought to meet or somehow be in concert with the revenue levels. And Congressman Brady, I guess I'll give you the last word on this.
Yeah.
Is there a way?
I hope he doesn't get the last word on revenue.
Well,
Putting IRS agents to.
That's where I was going to go, Congresswoman. Fair enough.
Give me a break.
You guys have shut the door, Congressman Brady, on the revenue side, but most economists I speak with say the only way to solve this, to get off of this runaway train we're on, is through the spending and the revenue side.
Yeah, so look, we are at record revenues, levels of revenues. We have since the tax reform was established, created huge economic growth, record levels of revenue, which we're at today. Look, we really do not have a revenue problem in Washington. It is on the spending side, especially the $6 trillion that we've added as a nation over the last 3 years. And let's fact check a little. My first 4 years in Congress, Republicans led Congress, balanced the budget 4 times, and the tax reform bill generated major revenues for us. But I think here's the key. At the end of the day, we need a bipartisan framework, longer term, for spending to equalize, as you said, sort of our economic growth and the size of government. House Budget Committee has proposed a bipartisan fiscal commission that would really require both leaders from both parties. I think that's a very smart approach.
Added a tremendous amount of debt.
Let the record show for those on the radio that Congresswoman Moore was shaking her head the entire time Kevin Brady was talking.
I imagine
so. I think we should have these two guys back because I think they could make a deal. They don't. I mean, they could make a deal. These two guys. All right, thanks so much.
We will
I'm
do
John
our
Morris.
best.
And Kevin Brady, thanks for coming.
Thank you.
All right, coming up, a look at some pre-market movers, plus Jeff Curry and why he's bullish on oil, copper, and gold in 2024. And we go to break. Check out shares of Mobileye plunging. The company slashing guidance. It now expects first quarter revenue to drop about 50% over the prior year. Mobileye sees first quarter adjusted operating income in a range of down 65 million to down 80 million. The street was looking for around 140 million. Squawk Box will be right back.
Time now for today's Aflac trivia question. Which 2023 NCAA bowl game now holds the record for the lowest scoring game in the playoff era? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. Which 2023 NCAA bowl game now holds the record for lowest scoring game in the playoff era? The answer, the Cotton Bowl. Missouri and Ohio State combined for a total of just 17 points.
Welcome back to Squawk Box. I'm Dominic Chu with your morning movers here. We'll start off this edition with Apple, which is again a focal point for investors and traders. The Dow component and biggest weighting in the S&P and NASDAQ is lower this morning by just about 0.75% over 200,000 shares of volume. Today, the iPhone maker is getting another downgrade, this time by Piper Sandler, which cut it to neutral from overweight and cut the target price to $205 from $220, citing what it sees as broader handset and macro weakness in the first half of the year, coupled with some valuation concerns. This, remember, follows a downgrade by Barclays earlier this week, citing, amongst other things, demand concerns. Apple shares down. On the food and beverage front, shares of Pizza Hut, parent company Yum Brands, and Papa John's are both getting some attention after analysts at Stifel are downgrading both Yum to hold from buy and Papa John's to sell from hold. For Yum Brands, it's a lack of potential catalysts in the coming year with an expectation of moderating U.S. sales growth at existing store locations. For Papa John's, its concerns include some that That's for that same expectation of moderating sales growth at U.S. restaurant locations, along with headwinds to international expansion. And we'll cap things off with a check on American Express, which is thinly traded so far, but still showing signs up about 1/3%. The diversified financial services company and Dow component as well is getting upgraded to overweight from neutral over at JP Morgan. The target price goes up to 205. It was 167. They think that American Express's more affluent customer base could act as a potential buffer against what they see as deteriorating household balance sheets for lower to middle income consumers. So those Amex shares, Becky, up 1/3%. A couple of Dow components already in the news. I'll send things back over to you.
I think that's the big question, right, Dom? Just this idea of whether consumer balance sheets are going to deteriorate or not this year.
And whether or not the inflation story really starts to change in a way where consumers can actually see some of the benefits to moderating inflation. Of course, all of those will be focal points for the Fed, the interest rate discussion and everything else. But Amex right now seeing some of those kinds of perhaps signs of life because of that higher end tilt. We'll see if that comes to fruition.
Dom, thanks. We'll see you a little later. When we come back, we will talk commodities and where oil could be headed in 2024. And as Dom just mentioned, Apple getting another downgrade this morning. We'll talk, will the tech giant lose its status as the most valuable stock? John Fort will be here to weigh in for the first installment of the year of On the Other Hand. Squawk Box will be right back.
Humanly possible.
We have some breaking news from Eli Lilly right now. Bertha Coombs joins us with the details. Bertha.
Mike, Eli Lilly is taking a bold step to get its obesity and diabetes medications directly to consumers. The drug maker is launching Lilly Direct, where patients can get the company's obesity, diabetes, migraine meds with a doctor's prescription directly from Lilly. If they don't have a doctor, they can find one on the site and get their prescription sent to their home through a third party. Lilly is using online pharmacies like TruePill and others for this direct-to-consumer push. In an exclusive interview with NBC News' Maggie Vespa, CEO David Ricks says he thinks consumers are ready for this move.
At a high level, it seems like something that should have happened before. We're used to buying consumer goods directly from manufacturers all the time on online websites. It hasn't really been an option that's been provided before, but given how complicated healthcare is, particularly for common medications, we thought it was time to create a new way for patients to get access directly from Lilly for medicines they want.
Now, through Lilly Direct, patients can get the company's new weight loss drug, Zepbound, which lists for about $1,060 for half that price at $550 without insurance and a copay of $25 with insurance. Now, that transparent pricing is really a shot across the bow at the big three pharmacy benefit managers, Cigna's Express Scripts, CVS's Caremark, and United Health's Optum. Drug makers have long complained that they have to give PBMs steep discounts, but then patients still pay high out-of-pocket costs based on a list price, and that the PBMs, they say, pocket the difference. Now, David Ricks has said that he wants employers to know that they are working hard to make these weight loss drugs more affordable. By doing this, he's certainly setting a precedent saying, really, the real price of this is $550, not the list price that we have to use to negotiate with the PBMs. Back over to you.
Bertha, fascinating move here. I guess one of the questions is, aside from the price transparency, is this in effect creating a little bit of a premium lane or a fast track? In other words, are they going to prioritize supplies through the direct channel, or how are we going to sort that out?
Yeah, that's one of the interesting things. We know that Novo Nordisk has trouble with the supply, keeping up with demand in terms of Ozempic and Wegovy. However, the folks at Lilly say that they're okay in terms of supply, especially with Zepbound. This is new, so the demand is just ramping. They certainly want to put this drug on the map. But this doesn't mean that they're going to get rid of their relationships with PBMs altogether. I mean, one real sort of example of how these guys are frenemies is what happened yesterday. CVS is taking off AbbVie's Humira. This is a drug to treat rheumatoid arthritis, plaque psoriasis. They're taking that off of their formulary starting in the second quarter and only going to offer the generics or the biosimilar versions of those. What AbbVie is doing is it's going to work with CVS's company that is producing biologics, biosimilars, and they're going to give them a co-branded biosimilar version of that so that they can still get that sale. So at a much more discounted price from the list price, but they still want to be in there.
Bertha, this is not a coincidence that this is happening at a time where the federal government is trying to lower drug costs and is going to be directly negotiating with the drug companies for Medicare. That's a big part of the reason everybody's been trying to figure out internally, because the drug companies have been saying it's the pharmacy benefits manager's fault, it's trying to point the blame elsewhere. Do you think that this is something that is really going to stick? I understand why they would do it with a big popular drug that consumers want, like these weight loss drugs, because that gets the attention. The idea that they went to the Today Show, it means they're looking for the broadest possible consumer audience to get some of these things. But is this more than a marketing ploy? Is this an attempt to really break the system and say, forget it, we're going to go direct and we're going to try and do that with a lot more drugs?
I'm not sure that they really have the ability to necessarily do that altogether, because it's not just one popular drug. In terms of their whole list of what they have, it's kind of difficult. There's a whole infrastructure involved, but certainly it's going to be a very interesting experiment, especially with a big popular drug like this. And don't forget, again, Novo Nordisk is sort of number one, so they want to make this big splash here to make sure that they are in the game and that they can gain more market share against Wegovy with the diet drug, which from the studies that we've seen is very, very effective. Now, we've also got pushback on these diet drugs because even at $550 a month, that's a lot. In terms of employers covering it. So especially if it's something that someone has to be on these drugs for a lifetime, there's still a lot of employers that are trying to figure out how they can afford this. We've even seen a report this morning, Modern Healthcare, that more employers or more insurers are starting to look at bariatric surgery and make that more accessible because that's just a one-time $25,000 or $30,000 expense rather than a lifetime of these drugs, and these drugs that are new, so they're still on patent.
You know, Bertha, things moving so fast. More news from Lilly in this direct area that the company's commenced legal action against some importers and distributors, they say fraudulently claiming to sell Mounjaro, Zepbound, or other medicines like this. And essentially in an open letter, Lilly is saying that it does not promote or encourage use of Mounjaro and the other drugs outside of a medicine's FDA-approved indication. In other words, going after, I guess, some providers out there that are trying to circumvent the normal channels and
they're
perhaps
going after people who are using this for
cosmetic purposes,
weight loss purposes. But the idea of going directly to the consumer with this drug would raise some brows, I would think. You know, if you don't have a doctor, don't worry, we'll provide one for you. It almost seems like they are promoting.
No. This has to be, But it's still, you have to have a doctor's prescription, and
but a
part
doctor
of the reason
will provide for
they're
you.
doing that is, right, but they also want you to connect you, they'll connect you with a doctor in your own area who can prescribe it, and they are recommending that you work with a doctor, because for a lot of people, you know, the initial side effects are really tough, and you really need to, you know, follow with a doctor on these, because at some point, maybe the dosage you have initially is too low or too high, and then you can adjust it later on. So
they're
this
double
isn't
down and saying that this shouldn't be for people who are trying to lose 10 pounds or something. This is for somebody who has a real medical weight problem with this, because that's been the big question. The reason there's so much interest in this in Wall Street is because they think it's going to be 5% of the population on this, not 2%.
Yeah, but you also have to look at the fact that you have so many Americans who are obese. You know, 34% of Americans are obese. So that is a huge addressable market if people want to go this route. Again, there are other things that they can do. Obviously, there's bariatric surgery, which is also, you know, really expensive, but for some people that works longer term. And there are also a lot of companies that are trying to really work more on the lifestyle change to make it something where it's not just about a pill and not just about thinking about food, but really changing the way you approach your approach to food.
I want to go back to what you talked about earlier, this being a broadside against the pharmaceuticals. Does this overall raise questions about the value added by the pharmacy? If I can go and get the same service or product or whatever directly from the company, and that's a change for me as a consumer that is without a difference, then what does that say about the overall utility of the whole pharmaceutical business here?
Well, when you talk to the pharmacists, they will tell you that, you know, there are oftentimes people have questions about their medications. And you also have to consider that a lot of people are on multiple medications. So if you're taking a statin or you're taking, you know, a heart medication or something else, there can be contraindications. You know, they can sometimes work against one another. And if you're working with a pharmacist, they can keep track of that and say to you, and maybe go back to the doctor and say, hey, they're on this medication, you know, we might want to make a different choice on this. So that's one of the services that the pharmacists say they can offer. And the pharmacists,
this is a challenge that's limited to these drugs. You don't see it as a broader thing where this is something like Tesla coming along and undermining the notion of the auto dealership, for example.
You know, at the moment, I think it's difficult to do that because you have to set up the whole infrastructure. You know, you've seen Mark Cuban with cost-plus drugs.
Right.
They've done it on a number of drugs, but they can't do everything. And then at the end of the day, the plan itself, the insured, the payer, the large employer, what they choose to have on the plan, and these pharmacy benefit managers are in the middle of that, that's what determines what you pay and what you have access to. But again, the more transparency there is on these high-priced drugs, the more pressure it puts on everybody in the process. And I think they're all hoping that it also takes pressure off in terms of regulatory pressure. You know, last year we had more than 24 bills to go after PBMs and transparency because Congress didn't get anything passed. None of those made it through, but it's certainly something that's on the radar in Washington.
Bertha, we will have a lot more reaction to this big news. Squawk Box will be right back. Thanks.
Member.
Welcome back, everybody, for a check right now on the energy markets. We want to bring in Jeff Curry. He is a Goldman Sachs partner alum who is now advisory board chair of the University of Chicago's Energy Policy Institute. And Jeff, good morning. Thank you for joining us, and congratulations on the new gig.
Well, it's a board seat. I'm also on BOR and ABEX as board seats, and the new gig is likely to come sometime in the near future, but right now it's board seats.
Okay, well, Jeff, let's talk about your outlook for commodities markets. You're pretty bullish on all of these commodities this year. You were pretty bullish last year, and it didn't quite play out that way, at least when it came to oil. So what happened last year, and why do you still believe in the super cycle?
Well, let's go and let's look at this quote-unquote immaculate disinflation. I want to point out a couple of facts. One, it's happened globally at the exact same time. So it's globally synchronous disinflation. Second point is commodity demand, oil demand, coal demand, copper demand at record level, U.S. economy booming. So what does that tell you? It has to be supply driven, not demand driven. Therefore, it can't be monetary policy, it cannot be fiscal policy. What it is regulatory easing. You know, politicians turned a blind eye on the sanctions in places like China. That led to 1 million barrels per day plus of additional oil from Iran, Venezuela, Russia. Then the secondary sanctions, debottleneck supply chains, more fertilizers, more wheat, so more energy, more food. And this all put downward pressure on oil and commodity prices. So then the second point is we saw the world last year turn a blind eye to environmental policy. They did it in about face. Whether, record oil consumption, record coal consumption, deforestation, cutting down mangroves for palm oil, deforestation for soy, so you got more food out of it. So when I think about what happened here, we overestimated the willingness of politics and politicians in the West to pursue their political goals, being deglobalization, decarbonization, as well as redistribution policies.
Hey,
and
Jeff,
because of that, we ended up with more supply.
Well, let me just say on that front, though, politicians did what they needed to do, I think, for their ultimate goal, which is to stay elected and get reelected. When prices spiked and consumers said, we're not paying for this, they did turn a blind eye because they figured the most important thing is that you don't have consumers mad that they're paying so much at the pump, mad that they're paying so much at the grocery store. So they said, okay, whatever is going to get more food and energy to the table or into your pump more cheaply, they're going to go ahead with it. What makes you think they're going to change their minds this year?
By the way, the view I take, as soon as you have inflation coming back down, everybody's happy again, they're going to turn green again. And then look at the implications of allowing Iran to pump an extra, 8,000 barrels per day. They have the Houthis taking, shots at U.S. warships in the Red Sea. So there's a cost to this. So as soon as the inflation settles, more likely than not, you're probably going to see a flip once again. We may not go all the way back, but we're likely to see everybody become more green and more focused on some of these sanction issues. But right now, it debottlenecked the system, created excess supply, and put downward pressure on commodities. So that's why I would argue, I'm not going to point the finger or anything like that, but that's really at the core why we were so wrong last year. You just got a lot more supply, political oil, carbon-based commodities. You got a lot more of those last year than what we thought you would get. And I don't think we were alone in those assumptions over a year ago. So I think the big question going forward is okay, what does the outlook look like going forward? And I'd say there's 3 points I want to emphasize there.
Can I just ask before we look for the outlook going forward? I mean, wouldn't that always be the case that there's always going to be, if what played out last year as politicians saying there's a limit to what we can expect consumers to pay? Wouldn't that always put a bit of a ceiling on commodities prices? So the idea of a real super spike kind of gets out of the way because politicians everywhere are going to do everything they can to keep that from truly happening.
Well, let's go back to like 07, 08. You had the super spike occur there, but it didn't filter into broader inflation. And what got policymakers so focused on commodities this time around is it filtered into the broader inflation mix.
Jeff, I think you're beating yourself up a little bit too much here, because if 73 is the bottom of the cycle, that's not too bad for being bullish on oil prices, because I remember 48 and I remember 10. I was a reporter at the Journal when it was $10 a barrel. If 73 is the bottom...
I remember 0 from 2020.
Yeah.
Well, forget 0.
Yeah, there was. I remember it was negative back in April of 21.
I mean, I remember we're sort of on the super cycle train, but the idea that 73 being the bottom is not too shabby if you're bullish this commodity.
And but by the way, it is the most investable space out there in the economy right now. The return on capital employed exceeds 20% in many parts of the world. Go back to your point, if this is the low point, and we're underinvested going forward. To answer your question, is this a common occurrence? I think the problem is like the boiling frog. It happened too quick, too fast, went up too high, hit the consumer, and the backlash from governments around the world was significant. I mean, I live here in the UK, and they did an about face on their green policy. I think we'll see the green policy resurface and become an important driver. By the way, we'll talk about China in a second. The green policy is full steam ahead there, but it just did it a little bit at the margin. It wasn't substantial, but it did take some of the sting out of the markets. And I think, as Steve points out, 73 is not a bad price.
I wonder if the Biden administration and other, I don't know what to call the United States, but essentially commodity users have learned a lesson with their use of the SPR this time around to actually use it to moderate price changes. And I'm not sure it's the worst thing in the world. I know people are sort of all into free markets, but if you got one side controlling supply, why wouldn't the demand side also use a weapon if they have it?
Yeah, and I think, if you could say that during 2022, the West was the first one to use oil as a weapon for precisely that point on both sides. But I think at this point right now, what you really have is many of these countries, whether if it's the ones in the Middle East, pursuing their own domestic interests in terms of what price is most feasible for their economies. But I don't think it's a weapon or anything like that. But I do think that the reaction of the Western economies to the inflation was they pulled every lever they could possibly get. And I think here's an important point here is we know it had to be a supply side event that created that global synchronous deflation. It wasn't monetary policy. It wasn't fiscal policy, it was that regulatory easing that occurred, which means it's temporary. So that eventually either demands, it wasn't created by investment or a slowdown in demand. It was created by a one-off increase in supply that the system could either absorb, or that one-off increase in supply goes away.
Jeff, I'm really sorry we've talked so long. We've only got about 30 seconds, but give us your best guesses for what happens 2024.
Start with China. Why does China have to stimulate? You cannot deleverage and deflate at the same time. It's incongruous. They have to reflate. They have to stimulate if they want to deleverage. So that's point number one. Last point I want to leave you with: lower inflation, the Fed cuts. Look at commodities every time the Fed cuts in late cycle. I want you to go back September 07. They cut, oil went straight up, $10 a barrel. I don't care how bearish you get on fundamentals this year. If you see the Fed cut, you don't want to be short commodities. Let's leave it at that.
All right, Jeff, thank you. It's great to see you, and we will talk to you again soon. Thanks. When we come back, we're going to get reaction to this morning's big breaking news. Eli Lilly launching Lilly Direct, where patients can get the company's obesity, diabetes, and migraine medications with a doctor's prescription directly. We will hear from an analyst right after this break. Squawk Box will be right back.
New this hour, Eli Lilly launching Lilly Direct, where patients can get the company's obesity, diabetes, and migraine meds sent to their home with a doctor's prescription. The new program includes the company's new weight loss drug, Zepbound, which lists for more than $1,000 for half price, with $550 without insurance and a copay of $25 with insurance. Joining us now, Michael Yee, Senior Biotech Analyst at Jefferies. Michael, it's great to have you here. I know you already kind of liked Lilly based on a lot of the fundamentals and the efforts in obesity. What do you think of today's news as a way of addressing the market?
Yeah, well, good to be here. Good morning. I mean, I think on one side, it's important to understand that this is the beginning and the early cycle for Lilly and others to continue to grow the obesity market. And importantly, getting access to the drugs is critical. Certainly, I know Lilly is putting in huge emphasis on that. This program, of course, is interesting. I wouldn't say it's game-changing, of course, but it's incremental in getting access to people online, if you read some of the details, without having to necessarily go in to specifically see a doctor in the office.
And does it also reflect the fact that insurance companies are slow to adopt these things and approve them in as broad a way as Lilly would like?
Well, I think it's a process. To be clear, it doesn't happen overnight. I think today's program and others that are going to follow are related to getting access and getting awareness and getting access to doctors. Just to be clear, payer access is opening up slowly and surely this year. Remember, Lilly's drug for obesity, Zepbound, just got approved recently. And so that access is going to open up and it's going to take time. I'd also point out to viewers, and they may not know this, the supply and access to all of this certainly is also opening up, and that's a critical part that is also not so well understood.
That has been an issue for sure. You know, we also mentioned that Lilly on a separate front is going after the cosmetic use or off-label use, or in their mind, fraudulent use through some providers of these medications just for cosmetic purposes. Does that do anything in terms of your estimate of how large this market can get if it truly just goes to those that have critical health problems related to obesity?
Well, to be clear, the vast majority of the use, and certainly if you looked at the prescriptional use through a doctor, has to meet certain criteria with weight, BMI, and other criteria. Obviously, out-of-pocket pay through a physician if it was to get administered for, shall you say, cosmetic use or not necessarily meeting the specific high BMI weight is a proportion of that as well. Long term, again, I think the obesity market is so big, just the penetration of the critically obese population is also very important for it. Pricing as well, I think, critical. So all of that plays into a multi-year factorium. So for investors, this is still the relative early cycle. The drug just got approved. And we'd also say it's not great for Lilly, but also Amgen, a stock we've been telling people to buy. It's been great. Is also the second player coming around the corner.
Yeah, I was going to get to that. So last year, the market treated Lilly and Novo as just basically the only two names you wanted to have ownership of because they were playing this strong theme. So you think it's going to splinter out from there? You know, it can move the needle on Amgen already?
Yeah. So look, I think there's two themes. One is to play the leaders, play the folks who are obviously growing. Lilly being the dominant player, and that's obviously been a great stock. At Jefferies, we're still recommending that stock. We believe there's significant upside as well from Amgen. We just raised our price target yesterday. They have a monthly or possibly quarterly, and there's big data coming from Amgen later in 2024. Been super bullish on that. That certainly could move it because there's not much in the consensus numbers. Obviously for Lilly, huge numbers out there. For Amgen, not a lot. We still see more data. So for investors, we need the data, of course, a little bit riskier, but there's huge upside there on Amgen if the data looks good.
Michael, there's so many interesting aspects here, and I know that the pharmacy benefit managers aren't your wheelhouse, but if this is really Lilly kind of declaring war on the pharmacy benefit managers, is that something that goes well for the pharmaceutical companies? Is it something that potentially backfires if they're frenemies? How would you play that out? Because this is really a shot across the bow.
You know, I think it depends on how you look at it. I think that the key here is Lilly's trying to get access. I agree that the payer plans are slow to get going. You can imagine, of course, Becky, that not going to turn it on overnight, right? There's a huge cost to that. And if you go look back at the Hep C days or some of these big markets that opened up very quickly, a lot of the budget constraints and planning for the PBMs gets all out of whack, and that's a problem for their earnings. So I think they want to manage that. Here, Lilly obviously wants to get access through out of pocket. So these are people who also want to play out of pocket. I think it's important, a difference here. And I wouldn't say it's a shot across the bow. I think it's a long-term market, and that's why the PBMs, I think, are taking slow.
Michael, great to get your thoughts on this morning. Thanks so much.
Good. Thank you, guys.
All right, our next guest says that the risk reward in equities today isn't as good as it was a year ago. He says investors should expect lower returns and higher volatility. Oh, goody. Here we go with the new year. We want to bring in Burns McKinney for this. He's senior portfolio manager at NFJ Investment Group. Why don't you talk a little bit about this, Burns? Why do you think that this is a riskier year?
Well, basically, one way we're looking at it is that investors had a great 2024 during the fourth quarter of 2023. And really the one primary mover of markets for the last year has been interest rates. And so when the Fed pivoted, the Jay Powell and company said, maybe we might even cut rates 3 times next year. And what did the market hear? Well, the market heard 6 times. The analogy I sometimes try to picture is, if you ever seen someone walking their dog, it's a big dog and they're getting just pulled along on the leash. Well, that big dog is investor expectations, and the fellow at the end of the leash, that's Jay Powell getting yanked along by animal spirits. And as a result of that big rally, you're looking at U.S. equities trading at about 21, 22 times earnings. That's more expensive than they've been about 75% of the time this millennium. So overall, I think the risk reward isn't as good. That said, breadth is expanding, and so for stock pickers and those who are selective, there definitely are opportunities this year.
All right, let's stick with that analogy. How does the walk end? Most of the time when you see that happening on the streets, the owner eventually gets control and maybe gets a choke collar. Sometimes the owner gets pulled over. What happens?
The dog gets run over.
I think one of the things you have to consider is that not so much what are interest rates and what is the Fed going to do this year, but how you might want to get it wrong. I mean, that, you can have the one type of error where one expects and builds a portfolio expecting 6 cuts, and perhaps you only get 3. And the flip side, you maybe expect 3 and you end up with 6. The latter type of error is probably the better error that you want to make for your portfolios, whereby we're suggesting clients maybe invest a little bit more conservatively and build a portfolio of names that have visible earnings. And this is a great type of environment to buy companies that are returning capital to shareholders via share repurchases, and especially in dividend raises.
You do think, though, that inflation is falling more quickly than data suggests right now. Wouldn't that lead you to think that more cuts are coming more quickly?
Inflation definitely is coming down more rapidly, I think, than even the market has priced in. When you consider that the last 3 months, core inflation is around 2.4%, and really the biggest driver of that has been shelter costs, which that's stale data. If you look at real-time shelter data and plug that in, inflation may already be at the Fed's target. And so that said, the Fed does have the ability to reduce rates, but there's 2 reasons that the Fed would reduce rates, one of which is on economic weakness, and the other is simply that inflation is coming down. And I think that really the inflation coming down is probably the good reason, whereas the economy is showing signs of maybe softening from 2023's growth, but you're not necessarily seeing signs of recession yet that might necessitate cutting more times.
You like industrials and you like healthcare. Why?
In the case of industrials, it's a sector that really has almost twin secular trend engines, one of which is the infrastructure spending bills that were passed a couple of years ago. That may seem like yesterday's news, but a lot of that money is just going out the door, and that infrastructure spending is expected to double even over the next couple of years, not peaking until 2026. You have that. And then in a world of geopolitical uncertainty, a lot of industrial names reside in the defense space. And so I think that spending is continuing to drive it. And just, we're seeing a gradual rebuilding of U.S. manufacturing capacity, all of which said, more important than anything, industrials don't have demanding valuations. Whereas in the case of healthcare, it's the one sector in which if you have an uncertain world, which it seems like we do today, it's the sector that kind of straddles, it's kind of the best of all worlds between playing defense and growth. You have great demographics. You do have many of the names in healthcare provide things that are non-discretionary, and so that allows investors to be defensive if we do have an economic slowdown. But at the same time, it's the one sector that's actually generated the best earnings growth of any sector, even including technology, over the last 40 or so years. And so you get the compounding effect of that growth is something that can also drive returns.
Burns, thanks a lot.
Thank you.
Coming up, private payroll data from ADP futures ahead of that. Numbers up 77. That's one of the higher numbers of the morning. S&P up just under a point, and NASDAQ down 30 points. Squawk Box coming right back. Coming up, December ADP employment. Squawk Box coming right back with the number.
and comfort.
It is time now for December's ADP payroll report, coming in at 164,000, which I believe is a beat on the upside. The street looking for 130,000. They revised up the last month or just a little bit. Maybe it was revised down. Guys, just scroll up a little bit. I just want to get the bottom there. I forgot what it was. Okay, so 130,000 was the estimate. Goods sector up 9,000. Service sector up a strong 155,000. And there's the payroll estimate for Friday for the government report, 170,000. So this would be in line with that. And they did revise down the November number to 101,000 from 103,000. Looking at it by business size, pretty good across the board, 74, 53, and 40,000 across the board, small, medium, large. And then pretty good job growth by sector as well. Leisure, hospitality coming in strong again. Education, health services, those are the two sectors that have really been leading, with finance activities also doing well. Manufacturing down 13,000, one of the few sectors down and down big. Now this is, I think, some of the more important data that ADP provides is this wage data, with job stayers down 5.4%, down to 5.4%. That's 2 ticks down from November, and continuing a slide that we saw beginning in September 2022, job changers up 8% year over year. That's a stronger number, obviously, but it's down from what it's been. Becky?
I just realized the weakness with the ADP number in terms of trying to figure out the most important number from Friday. I think Friday, the number we're going to be following most closely is going to be average hourly wage increases, just because of the inflation picture at this point. ADP has that information. But
They have that information, and the reason I emphasize every month its importance is because their data set is so much larger and complete than the government's data set. In fact, for more on these numbers and just this fact here, let's bring in Neela Richardson, Chief Economist at ADP. And Neela, I don't want to denigrate the other numbers by praising the wage numbers, but tell us how big the data set is for the wage numbers versus what the government is providing us with.
Well, first of all, Happy New Year, and I'm happy to do that because we're looking at 10 million individual wage earners to calculate our pay insights number, and that's from a sample of 20 million that we start from. Why 10 million? Because we're able to match each individual over time. Right. So we're not talking about cohort effects or the fact that one sector was stronger one month than the other, or that there were a lot of part-time jobs in the second half of the year compared to the first. We're talking about the same individual matched every single month for over a year. And that gives us a really robust fine-grained measure of wage growth. And what I tell you, Steve, and what you already know, is that pay deceleration is the story of 2023. After moving sideways in terms of growth for the better part of 2022, we actually did see that deceleration through 2023. And that means any specter of a wage price spiral that pushes up inflation has all but disappeared.
Yeah, Becky, I'm going to promise you, I'm going to come back and do an whole segment on the wage data from ADP, okay?
Because I think their number is going to be better.
Really important, and I'll show you what that does versus the government data. But let me just use the time I have with Neela to talk about the job market. Neela, you didn't decelerate as much as some had thought. How do you overall characterize what's happening in the job market? 164,000, still a little bit above trend, but not as much as it's been.
You know what? I was actually a little surprised about the rebound because we had been seeing about 100,000 jobs for the past 2 months, and it was really driven by the slowdown in leisure and hospitality. What we saw in December was consistent with a very strong holiday travel season and a very strong holiday retail season, which people were moving around, they were buying things, they were going places, and we saw a return to leisure and hospitality. That not only fueled that industry, it also fueled small firms, which are over-indexed in that sector. So if this keeps going, if we're seeing above-trend growth into 2024, that's a good sign for the labor market. One note of caution, manufacturing. Second note of caution, we still didn't see retail hiring as strong as it was before the pandemic. So we're still low compared to 2019.
Neela, we're unfortunately have to leave it there. We're a little pressed for time this morning, but thanks for joining us and giving us some insights into both the pay and the job growth that's going on in the country. Thanks, Neela.
Thank you. Take care.
All right, when we come back this morning, we do have more on the news that Eli Lilly will make a breakthrough weight loss drug available directly to consumers. Squawk Box will be right back.
They can deliver. It's been a rough start to the year for Apple, which got another analyst downgrade just this morning on slower iPhone sales and cloudy growth prospects. So, will Apple lose its status as the most valuable stock? John Ford is here to weigh in. John?
Yeah, we all got jackets on this morning.
I didn't realize that until you sat down and said it.
So I put one on. Well, no, Apple won't lose the top spot, Mike. I'm not saying it'll keep its $2.9 trillion market cap. I'm just saying that it's not the worst house in the mega cap block. So if Apple's value slips, all the others probably will too. Now, the notes on Piper and Barclays downgrades make some reasonable points. The iPhone isn't growing right now. China's a weak spot, and the March quarter won't be that strong with consumer credit stretched. What the downgrades miss is Apple's got unique strengths. Its vertically integrated products and loyal customers provide advantages in a shifting economy. Because Apple controls so much of its manufacturing and supply chain, it can quickly balance inventories when demand shifts. And because its stores nurture a direct relationship with customers, Apple's got an affordable link to a wealthy audience. Now, also, Apple's Mac lineup runs completely on its own chips now, which gives its machines better performance at higher margins than rivals. And because Apple didn't update the iPad line at all in 2023, there's probably pent-up demand for a 2024 refresh there. Now, the biggest threat to Apple stock is a valuation reset, and that will hit AI-fueled Microsoft just as hard if it comes. There might be temporary market fluctuations, but Apple stays number one.
All right. I mean, I think it's only about a $100 billion gap right now.
Yeah,
and
that's it.
Here's my market nerdery. In the S&P 500 index, Microsoft is actually the higher weighting by a slight hair because it takes the free float, and Berkshire Hathaway shares are sort of removed from the market. However,
You said, here's my market nerdery, as if you weren't leading with that already.
exactly. That was redundant. You're correct. On the other hand, you've laid out the reasons.
That's my line.
Why, exactly, why Apple has this valuation in a sense, the predictability, the financial strength, the fact that it has this massive install base and customer relationships. What about the innovation piece? Did they kind of lose a generation of new product introduction and get left behind?
Well, Mike, on the other hand, Apple stock is sure to lose ground to rivals in 2024. Now, iPhone revenues have been stagnant for the past 2 years, even as shares have stayed strong. Apple's had a pretty good 2023, even though its artificial intelligence story is the fuzziest of all the mega caps. That says to me that if there's a valuation reset in the market, Apple's going to get hit harder than the rest because unlike Microsoft, Alphabet, and Amazon, Apple doesn't have an AI narrative to fall back on. In 2024, we're moving into a moment in a technology cycle that doesn't play to Apple's strengths. This happens every 10 years. In the early 2000s, after the dot-com bust, investors didn't believe in consumer hardware anymore and abandoned Apple. In the early 2010s, after the financial crisis, investors thought Samsung would commoditize smartphones and abandon Apple. This time, investors probably will abandon Apple because they think the future belongs to massive cloud platforms and the AI software models running on them. The thing is, this time, they might be right. 20 years ago, Apple's iPod laid the groundwork for success. 10 years later, the iPhone proved the naysayers wrong. This time, is Apple's Vision Pro headset going mainstream? I mean, for $3,500? No. Sorry, Apple.
John, what if you're wrong? What if, of course, there's both sides.
Yeah, I cover myself nicely.
This thing here, what if this becomes the conduit for the AI and what we need is bigger, faster, stronger hardware because the software caught up with it, that would really rejuvenate a round of replacement and recycling of the phone.
Especially since Apple's making its own CPUs and graphics processors so it can control that process. That's a very good point.
So that would be the thing that could be, if AI goes to the phone rather than the desktop.
Well, it's moving to the edge. Like, everybody's talking about it. Intel talks about that. You know, NVIDIA's already at the edge.
Phone for software for years.
Yeah.
Maybe I do soon.
We know you can go to CNBC.com, OTOH, right?
That's right.
Get the whole.
There's a little we don't have the QR code yet.
Yeah, we get data.
What are people going to do? All right, type in the URL, just like everyone.
Thank you.
All right, coming up, more breaking economic data. Jobless claims are out after the break. Squawk Box, be right back.
Welcome back to Squawk Box. Rick Santelli here live at CME HQ with the breaking news of the morning. Initial claims expected to be 215 to 217,000. Well, they come in light. 202,000, 202,000. This is the lightest level going all the way back to the second week in October. And on continuing claims, call it number 5, the 5th consecutive week under 1.9 million. Yes, we had 1.9 million the third week in November. That was the highest level since Nova of 21. But this is 1,855,000, definitely on the light side. Definitely below last look at 1,875,000, and 1,855,000 is the lightest level going back to the second week in November of last year. Not that far ago, but as I said, 5th week under 1.9 is significant. There are revisions coming in, not big ones, subtle revisions to the upside. Interest rates moving up on that, and ADP, which was the highest since August, and maybe even more important, across the pond, if you look at inflation in Europe, boy, Germany's specific inflation, which came out at 8 Eastern, was warmer than expected. Prior to that, all the regional areas in Germany's inflation numbers came out hotter than expected. Bund yields hovering at 210. Should they close there, that would be a 3-week high yield close. We still have more data to come, but the significant aspect of this short year thus far has been interest rates moving higher and yield curve vibrations that seem to be inverting more on the steepening side. Mike, back to you.
For sure, Rick. Absolutely stay with us. Steve, you had a quick note on this?
Yeah, just everybody needs to be a little bit careful with the numbers around this time of year, right? You're already starting to fire people from Christmas. I think it starts actually the week of Christmas, right? That people get laid off for the high. So the data's going to be noisy. It's good that it's been down. If it was high, I would have said be careful. If it was low, I would have said be careful.
Okay, we'll continue to be careful as we open the discussion up. Let's bring in Skanda Amarnath, Employee America Executive Director, and E.J. Antoni, economist at the Heritage Foundation. Gentlemen, so these are firm numbers. We can, run them through the filter of what seasonality means or not. But Skanda, you have this setup where we have labor market resilience, the economy continuing to hang in there as employment's come down faster than the Fed thought. Now the big debate is, what's the correct interest rate structure if we're going to continue on this path? So what's your answer there?
So the reason thanks for having me on, by the way. So the reason we have interest rates, Fed funds rate specifically at 5.33% is because inflation seriously flared up for multiple years, and the Fed was trying to play catch up to where inflation was, with some understanding that we know it's probably not going to stick at the peak, but we don't know how far it's going to fall. And if we take that forward now, we're seeing that inflation is falling faster than the Fed's projecting, at least in 2023. We'll see how much more progress we get from there. But if we see that a labor market that looks increasingly normal, especially on measures of wage growth, and at the same time we also see signs that inflation is returning to something like normal, then the path to interest rate normalization actually becomes more compelling. The Fed has time to evaluate this. It's not as if the labor market or the financial markets are showing significant deterioration, but we should see that if we get more confirming signs on the inflation front, and look, there may be reasons for chop, there may be reasons why inflation may not come down quite as quickly as people anticipate, but if we get that over the next few months especially, the Fed should be considering interest rate cuts. It sounds like they are. If you look at their projections, it's basically a function of if inflation can come down, that's an if, but so far the signs look encouraging, especially over the last 6 to 7 months. But if that materializes, I think the Fed will entertain, and I think they probably should entertain, normalizing interest rates as something that looks a little closer to neutral, especially in the context of a labor market that, while resilient on the job growth side, also has cooled, especially on measures of wage pressure and market turnover.
Yeah, and neutral, of course, by the Fed's estimation is significantly lower than where the rates are right now, of course. EJ, one way of, I guess, explaining how markets have been strong in the latter part of 2023 was that the conclusion was the Fed was not going to have to help run this economy way below potential or be very restrictive in order to do the job on inflation. Is there anything in the data today or recently that changes that view?
No, I don't think so, but I'm also not entirely sure how data dependent this Fed actually is, because we have seen numerous times, for example, when they talk up how important inflation expectations are, and then as those inflation expectations move one way or another, the Fed seemingly does the opposite of what they should do. So I think we still need to be concerned that we have over $700 billion in reverse repos, for example. So the Fed is still sucking an incredible amount of liquidity out of the market on a daily basis in order to keep rates where they are. As that money does leave reverse repos, it will work its way into the banking system and multiply, and that's going to help fuel inflation going forward. I think we risk repeating the mistakes of the 1970s if we call victory on this too soon.
I mean, I'm not sure the reverse repo facility and the assets there has been a really great guide to exactly where rates are going or what the economy is going to do. Has it, EJ? I mean, where'd it come from?
Well, it speaks, what it does is it speaks to just how oversized the balance sheet has been. The fact that they need to work that hard in order to try to maintain an interest rate floor.
Yeah, I mean, of course, there was in the minutes yesterday, Steve, the allusion to their thinking about slowing the pace of quantitative tightening and the runoff in the balance sheet.
Thinking about perhaps providing a framework for ending QT, which, by the way, we did in our Fed survey leading the pack, the recent talking about it. People do expect QT to end in November of this year, which is kind of interesting, if depending upon where the Fed wants to get to, with an important question of what EJ was talking about, which is this idea that they do bring down the reverse repo facility first. And that's, by the way, when QT should start biting a little bit more. Yeah. Once that reverse repo facility goes away, which is sort of the froth on the market. Rick, I want to ask you about the minutes yesterday. I think people went into it looking for a little affirmation or confirmation or support for their views of rate cuts, but didn't get it yesterday. What was your takeaway?
You know, my takeaway was very similar to a friend of CNBC, Peter Bookvar. I think they were a little bit more sanitized than the actual impression that was left by Jay Powell when he opened up the press conference. Most traders I talk to think that the market's still in control. They see the pushback, they see the walk back by the Fed. But the real issue continues to be in the marketplace that all this positive feeling with regard to inflation and how many interest rate cuts we have probably is going to be tapered, but not necessarily because of Fed speak. I think, look overseas. If you use the same methodologies, for example, in Germany and some of the areas in Europe where inflation has been anything but linear, if you annualize some of those better inflation rates as they were moving down, you'd end up with the same trap that we may end up in, is that it isn't linear and there can be bumps in the road. Now, I'm not saying our inflation projections are going to match entirely with Europe's or Germany in particular, but my guess is that they will rhyme and there are some significant issues. And the other thing, but one other thing, Steve, I'm glad you brought up the claims distortions. Holidays always seem to push claims a bit on the low side. But the other issue is that we talk all about interest rates and the Fed, and they're hugely important. But I think 2024 is going to be the year of the market rate on the long maturities. And I continue to say, if all we do is try to talk around in circles about what the Fed may or may not do, and their projections of the past should give us a notion that we should spend less time doing that. The reality is the market's starting to focus on other issues. Maybe it's $34 trillion in debt. Maybe it's servicing the debt. Maybe it's the fact that that parking lot, Mike, has had a lot of movement at RRP. Go on.
Rick, I want to pick up on that. I want to throw the question of Skanda, which we aren't yet at a point where the market can set an interest rate the way the market wants to set it, kind of irrespective of the heavy hand of the Fed. And I guess I say that by pointing out the Fed can stay tighter for longer, but the market may not want to. Where are we at in that process? I know the Fed is coming off reducing the heavy hand, but it's still pretty important in terms of where rates are being set, especially on the short end of the curve, Skanda.
Right. So we have a very high level of the Fed funds rate in terms of 5.23%. But obviously, if you look at long-term treasury yields, they're all anticipating some path towards cuts. Some of that might imply a recessionary scenario. Some of that may imply a very benign interest rate normalization scenario. And now the proof is going to be in terms of Fed policy and how it either validates or doesn't validate market pricing. If it doesn't validate market pricing in a pretty aggressive manner, let's say we stay at higher interest rates for much longer, either because interest rates or inflation rates stay high, or the Fed just proves to be a lot more hawkish, that probably would have some implications for financial conditions. So the Fed has the task of really, how does it hold serve here? How does it actually stick to its policy rates in a way that isn't too dislocating in either direction? So the burden of proof is really on the Fed and Fed actions over the course of 2024. Markets have already priced in quite a bit.
Yeah, for sure. We'll have to monitor it along the way as we go. We've got to leave it there. Thanks to all.
EJ's rolling his eyes, thinking that this is still a $7 trillion balance sheet. How can we talk about the market setting? But we'll have EJ back to make that comment.
Yes, we will.
Okay, coming up, former White House Health Policy Director Dr. Kavita Patel will join us on the health and business implications of Eli Lilly going direct to consumer with a popular weight loss drug. We're going to come right back.
Eli Lilly making a move today to bring obesity and diabetes medications directly to consumers. The company is launching what it's calling Lilly Direct, which will allow people to get medications directly from the company and maybe not go through a pharmacy benefits management plan. They do have to have a doctor's prescription. Joining on this right now and the impact of more transparent pricing for these drugs is Dr. Kavita Patel. She's a primary care physician, a former White House healthcare policy director, and an NBC News and MSNBC contributor. And Dr. Patel, thank you for being here. We need a little guidance and advice because we've been trying to make sense of this news and figure out what it all means. And there's a lot of different implications that I can think of. I guess, first of all, as a doctor, what do you think about going directly to consumers?
Yeah, Becky, I think it's kind of an indication of what consumers are seeking. People are tired. People don't even know, most doctors don't even know about all the kind of middlemen and different entities that are in between the pharmaceutical manufacturer and the patient actually getting their medication. And I think this is just one more sign that people are seeking those easier solutions. And here you have Lilly, basically, they're still going to participate with kind of the pharmacy benefit managers. They have to in order to make sure their drugs get out there. But this is just sending a very clear signal that they are going to look for alternatives through digital solutions, starting with telehealth providers. You're right, they need prescriptions. None of that gets replaced without a prescription, but it'll get people medication in their hands faster. Nothing is more frustrating, Becky, than a lot of my patients. Every single phone call I get is, my pharmacy is out of fill in the blank. And I think this is basically another mechanism to make sure that those calls don't have to happen and that people get drugs. And of course, that improves adherence and obviously gives better returns to Lilly.
Okay, look, this is a shot across the bow for the pharmacy benefits managers because they're offering it at half the price because they say the PBMs jack up the price and all of that money never makes its way. The cuts that they give to the PBMs never make their way to the consumer. So there's that aspect of it. There's also the aspect of, okay, the pharmacy says they're out, how do I get it? Do you think there'll really be better managers of getting it direct? I'm trying to figure out if this is like the equivalent of Nike starting its own direct-to-consumer website and still dealing with Foot Locker.
Yeah, we'll see. You're probably right to be a little skeptical on, is this actually going to translate to people getting all their drugs as efficiently as possible? I would, I'm not a betting woman, but I would say that it's highly unlikely that that's going to happen as seamlessly as it might sound. However, Becky, I think it is incredibly likely that you're going to have a much more motivated line of service that is Lilly partnering with a telehealth provider that also is a third party that wants to make sure that they can deliver to the consumer. All of these people are much more motivated for the consumer, which is what you're not seeing with kind of middlemen. I think if add to that we are going to see the FTC actually taking some action on these PBMs. Who knows what that will ultimately result in? But I think all of those are signals that we're sending that, hey, getting to the consumer in a more responsible, direct manner is going to be good. And when you're talking about not just $1 billion drug, but potentially $1 trillion out of drugs like Mounjaro, Zepbound, all the weight loss GLP-1 category potential, everybody is motivated to get them into consumers' hands as efficiently as possible.
But do you worry that the going direct to the consumer creates this tug on the doctor that we've heard about where a patient comes in to see the doctor and isn't satisfied until you write them a prescription for leaving the office?
Yeah, I have to be honest. I've been practicing for a long time, and that we always kind of worried. When I started practice, I thought, oh, that's going to happen. They're going to leave my office. They're going to go find someone that will get it for them.
The pill.
Right. That certainly happens. I don't want to dispute that. That happens every time I say, no, you don't need an antibiotic, it's a virus. Or no, you really don't need that drug. Let's try these other approaches. That does happen, but it's a much smaller fraction than you would think. It's not actually the large majority. I think the large majority of people, if they hear from a doctor, hey, I really don't think you're appropriate for this drug, then they listen. What I think you are hearing, though, when Lilly makes this kind of partnership with a telehealth provider is actually, Mike, that it's hard to get to a doctor. I think this is dealing with an access problem where we have like literally millions of Americans, if you tried to pick up a phone and get a primary care appointment or even a weight loss appointment with an obesity specialist today, you can't get one. I think they're also trying to deal with an access problem. And that alone, I think this puts a lot of pressure on insurers, quite frankly, because we still have incredible difficulty getting this covered. And I think this is going to put a lot more pressure on insurers in the end.
That's what I was wondering too, Dr. Patel, because we have not seen the stocks of UNH or Cigna or CVS trade down today. I was watching this pretty closely. They still look like they're, okay, CVS down by, 0.4% at this point, or 0.4%, not much. The others are still trading up, and this seems like this is a big push, not only towards the insurance companies and the pharmacies, the pharmacy benefits managers. It just seems like you can still say we're all going to be here, but again, if I go back to the Nike and Foot Locker kind of comparison with that, down the road, it may not be a big deal right now, but down the road where we are right now with Nike and Foot Locker, it is a big deal.
Right, Becky. Hey, look, I'm old enough. I remember going to Blockbuster to get my videos. So, I definitely agree with you.
Welcome Netflix.
And I think that the more that manufacturers embrace, and look, there's a lot of regulations in healthcare, so it's not like everybody could just go out there and sell anything to a consumer. Keep in mind, this isn't easy, but every single drug company, big or small, is thinking about a digital approach. Think about gene and cell therapy. Even just the education around that makes sense to do digitally. So what I 100% right that this news in and of itself is not going to necessarily shock the stock market, but I think it is sending a deep signal to the healthcare industry. Be watch, look for these partnerships to disrupt the very traditional mechanisms. That combined with the FTC, that could actually amount into some short-term action.
Dr. Patel, thank you very much.
Thanks.
Have a great day. Squawk Box will be right back.
Asset.com.
Welcome back, everybody. New retail spending data out this morning as we close the book on the holiday shopping season. And Courtney Reagan is here. She's got a roundup of what we can expect. What are you seeing?
So we don't have full numbers, right? And the retailers have yet to reveal how their holiday sales turned out individually. But some data aggregators point to a relatively happy holiday season. U.S. online sales rose 4.9% between November 1st and December 31st. This is according to Adobe. That is slightly above its initial forecast, with sales between that key Thanksgiving and Cyber Monday stretch much stronger than expected, up 7.8%. And ultimately, that 5-day stretch made up more than 17% of total online holiday sales. Now, Adobe says that 5 categories made up 65% of total online holiday sales. Electronics, number 1, then apparel, furniture, groceries, and toys. Adobe says the sales gain was driven by net new demand and not inflation, because it says the online retail prices it tracks are down more than 5% in December from the year prior. Now, Customer Growth Partners also calculates a stronger overall holiday season than it initially expected, with sales in-store and online combined up 2.4% compared to its initial 2.1% growth estimates. Interestingly, the research group says Super Saturday sales hit $47 billion, beating Black Friday's $42.6 billion total. That's always the last Saturday before Christmas. Now, MasterCard, however, says preliminary sales between November 1st and December 24th grew 3.1%, which was short of its 3.7% estimate. That is for both online and in-store spending, and both of those did grow individually too. Restaurant spending grew nearly 8%. Apparel sales increased 2.4%. And MasterCard chief economist Michelle Mariner says that the economic backdrop is favorable and consumers spent, quote, in a deliberate manner. So yes, less than forecast, but still sort of more normalized, frankly, than what we had seen with these strange COVID surges in different categories.
You answered my question, though, when you talked about inflation.
Yeah.
This was not just inflation that pushed it up.
No, they're saying net new
Everybody's making
demand.
a mistake.
Yeah.
Goods inflation has been deflation in goods prices.
It has,
So it's not-
particularly these 18 core retail categories that Adobe tracks that also mirror what the BLS tracks there.
I was
And so think
surprised to
that's
see
key.
electronics as the number one, and surprised to see toys as the last.
I know, very interesting. And both of those categories did also have pretty decent discounts for the holiday season. We did a story on this Care Bear in particular, and the price of the Care Bear had fallen fallen fairly precipitously too over the last couple of years. So interesting, even just a sort of an anecdote of a toy like that.
All right, thanks.
Thank you.
Stay tuned. Next week we'll have our CNBC NRF retail sales numbers.
Okay.
For January. Just over half an hour left until the opening bell on Wall Street. Joining us now on the markets, Ross Mayfield, investment strategy analyst at Baird, which is more than $400 billion in assets under management. Ross, good morning. Navigate us through these last couple days in context of the huge rally we had at the end of last year. Is it all over? Is it just a break?
I think it's much more likely this is just a tidy kind of consolidation correction after a really breathtaking rally across November and December. So, the market was overbought by almost any metric you could look at. That's bullish over the intermediate term, but in the near term, a little consolidation here and there. It is not surprising, and especially with the context of investors maybe reassessing whether all those rate cuts they started pricing in are actually going to come to bear. I think there's a reality check on that front as well.
I read the Wall Street Journal's lead headline this morning. Stock's bad start to 2024 has forecasters on edge. And I thought there's so little faith in the rally we just had, I want to buy it. Is that, I just feel like people are so lacking confidence in what's happened. All of a sudden, they're ready to write the whole thing off after 2 days. I think that's a positive sign for the rally.
Yeah, absolutely. I will take any negative sentiment we can get. Some of the survey data on retail investors suggests more of an optimism or euphoria after the big rally. But, there are still things like what you're talking about, like the big inflows into money market funds that suggest there's just not quite this buy-in yet, that it feels somehow, not real, that the idea that a soft landing could actually happen. There's just still a lot of skepticism out there. And as you mentioned, those are the kind of things we want to see. When it's all euphoria all the time, those are the time to hit the doors.
At the same time, Ross, you have to deal with the issue of valuations. What do you expect to happen? Earnings season, I think, starts next week in earnest. Some stocks are trading at relatively high historical multiples.
Yeah, absolutely. And we know, valuation is not a great timing tool short term, but longer term, it matters. And when you have elevated valuations, you really need earnings and profitability to come through to help the market grow into those valuations. Otherwise you might face a low return, kind of long-term future. The market is expecting pretty good earnings growth, double-digit earnings growth for 2024. I think that number probably has to come down a bit, but if we hear things like the report you all just, put out on retail sales and spending and the consumer staying healthy, and, we got job market data this morning that shows that things are still pretty fine, maybe the earnings don't have to come all the way down to low single digits, and maybe an expansion in profitability and profit margins is in the coffer. So, I do think the earnings expectations are maybe a little high. Valuation is a problem, but it's not something that's flashing red on our radars.
All right, Ross, thanks for joining us this morning.
Thank
Guys,
you.
very quickly, I just want to weigh in from Carrie Firestone. She's got an idea on Lilly's plan to go direct to consumers. She's been watching at home, says she thinks it's a brilliant move by Lilly. It's a huge market drug that's new. Might be that there would be a price war eventually, and Lilly wants to preempt that phenomenon by taking control of its own product now, which is pretty interesting too. But from a stock picker's perspective, that's what Carrie Firestone is saying about it. Also, another quick story for you. or maybe not. It just went away. We would tell you a little bit about a TikTok matchup with Peloton. They've got some deal that they're going to be doing together where they are powering a channel that by Peloton, basically you have a lot of short snippets of things that are out there. You can do it all on Peloton. I just wonder if that's going to be cannibalizing Peloton's own stuff, but it is a good way to get out there and get a lot more people watching.
And tomorrow, jobs.
Tomorrow,
big jobs, huge. Come back. I'll be here. Or maybe that's a reason not to.
Mike Santoli will be here. I'll be here.
Jobs,
We hope
big,
you'll see us there.
huge.
It is a big day, and right now Dow futures up slightly, up by about 78. Nasdaq down by about 80, and the S&P down too. We'll see you back here tomorrow. Right now it's time for Squawk on the Street.
Good Thursday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 of the New York Stock Exchange. David Faber has the morning off. Bulls looking for some relief after two 1% declines to start the year on the NASDAQ. Yields are elevated again, though, as jobless claims come in at the lowest level since mid-October. Our roadmap begins with the big tech rout. Mag 7 stocks in the midst of their longest decline in more than a month. Apple shares tumbling 6%, another downgrade today. Plus, watching pharma, Walgreens slashing its dividend, Lilly taking weight loss drugs direct to consumer. And it's all about autos. GM gets an upgrade, Rivian downgraded, and Ford set to announce its latest sales figures. Let's begin, though, with stocks trying to bounce back from another tough session. S&P riding a three-day losing streak. Jim, back-to-back 1% declines on the Nas only happened a couple times. 1980 and 05.
Yeah, this is we trimmed these stocks at the beginning of the year, and we did it because it just felt like this was one of the greatest runs ever. And right into the last, from the, believe it or not, even from when the Fed signaled that they were probably going to be done tightening, this Mag 7 still was up 11. You had the S&P non-weighted, not overweighting Apple, they all 500 equal. That was up a couple percent more, so you could say that had been doing better. But the group's underperformed. But the main thing that's happened, obviously, is everyone's just picking on Apple, concerned about handset inventories. Some people are thinking it goes right through the supply chain. That's Qorvo and that's Skyworks Solutions. And at a certain point, you're going to say, well, I heard that already. But it sounds like that harsh commodity. Look, these are rigorous pieces because, as I said the other day, I think Apple will go to 160 without a problem, just because China and because handsets are in oversupply. But Carl, Apple was up almost 50% last year, and everyone acts like Apple was disappointing. And if all of our stocks were up 50%, do you think we'd be sitting here? Why talk about it? Let's just talk about the playoffs. And, let's just be unbelievable if everyone's up 50%.
Jim's referring to this downgrade today out of Piper, where they do cut Apple to neutral. They go to 205. They were at 220. But to your point, they also cut Microchip and Qorvo and Skyworks.
I mean, it's funny because it's not funny, but Microchip just got the
grant.
Yeah, got the great grant from the Commerce Department. And by the way, that is a terrific grant because it's going to expand what they're doing in Colorado Springs, and it's talked about Oregon. And Microchip is the dumb chip, so to speak, meaning what we really lost in the supply chain, that whether it be for defense or for aerospace, were these chips that are called large form factor, and they're not the most up-to-date cutting. And that's what we're hostage to. So I thought this was very good. Commerce Department, once again, finding a way to do the right thing and make people feel that your tax dollars are going a long way.
Yeah, we'll wait to see if those grants get finalized because they are in a preliminary stance.
But I would say that so far what I'm seeing is that they're focused on defense and aerospace, and that's good because talk about critical. I mean, when you pick up the front page, they're not talking about what we're doing. They're talking about what's happening in Iran. And we obviously, if we're going to try to stop the so-called rebels in the Red Sea, that's dumb chips. That's not high-end chips.
Right. And to that point, Micron does get upgraded over at Piper.
Interesting, because that really is that cell phone.
And we had Sanjay on a few weeks ago.
Yeah, I thought Sanjay tells a very good story. The stock had dropped. I was surprised to see the stock's down to 82. Now, that does dovetail with something that no one's talking about, which is this Microsoft putting
the new button.
A new button. Of course, now Microsoft doesn't do any buttons because the stuff is hardware, and the hardware is that's HP, which HP did not tell me about when I spoke to HP last. But that's Micron, and that's the AI that we've all been waiting for, that AMD has said. That is we press the button, and we get what we want. We make our lunch reservations by talking to our PCs.
First time Microsoft's added a button since '94. This would basically activate Copilot.
Yeah, and yet, when you speak to the people at Microsoft, Copilot's already making a lot of money. It's very hard to find anyone who's making a lot of money, and yet maybe AI is not a bubble because Microsoft's going to. Amazon, very involved. These new Meta products. Hey Meta, look out! Everybody when I say Hey Meta, that activates your Ray-Bans. But they've got a lot of AI. So AI is coming into the mainstream when you see something like this, and it makes you feel like, wait a second, how could it be a bubble if Microsoft just put a key on your PC?
Although Amazon earlier this morning was down 1%, that's the 4th day lower. It's just hard to fight some of these macro headwinds, right?
And look, and obviously these are sources of funds. NVIDIA mentioned today positively that's a source of fund. But what I think is interesting is if you're going to put a button for Copilot on your PC, the reverberations for that are basically throw out your PC and get a new PC. Now, we've been waiting for a refresh cycle. This is the greatest refresh cycle in history. Because, what are you going to, like, let's say I come in and mine doesn't have a button and yours have a button. You're going to allow that to happen? If you get the button, I want the button. And HP is probably going to have to do the button. And or Dell. You have to upgrade your PC. Well, that is a Micron. It also might be Intel, but then Intel owns a lot of Mobileye. And Mobileye was one of the fiascos of today. Yeah. Good work by Ray J yesterday. Downgrading Mobileye. There's a lot to cover, is what I'm saying.
Yeah, Mobileye does guide revenue down 50% year on year.
That's
some excess inventory.
Yeah, that's a slash.
Does the labor data today interest you? We mentioned claims. ADP comes in solid. Challenger a little bit lower than the prior month.
But we don't. If you're a bull, you just want to see data which continues this idea that things are tepid and doesn't drive the yield, the 10-year past 4, because then you can still stick with that whole rap that there might be 5, 6 cuts. That's a rap that I simply don't believe in, which is one of the reasons why I wanted to trim at the beginning of the year. Because if everyone's leaning toward that way, that's going to be wrong. I mean, could we take out 4% on some, when we're taking for the 30-year already over there, and the mortgage rates probably go back over 7. I just don't understand the 6-cut thesis. I mean, not when you see numbers like that.
Yeah. Well, there's a lot of work being done right now on sort of the rethink of the Fed pivot. The J.P. Morgan Treasury Client Survey, biggest drop in net long positions in a few years.
I know. Look, I think that a lot of people, there's a lot of inputs right now. It's strange that unemployment obviously a little strong. Employment's stronger, but oil seems to bottom at 70. You can count that strike against it, and yet coming in, there was just this notion that the Fed was being with 3. Not being straightforward with us, that they're going to do more. No. I see so many people come on air and they keep saying that the Fed is not telegraphing. Why don't they look back and see that Jay Powell said everything and then did everything? I mean, I find that Jay Powell is not hard to figure. He's not inscrutable. He's open. 3 is 3. 3 is not 6.
Right. Of course, that does come a day after we got the December meeting minutes, where the Fed did say, in discussing the outlook, participants viewed the rate as likely at or near its peak for this tightening cycle, though they noted that the actual path will depend on how the economy evolves. Kind of a pushback against a Q1 or a first half.
Completely. I thought so completely. And look, there's room for construction. That's gotten less tight. I mean, that's important because the home builders are making really good gross margins. It's not clear. I mean, I'll tell you the underground story, and I know this from the business that I was in. The immigration has really made it so that there's an underground economy again, like we had before Trump. No one wants to talk about it because it's completely third rail. But the underground economy is making it so that the people who are being paid a very high price, above minimum wage, don't have to be. Now, again, I don't want to hire anyone who's not a citizen or green card, but that economy is not being taken into account by these numbers.
So for tomorrow's NFP print, you'll be watching, I can imagine, wages, right, and participation.
Definitely. Yeah, because I just think, look, what did they really do when they pivoted? They said, look, it's not higher for longer. That's out. We're going to have to probably cut. But the time frame of the cuts is completely random to me. In other words, if the data says they should cut, they will. Someone was on our air this morning says the Fed's not data dependent, and I wanted to scream.
What, you scream with the TV as well?
I wanted to go put on, Soupy Sales. I mean, I don't need that. They're not data dependent. Like the whole thing has been data. Like, why say stuff like that? You are what your record says you are. I mean, we have to deal with the reality, which is they're data dependent and they're very clear. And what they're saying is the data's really strong. We're going to take our time cutting it. Why is that so hard to understand?
Meantime, there's a bunch of micro news today, company specific. Walgreens, a good example, reporting before the bell this morning. Earnings beat, slashing its dividend nearly in half, first time in several decades. And CEO Tim Wentworth did speak exclusively with CNBC about that decision.
We didn't love having to make that decision. We actually thought it was incredibly important and responsible. And I will tell you, the majority of investors with whom I've met since taking this role not only expected it, but they actually are excited about the fact that we're going to have additional capital to invest in the core business in a way that stimulates growth again, because that ultimately is going to be the most shareholder-friendly thing we can do.
Hitter. He's a hitter.
Basically, you tweeted that he's starting to work his magic.
Oh, yeah. I mean, everyone knows that his press scripts, he was great. Signy was great. And he comes in and basically just says, look, I got to do what I said I have to do. And if anyone was surprised about that, they were probably in some sort of Musk flight to Mars. We don't know that for certain. But I just think that Wentworth, sometimes you have to take the CEO's credibility. Now, I thought Roz Brewer had done previous CEO, the one who quit after 3 years. So that's 3 years. Yep. She come from Starbucks, where she was very, very good, but the Walgreens challenge, and she went headlong into health, which I don't think was bad, but that's really what Tim's strength is. I think he will be terrific. I look forward to talking to him again when I'm out at JP Morgan. Look, healthcare and tech are so on the red-hot griddle right now, but healthcare's on the upside and the techs are on the downside. And it's very, very important to realize that the techs are sources of fun, and healthcare is very interesting to people. Away from where the treasuries are.
Yes. By the way, you can watch the whole Wentworth interview on CNBC.com.
That's fantastic.
Jim mentions healthcare because you got the Walgreens news.
Right.
You got Cigna news yesterday on this Medicare Advantage business. You got some upgrades of Merck today, a downgrade of Pfizer.
Yeah.
And we got the JP Morgan healthcare conference coming on.
Oh, my. I mean, look, Lisa Gill's going to be on my show tonight on Mad Money, and she runs the greatest conference of the year. And if you're interested in healthcare, I think my staff set me up with 27 interviews. 27 20-minute interviews. I'm like looking at the intervals and I'm realizing, okay, Kansas sleep, take the red eye back, bring the executives home. But one thing that is certain is that has been where people some people break news there. I was there when Medtronic announced a shortfall. And it was one of those things where it's like, huh? No. And it was very tough.
Was that coming out of COVID?
No, it's just several years ago. But it was like, I'm saying this is up to the minute news stuff.
Yeah.
And David Ricks, who is so great and so clear. If you read the statement today about Zepbound, which is, of course, their weight loss drug.
We're talking Lilly now.
It does sound like he's trying to streamline the process. But, Carl, an end-to-end direct healthcare experience, Lilly Direct, is something that's new. But I don't want to say it's necessarily an enemy of the chain. I want to say that Lilly has made it so that you've always been able to get it at all different places. But most important is it's $25.
So, for viewers wondering if there's liability for PBMs, your answer is no?
Well, look, I just know that when Lilly did its migraine drug, they chose to be unlike Amgen. They cut out the middle guy and just gave it to CVS. I know, because I'm on the drug, and I get it from McKesson, which is from Amgen, and I remember fighting Amgen, saying, listen, can I please get it at CVS, because that's refrigerated. And, Lilly was basically saying, listen, we're going to make it so it's easy to get. And so what I'm taking away from what Ricks is doing is he's saying it's easy to get, which could mean maybe you can go to Teladoc. I'll be seeing them next week. It could be that you can go to Amazon. When I saw Andy Jassy, he was trying to say, listen, we're going to be a major factor in the distribution of drugs this year. But whatever, the real takeaway is they're going to make it easier, but at the same time, they really want to crack down on people who use it for cosmetic purposes and crack down on counterfeits, which I thought was surprising.
Yeah, the statement there, very clear that it is not for cosmetic use. And just an aside as to what a big consumer story it is, David Ricks of Lilly on the Today Show this morning, here's what he said.
It's a critical part of how the site works. These drugs need to be used under the supervision of a physician. And we're just offering more choice in that regard. This is about patient success. Our sales will be the same either way, whether we sell it to CVS or Walgreens or sell it on our website.
So their point is this is for a serious disease.
Yeah, look, the thing that you knew that they had to say that, but because the goal is not to make it so people look thinner. Look, it's about blood pressure. It's about statistics, which tell you that you are obese, which therefore you are a candidate to die earlier than people who are not obese. hobby. Just like one of the things that people don't understand about these drugs is that the sotto voce is that diet and exercise doesn't work. Doesn't work for most people. That people try it and they fail. Now it is true. Wall Street Journal had a great piece that said if you exercise 5 to 8 hours a week, then you can have a 4-year increase in life. But for the most part, and this is heresy to the community, but the people who prescribe these drugs just say, look, we know that diet and exercise has not worked for obese, and we got to get obese down because of blood pressure. These are blood pressure drugs, and they're drugs that are meant for a lot of different uses, but for the most part, they're about how to lengthen people's lives. Right. And then people are taking it for cosmetic purposes. Lilly doesn't want that. I mean, Lilly wants to lengthen people's lives. No healthcare provider, no Cigna wants to give you a $25 copay and say, listen, it's better to look thinner. There are a tremendous number of drugs. And I'm speaking to Bristol Myers next week. There's a tremendous amount of drugs, including the current schizophrenia drugs, that put on a huge amount of weight. And what they're really targeting here is what drugs add weight that we can take that weight off by using this drug. What people have not been able to reduce their weight by diet and exercise. And there's just so many lies and mistakes about what this drug's about. Right. It drives me crazy because Eli Lilly's trying to do the right thing.
Yeah. The forcefulness of the statement today makes that very clear. Got some news in the auto business today. Ford monthly sales. Let's get to Phil LeBeau for that. Morning, Phil.
Good morning, Carl. We have actually Q4 sales for Ford, and much like General Motors, not a huge increase, but it was an increase for Ford, 0.8% increase in Q4 sales. But listen to these numbers, especially when you break out hybrids and EVs. Hybrid sales, and we've talked about how Ford has an underappreciated hybrid business, up 55.5% in the fourth quarter. EV sales up 27.5% as they increase their production, particularly with the F-150 Lightning. ICE models. Now this is interesting, guys. This is where you see hybrid and EV sales replacing ICE model sales, down 3.5%. So again, Ford overall for the fourth quarter up 0.8%. And guys, we also have the numbers from Motor Intelligence in terms of overall EV sales and the EV market share. Remember, Tesla has dominated this market really from the beginning. They created the market and they still own it, but it's down now to 55.1%. Look at Hyundai Kia, underappreciated how their EV sales have grown, and they're doing quite well, actually. Then you have GM, Ford, and Volkswagen. Bottom line is this, guys. This will be the year when we see how much the other guys, and I'm talking about the non-Teslas, can ramp up production and cut into Tesla's market share lead. By the way, with Tesla, Model 3, Model Y, they are 51% of all EV sales in this country. Those are the two Goliaths. You know, they're in charge of EV sales right now.
But Phil, great reporting as always, and yesterday it was amazing how you talked about the Japanese. I was like in awe of them, but I do think that maybe you are right. We bear down on Ford and trucks. They seem to be doubling down on what they're great at, which means they're making it so that they're going to make a lot more money than we think.
I agree, Jim. And here's the thing. When you talk with Ford dealers, it's not like people are saying, I don't want the F-150. F-150 still dominates sales. It is the best-selling vehicle in this country. Once again, 47 straight years. What you are seeing, Jim, is the discussion with buyers, at least amongst themselves, you know, or with their spouse or whoever, saying, okay, I want an F-150, Carl. Do I buy the ICE model? Do I buy the hybrid? Maybe I buy the EV, although for some that's still a bridge too far. The hybrid is hot right now with the F-150 because people are saying, I want greater fuel economy, Carl, but I still want the F-150, and that's what you're seeing.
Very exciting. I also know, let me just ask you, I know we've got a close to cutaway, but I don't care about that. It doesn't matter that Ford is winning in a country like Australia, where they compete against the Chinese when it comes to trucks. Does that matter?
Well, look, you could make an argument that it's a relatively small market. I would make the counter argument. Where were they just 10, 15 years ago in Australia? I mean, they used to be the main sponsor of the Australian Open. They were a big deal there. That faded away. Now they're number one. That says something about the strength that they have over there that they're trying to build in Southeast Asia.
Fantastic.
Well, I found out one thing. Good morning, everybody.
Which I know Phil mentioned last night. Third consecutive year, the U.S. consumers spent $500 billion on new cars.
on used cars. Ford, do you know that most of the work that comes on these EV trucks, the F-150, is made in 70%, 80% of them are made in Mexico and China? Tesla, just the opposite. All the Cybertrucks are made in America. So they're going to pump Ford, and it is down. This guy's a pumper when it comes to government motors. We could probably take half of this here breakout at a 50% pullback right there on the fibbies. If I took it right there and brought it down to there, actually the body, let's redo that and do it to the body because we're kind of shortcutting ourselves. $11.53. We got some big buys coming in here. 5,000 shares. Someone just bought 10 grand at least. They got it at 11 bucks. 11.75. Yeah. 100,000 shares between 11.71 and 11.70. Then you got 100,000 here at 74 and 75. And they want to get out at 77 for now. Tape reading used to be my masterpiece. I don't use it as much as I used to now. I use chart patterns and trend lines, but pull back to the 68. I'm not going to. 2 million vehicles in 2023. Ford sales rise 7.1% to nearly 2 million vehicles in 2023. That was, shit, today. The CEO came out and said that they've had too many recalls and he was going to put a stop to it. And they just got another recall here just lately on a bolt that was hooked up to the, if I can remember, due to rear axle hub, a bolt issue. So that's a serious situation right there. And that's on the F-150. Due to concerns of the rear axle hub, bolt may break. The National Highway Traffic Safety Administration put a stop to that. So I'm not too interested in, I'd buy it maybe at a cheaper price. What time is it? 11:20 free. So we got Mara. We'll see if it wants to break these moving averages in 200 and squeeze up, but we probably can. I'm looking for that. We hit 20. Now I called 20 bucks and to the penny on Mara. I said 20 or a little bit below. So that would have been a good entry this morning. How did I come up with that number? That's a good question. I'll show you. Fibonacci. If you pull up the daily, we had this peak right here, and I did a video on it. And if you go to the top of that wick, right there, put your little price line there, it's 1990. And I had a support level here at 1930. So anywhere in that channel, you would probably squeeze to the upside. And then this morning we hit 20. Plus, we're respecting the 21 on the daily. When did we hit it? We hit it yesterday. So damn, I wish I'd have saw that yesterday morning. Tesla's respecting that 1-2 Fribus on the inverse head and shoulders. We break the 200, we'll shoot up to 244. Let's make it 240.84. That's a buck 80. Then we got Amazon taking a knife. Jim Cramer Investors, Twitch tightens grip on sexual content. Really? I thought it was all about sex here with this Biden administration. Having trannies and stuff on here. Hair sniffing. I wonder if they're going to take that off. I'm opposed to hair sniffing. Jeff Bezos bets on Google Challenger using AI to try to uptrend internet search. So I don't know. I don't see anything in here bad about Amazon. Now they're going to have they got a chip. They got the stimulus package coming out, and it's going to be a pumper for the market this year. They made sure it come out in 2024 so we could have a nice little run, but you don't always get what you want. Nile's pulled back pretty hard. We got a 1-2-3 on Nile. I'm using the 1 hour time frame to find these support levels on a 20-day. So anywhere above 820 I think would be a good buy. 820, 811 maybe. Apple got another downgrade today. It really upsets me how CNBC pumped this. And the facts were all there. Lower sales, the Apple Watch banned, and then something to do with the iPad, and I heard this morning. Apple stock gets another downgrade on iPad. And it's neutral from overweight, citing concerns about the evaluation as well as the pressures of the smartphone market. I knew they were pumping this real hard. And it makes me even more mad to where I'd like to see it even go down more, just to bite them in the ass. Maybe 160, but it'll probably bounce off the 200 on the daily time frame. So I'm hitting my first support at 183 and we went below it. So let's put an alert right here above the 200. At 179.78. It respects the 200 quite a bit. And we got Intel. Jimmy called a little pullback on Intel to the 21. Now this has had an irrational exuberance run on hype off the 200 here. We called that out. Boom, baby. AMD 130.59. We're on the 21. Here we go. That was fast. Right out of the gate, we had the pop. We got a hammer on the SPY. Pull up your platform, trading platforms. I'd like to get my SPY trade out of the way first thing. That's the best time to trade it. And I'm looking at PLTR all the way to the March 17th. I'll be looking at it here in a little bit. So watch the SPY. Where's that? There we go. Get my other platform up. This is what I call the beach trade. The $18, oh, that's PLTR. All right, that's a nice nosedive on PLTR for March 15. And SPY, the 5th, January 5th, the 470 strike. You got a hammer, right it open. We're going to hit the 50, pull back and hit the 9, or jump up and hit this triple top. There we go, baby. Bam. Get out. Once we hit the 200, now we've had a pretty hard sell-off, and I'm using the 3-day rule. This is the 470 strike, so I'm off to the beach. We hit the 200. We got 3 white soldiers. We got 2 hammers, so I think we're going to have a lead out breakout today. We got to wait for the pullback. Maybe if it respects the 9, and it might just go ahead and bounce off the 50. So put your SPY on the VWAP. Use it as a resistance level to break. And we broke it, so come back to support and be at the bottom of that candle. We got an alert on PayPal. Oh man, PayPal's cheap. Now I can pull up my Trend Spider, see if I get any alerts on it. CVS are pumping. I gotta check it out, see what's going on with it. So we're at the VWAP. We're going to retest the triple here, double top on the 200 SMA. We got 3 white soldiers out of the gate, so this is very bullish for now. Should have grabbed it right there, but I did not. I was too late. Oh God, they got Kramer in here.
That is not. I happen to know the numbers for margarita.
You know the
That's
spirits
a real
business.
good business.
Yeah.
Food, not so good. Margarita, whoa. And he's the largest seller. He's also delightful. I'll ask you all.
I've had enough of you. We got 3 black crows on the IWM. QQQ's kind of oversold. And we're getting ready to, we're just squeezing out of the SPY right now. Still bullish as long as we stay above the VWAP. And if not, support's going to be right here. I'd rather catch it at that lower support level. I'll take that candle and run it up right there. And I'll set an alert above that trend line. This is going to be it here. It's going to break out or have a sharp pullback. And I'm not in the trade yet. Where's my 9? I don't have the 9 on here. Got to put the 9. That's better. That even applies pressure to the VWAP. So let's see what we got here. 125. In at 125. I don't really want to listen to Kramer rate yet. He's too much of a fast talker. I think we're going to break out. There we go. Let's see if we can get 150 out of this. To the top of the, once we break out of the 200, if we break out of here, there we go. Bam, baby. Here he is on Apple.
Including President Xi, who I think has very little knowledge of what's going on in his own
There's
country.
actually a really thick 50-page report today on Apple's reshoring process, where they think I think it's Cowan, they're just getting started in moving the chain out of China.
I don't want them to move it here. I want them to move it to India because that is the country of the future, and they're
Oh,
trying.
you dummy.
their supply chain is perhaps the most complex.
India is a
supply chain.
very
So you always hear these people
heavy
say,
populated
"Look, we just got
area.
this word from
That's
the
what
supply
he's
chain, it's not
thinking
doing
about.
well." They know much more than that.
What's interesting is to watch the Dow sort of shake
The
off
Indian
the
people are very
Walgreens
smart.
effect.
Yes. Yes. Well, you've got Merck. I mean, is there a day? Bob Davis is doing an amazing job at Merck. And again, a parabolic move, but he's doing a fantastic job. And we got to hand it to him. And he's getting away from just Keytruda. I think he's terrific, remarkable. He's got new drugs. So, I mean, Merck is a real driver in, Pfizer's an active lead. Merck's a real driver. What I think is so interesting is you've got Pat Gelsinger with a giant position in Mobileye, and 88%. The stock's only down to 85 cents. People are
Okay, we got a hold right
this
here.
PC refresh that's coming from Microsoft, and some people it's starting to dawn on people. Well, wait a second. If there's a button that they're going to put on, I'm going to have to buy that PC. I think that HP Inc. being only up 2 cents is kind of ridiculous, given the fact that they're probably. I mean, if we called Enrico Loris right now, then I'm waiting. Please call Enrico Loris Siri Meta. Yep. But that's the principal beneficiary. Sells at 8 times earnings. Kind of interesting.
Well, Dell is really not that far from all-time highs.
Yeah, well, Dell's got a complex, really complex, terrific set of order books that includes much more enterprise, and I really, really love Dell. I'm a big fan of Michael Dell. I think he's fantastic.
We've paid a lot of attention to transports. XPO gets an upgrade today over at Wells. They go to overweight.
It's been the winner. And Old Dominion's been okay, too.
And I think Citi, too, makes FedEx a top pick for the year.
Well, FedEx, we have to recognize, just missed. I mean, let's give it a little breathing room. I mean, it did miss. It just shows the love affair. And
This is an ascending triangle,
Adobe numbers this morning
so it's very bullish
online commerce,
pattern.
Which is just showing no end whatsoever. And that's Amazon. By the way, Amazon, how much is it down today? I'm waiting. Some of these guys, someone's going to break ranks and downgrade Amazon. And they will be wrong, but they will downgrade Amazon. And I say they'll be wrong because if I'm going to have to pay $3 not to have commercials, well, bring it on. I'll pay $3.
Amazon back to the 50-day for the first time since, let's say, early November.
This is Andy Jassy's chance to be able to line up with Lilly and get that healthcare system going where you get a big break with Prime. This is his chance, and I'm not sure Andy's watching. He's a tremendous guy. But if you want to get back into this game, well, he is in the game. But Amazon is the way that you might want to get the Lilly drugs.
There has been some work this week done on what ads may do on Prime to revenue, maybe as much as $5 billion a year. And then there's a piece in JPM this morning, Doug Emwith, on Netflix, arguing that paid share is a dynamic that's going to last several quarters.
Well, it turned out that they were brilliant again. I mean, Netflix. Remember when Reed Hastings, became not the operating guy, and people said, well, who are these new guys? These new guys are just as good. And I have to hand it to Sarandos. He's amazing.
Netflix, don't take his advice here.
You saw the journal piece this week on how
it's way overpriced.
And churn are up, right, as the streaming bills mount.
Well, there is a problem with streaming bills. They are big, but I think that if you
they're raising rates,
then we're talking. Netflix is still, hey guys, did you watch apps? And the answer is no, then you're excluded from all conversations until you get to Apple Plus, and that's, Tim Cook doesn't know what he's doing. Forget slow horses, forget what he's got going. People talk about this stuff. People talk about Netflix.
Yes.
So it's very hard to not have Netflix. Let's cancel other things. Well, let's not cancel Netflix.
Back to 4,700 here, Jim. I saw some technicians last night, Mark Newton's a good example, arguing that if you could hold 46.65, maybe this begins to revert back to the upside in the coming days.
I do think that the S&P is okay. I just don't want
137. We break out of here, baby. We're off to the races right now.
For the S&P, because the S&P.
You could get out of the trade. It's an exit idea, but this is a bullish flag.
If Home Depot, if we do have a more normal economy, you should be buying Home Depot.
Jimmy wants 150. If we hit the top of this, I think I'm going to get it. Now, we're busting out. Watch the tape. People are buying in here. Now, when I'm up like $30, $40 a contract, I'm going to take profit. That's a bear flag right there. We're going to see if we can build that wick back up. If not, then we'll have what you call a shooting star or an inverted hammer. And if you look at the 5 minute, we probably have a tweezer bottom. Yep, tweezer bottom right here. So that's bullish indicator. That's a long leg doji, which we have indecisiveness. Boom. So when I say take profit, it's pretty good advice. The VWAP starting to squeeze to the 200, and we're still respecting the 9 all morning. As long as we respect the 9, we stay in the trade. But you can get a real sharp knife. So, you know, like I said, it's good to take profit when you can. I'm going to take it here. Get just a little bit of bounce. That 200 is one of your best indicators. Set an alert on Netflix at 44571. I do believe we'll pull back. I don't listen to their pumps. So this is called a squeeze. We got to hold this support level, and then we're going to come up maybe for the third time and break out. Now this is now a rising wedge just by very little. So we're still bullish as long as you stay above the VWAP in this trend line. If not, it could be a nice little double bottom down here. And that's where I'd probably jump back into this trade. Don't forget, we got these 3 soldiers here, and that's a real nice breakout. Okay, get ready. I've got 2 trades out of the way, so I'm going to kind of do my homework and walk around a little bit. Keep this here open just in case we break the 200. Meta, Apple, NVIDIA. What you doing? NVIDIA's at support. AMD's at support on the 20-day, and we broke support on Apple, which I knew that would do that. And once we hit 180, that's my second support. 183 was my first one. Good morning. What's up about that? Yeah. Yeah. Yep. Yeah.
In 45 years. We'll get stopped trading the Jim in a minute.
Or you by yourself, you're not around anybody. Talking with us. Did they leave? Yeah, this could be bad. Yeah. Well, he's dumber than fuck. Cody is. Yeah. Well, he's got money now. He's been working. Yeah, so probably when he gets his first check, he'll probably quit. Yeah. He hasn't answered his phone. I messaged him for years now. I messaged back. Messaged him twice. He's got two phones.
I called him yesterday and I called him today.
Okay.
And I gave the phone number that he gave me to the police.
Okay. Don't feel guilty. Don't feel bad. Okay? Don't feel bad. Just try to not think about it for right now, and I'll call you later.
Yeah, the police tell me he just needs to question him on a case he's working.
It's probably they're not going to tell you everything. They don't want you to hit him. Give him any.
They know I probably just called him.
Yeah, they probably already know that too. Okay, well, let me call you here in a little bit. Right now, I'm very busy.
Okay.
Just be easy on your head. And we'll talk later.
Okay.
Okay, Jimmy loves you. Bye.
Bye.
Humanly possible.
Let's get to Jim and stop trading.
You are going to see sporadic stands being made by Mag 7, but one of the non-Mag 7 stocks that was really terrific last year was Boeing. And Boeing has now pulled back nicely. And I think this Deutsche Bank piece today, still early cycle. Those of us who have followed Boeing for the last 30 years know that when they get the cycle going, it's not a one-year thing. It's 4 or 5 years. So there's a stock that's come down that I think you can say, you know what, that's a buyable. Not going to get a downgrade, Boeing. You're going to get many people saying upgrade or that you should buy. Versus, say, Apple, where you're just like come in every day and it's like, hit me again. You're hitting on a 19 with that one.
Yeah, Deutsche names both Boeing.
They're calling out all the pullbacks of good stocks. Boeing's one of them that I'd like to trade. So I'll look at it here in a second. But right now we've had another 3 white soldiers. We have 3 white soldiers pulled back to the trend line as counted. This thing's going to run for the rest of the day. We only disrespected the 9 for just 2 candles, 3 candles, 3 minutes. This one's respecting it because we bounced above it. So, I've been talking about how to trade off the 9 on any time frame. And when you're scalping the SPY, you need to use the 1 minute And I'm going to start using the 5 minute. And you got the I got the 3 minute on here also. Now, if you look at the 3 minute, we respected the SPY all the way. We got this big lead out candle, which is good. And every one of these candles is bullish, especially this one right here. This is called a dragonfly doji. It's almost like a hammer, or it could be a morning star. Each one of these candles represent a reason why you want to stay in the trade. When you have the bigger wicks on the bottom, this one's the only scary one right here, and that's expected once you break resistance. So if you're in this trade right now and we got our 150, no, we're at 140. I would take some profit off the table. I already got out at 140, but I'm just saying, if you're in this trade still, it's time to do. Natural gas, we're going to start getting some snow, so you might be see a little bump and get natural gas. We've had a real warm summer, so it'll be short-lived. Tesla. I got my beach trades out of the way, so I'm done. I can go home. We got a symmetrical flag on Tesla right now. We're at the V. What the heck? That's a 51. This is the 5 minute. We got an inverse head and shoulders. So we'll see if we can create a right shoulder here. And Boeing. They have had a nice pullback on Boeing. So we're going to pull up the daily. Now you look at I just have to overemphasize how big of a run we had off the bottom once pow. This is all assumption that they were going to lower a lot of interest rates. Now, during the minutes yesterday, it didn't sound like it was going to be so like that. The biggest run I've seen in the 20 years I've sat here behind this desk, in a quarter, 2-month period, and it was scary. And I think reality's starting to hit some of these traders in the face. This thing can drop a lot more. I hate to put a Fibonacci all the way down here, because you're looking at 50% pullback at 222. We could have a third, but we're going to use this previous top as a support level, and I'm going to bring it up to the wick. Now I'm going to go to the 20-day and see what kind of run we've had on the 20-day. So I'm going to put the Fibby right there is at 50% pullback. Then you got your 61. So actually we're at a solid support on the 20-day. We've got a falling wedge. We're on the 200. So yeah, this is on the 1 hour time frame. So this is definitely a solid support. We've got two wedges here. This is Mike mentioned the other day how much he'd really love this here chart pattern, candlestick pattern. It's called what? Hainki Hashi. So that's the one I'm using, and it follows your trend. And this could be the first breakout. Now we got the 9 right here. So if we break out the 9 on the 1 hour, we could have a nice little run up to the 21. And we're below where the money is. Jimmy said we're bullish on the SPY. So we hit that top band of the third VWAP. If this breaks, we're off to the moon to 469.88. That's 40 more cents. There's my 150. This is really good bullish, really bullish start this morning. Nvidia's held support, but I'm not in that camp yet. They're trying to rotate out of tech until earnings come out. Mara, we're at resistance on Mara. Riot broke out. Mister, keep an eye on MSTR. And coin is at resistance right now. We got a triple top on coin. So we got a double top here on Mara. So let's see if we have a pullback here. And same thing here. We could go up to on Mr. 655 if we break this resistance here at 649. We've got a 1, 2, 3 here on coin. Coin's at resistance right now, and we broke out on Riot. Randy, did you trade it? The SPX is now at the 200. Randy. So FSR, I've been following FSR for years. So we got a trend line right here. I'm going to tell you, I think we can hold the 143. It's very important we hold this inverse head and shoulders. And then you'll find resistance at two different levels, 165 and 180. Boeing's getting pumped on CNBC, it is at a good spot. We've got a gap. Resistance to break. Let's go with the top of the wedge. If we break the 200, that could be a good catalyst to run this on up. If it pulls back, set you an alert off this previous high right here. Now what time frame we got? 5 minute. So I'm gonna do 2 checks. I'm gonna put a trend line here on the 5 minute. I'm using the body of that candle, and we got a nice breakout on this thing. This is just so confusing right in here. So I just kind of have to say it's going to be right there because that wick and this body, and it runs right into the trend line. So that's a triple confirmation that just a little above 250 is where I'd probably exit the trade. And I'd get in it right here off this wick. Or off the 9, just how much it's respected the 9. So let's move that up to the 9. Yeah, I'll tell you what, Jimmy's got his underarm stinking this morning. I worked my butt off yesterday, or this morning. I need more people to get on mic with Bobo. Some excellent traders that really want to have their voice heard. It was refreshing to have Linzoid on here yesterday. I traded with Vegas for 5 freaking years on mic. Then I traded with another chick for 3. Then another one for 2. I always like trading with women because they have a different value and a different perspective. And I disapprove trannies in competition with women in sports. And I disapprove urinals in the women's restroom. What do you think about that, YouTube? FSR, I'm not interested in yet, but Rivian, and that had the bad news, so I don't know. It seems to me, now I could be wrong, and I've seen it before, through the internet bubble, through the cannabis bubble, through the Bitcoin penny plays bubble, to now we're going to see the AI bubble, that you'll have a bunch of people mention the word AI. You could have like a BTBT mention AI, or just a penny stock, 0.001. Oh, we're getting into AI. And all of a sudden you'll have a big bounce. But you got to find which ones are the best and go with them, because there's only a few of them that are going to stand out in the long run. And that's true with the cannabis sector, the Bitcoin sector, the any kind of event that because you're always going to have something pushing the market up, and now it's AI. Next, who knows what it'll be? You know, cloud was one. Everybody was in the cloud, so all the stocks ran and tanked, but a few of them kept running. And we're going to go through my watch list here and see the daily losers. XP, Rivian, so you know that tells me that the smaller companies ain't going to be Baba. Baba's had a good run. You put a 50% Fibonacci on the Baba and set an alert on the 20-day. There we go. Every time, I'm telling you, every time you pull back, it's at 50%. CYTK just not doing me any good. Amazon's down 1.3%. This hit my support level on Amazon. We had 3 black crows with a hammer on the bottom. That's a strong buy signal. If I'd have caught that, I'd been on it. We now hit the 200, so we're going to pull back, and we got a triple top break right here. We're going to set an alert off that triple top. And we're about there already. Look at that, big knife all of a sudden. We've got an inverse head and shoulders right here. So if it does decide to pull back stronger, it'll definitely stop at the inverse head and shoulders. There's both the coons.
Their specialty drug division, Shields, assigned more than 24 insurers to provide support services for gene therapies to make sure that patients take those drugs properly and get the full benefit of the drug. You can watch that full interview with Tim Wentworth on CNBC.com.
It's not just a near-term problem for Walgreens. If you
Cool,
look at the
look.
performance in the last few years, Roz Brewer had to step down after just a few years on the job. What is the issue here, say, versus rival CVS, who's outperformed them by a wide margin?
Well, CVS has more parts, right, in the sense that Walgreens, under Roz, tried to build up their services. You can't just be a store. You can't just be the back of the store pharmacy. So they bought up all these companies to offer services with, investing in VillageMD, the Shields Pharmacy. At CVS, they have other parts. They also
Now they are pumping CVS, and that could run over Walgreens. But we have us a snake here, and we're going to draw this out and try to anticipate a trade off this today. This is a great example of so we had to break out. Now we got a 1, 2, 3 right here, so we've already had our wedge. I don't know if I want to trade, but this knife is very attractive. So if we pull back to this support level, I might take the trade. And I'll set that alert. And that's going to pull back right to the top of that snake. And that's what we're looking for. So set an alert right there. I talked about CVS yesterday. And they've been pumping the heck out of this one. CVS to cover. And Eli Lilly might be putting out that some kind of weight drug on the shelf instead of behind the shelf. Some kind of weight drug. In America, what? It's not. People eat too well on food stamps. Dr. Kavita Patel, Eli Lilly's direct-to-consumer portal, will help patients get medication faster. Jimmy called out Weight Watchers a couple of weeks ago. We're getting real close to support on Weight Watchers. This one I'm going to be very attracted to. Yeah, oh yeah. We got a nice little setup here on Weight Watchers. I mean, shit. This is looking real good. PLTR. I'm going long in PLTR this year. Just got to find the perfect entry. I missed it. I should have paid attention to this morning. I'm fired up on PLTR. PLTR stands with Israel. I wouldn't be saying that as a business person. I'm telling you, get involved in politics, and that's what they are. They're most of their contracts come from the government. Okay, Snooty's up. I don't like her. I used to love her, but look at that look. Just snooty. I am a snob. And there's Dr. What's his name?
And pharmacy prescription services direct to consumer shipments of drugs, but they're also offering, for example, access to providers, brick and mortar providers, and so they're looking to offer a more comprehensive solution, which I think is one of the advantages of getting a big player into this kind of a model.
So who gets hurt the most by this?
Well, I'm not sure anyone's going to be immediately hurt. This does reflect, I think, to some degree, the erosion of the traditional PBM selling model and the fact that traditionally pharmaceutical companies have used rebates that they pay to the PBMs to try to drive uptake of their drugs. The PBMs were incentivized to try to drive adoption of drugs because they were being paid those rebates that they were using to then offset other costs, like the cost of premiums for the health insurance plans, or pay them back to the employers that were sponsoring the plan. The employers like to get those dollars that they were fungible dollars that they could use for other services. Now that you see the erosion of those PBM dollars, of that gross versus net spread, it makes more sense for the drug companies.
There's people stuck in Sophie. So I'm going to explain how you trade something like this. A guy lost 45%, and he's posted his things like down $245,000 on Sophie and a few other stocks after yesterday. So there's a lot of hype on Sophie. There's a lot of people that got stuck on Sophie. So when you look at it, when you know that, being in the now, you're going to have what you call dead cat bounce. If you're familiar with a dead cat bounce. But it ain't had time to be dead, but it got slaughtered. So you take your fibbies. Again, we're going to use the fibby on the 5-day. There's going to be people that would come in here big, and then and this is a little bit under 750s where the millionaire gets in there, and I know that for a fact. That's why I called the pullback on it, waiting for that one spot. So eventually you're going to have a nice little bitty breakout on this, maybe. But people want to get back their money. I'm not going to trade it because I got to wait.
Now, do you worry about long-term unknown consequences of these drugs?
Oh, good question.
Well, look, I think as we see broader adoption of these drugs at higher doses, remember the doses used for weight loss are substantially higher than the doses that have traditionally been used for diabetes, upwards of 3 to 4 times the dose. As we see more people using higher doses of these drugs, I think we're going to unmask more side effects associated with them. But we do have a lot of experience with these drugs. They've been on the market as long as the iPhone's been on the market, these GLP-1 agonists. So we do have long-term experience with them, albeit at lower doses. I'm not too worried that we're going to unmask significant unknown side effects that we haven't seen already. I do think on the margins we're going to start to see more things crop up in small percentages. And FDA, in fact, announced in the last 24 hours that they're investigating things like hair loss and some other side effects that seem to be cropping up in some of the reporting back to the agency. We have a good pharmacovigilance system. Lilly does as well. And so they're going to gather these reports of side effects and investigate them pretty aggressively.
Hey, finally, Scott, we mentioned earlier this morning just the wealth of healthcare news right now. You got Lilly, there's some Cigna news. We talked about some upgrades of the likes of Merck, and we got this big JP Morgan conference next week. I just wondered, 30,000 feet, what sorts of narratives you'll be looking to see built in this early part of the year regarding healthcare?
Yeah, look, in addition to just the general innovation narrative, I think we're going to have a lot of data cards that get turned over this year that are going to be quite significant, particularly in new modalities like cell and gene therapy. You're seeing significant dislocation and changes in the selling model. Today's news reflects that. We're going to see legislation targeting the PBMs and those spreads. We're seeing a really rapid deceleration or compression in that gross versus net spread. List prices came down on the whole for the pharmaceutical companies for the first time this year, really in modern history. And so companies are aggressively compressing that market.
He's a good guy to listen to. He's on a couple of boards. I'd take his word for anything, probably. Now, why did I draw that line right there? Okay, it was on the 5-minute. This is interesting. I drew a trend line here for resistance level. One, two, three. That's why. That's why. That's it. That's it. One, two, body of the candle. Always go to that second body. And then count it to 3 with the double bottom. Bingo, bingo. To bingo. Let's take the body right here for support level. I'll set my alert right around 409.22 to catch this to run it back up. Tesla came right back to my support, but didn't trigger it. I mean, Boeing. Dr. Gottlieb. She's a cutie, but she's a snob. I think I got upset with her one time about when they were talking about cannabis. Now what's going on here? JD. JD can pull back to the shoulder line. Well, we got a shoulder there. Yeah, I'm going to set an alert for JD right around 2682. This is China. This is your head. Or it could be right here. Yeah, I'm just doing that because of that pullback, but maybe it could be right there. I'll set 2 alerts. 2620. Oh, I had an alert trigger. Or did I? I didn't read that, what that was. What was that? Tub. TUB. There's no TUB in here. Oh, that's YUB. Dumbass. Huh. PLTR had a nice setup today. This is on the hour time frame. Dr. Gottlieb. Government
A lot in
moves.
there, Sarah, but I'll send things back over to you.
All right, John, thank you very much. Amazon also named a top 2024 pick by a number of firms on Wall Street. Kate Rooney joins us with more on what's ahead for the company this year. Kate, and why analysts are getting more excited about it than some of the others.
Yeah, Sarah, so yesterday alone, we saw 5 Wall Street analysts come out with Amazon as their highest conviction tech name for the year. The tally of those now...
Bullshit. Behind closed doors, we got together, all 6 of us, and decided we're going to pump Amazon this year. It doesn't matter anything. That's what she should be saying.
Growth reaccelerating. Growth had dropped to its lowest level in history in the third quarter. It was 12% down from about 27% a year earlier. Cloud revenue appears to have stabilized, and cloud spending is widely expected to pick up. And then you've got artificial intelligence, big theme there. Raymond James among those, arguing that Amazon is the best positioned and among the best positioned to influence the next commercialization phase, as they call it on the enterprise side of that business. Wells Fargo thinks it could account for 7% of AWS revenues next year. And then you've got operating efficiencies. Wolf points out that you've got shipping inventory placement and then returns that should help gross margins.
It's definitely at a good spot.
The biggest upside, guys, and the surprise there could be advertising. Wolf estimates
3 black
Amazon now
crows
makes up 8%
with a hammer.
global ad markets.
Let's look
and
at
it's
Amazon.
expected to get a boost from things like Prime Video and retail. Bank of America says advertising could add $5 billion to Amazon's top line this year. It trades at a slight discount to the rest of the Magnificent Seven and its peers there. The risks to Amazon includes macro, regulatory, you got competitive e-commerce risks from the likes of Shein and Temu. But Carl, send it back to you. Big pick for the year on Amazon.
Okay, appreciate that. A lot of good information. Let's get a news update as well this morning with our Courtney Reagan. Morning, Court.
Morning, Carl. Welcome back, of course, here to Squawk on the Street. Here's the news update. A funeral underway for the senior Hamas leader who died in an attack in Lebanon on Tuesday. Lebanese media reported the drone strike in Beirut killed 7 people. It is sparking fears of a wider regional conflict as Israel continues its war with Hamas in Gaza. Israel has not confirmed or denied whether it was behind the attack. 4 ports of entry on the southern U.S. border are starting to reopen. They were shut down 1 month ago as Customs and Border Patrol agents dealt with an influx of migrants. They processed a record 300,000 people last month. And the Queen of Denmark took a farewell ride in
America's so screwed up.
carriage for the last time as monarch this morning. Queen Margrethe announced on New Year's Eve she will
I can't believe
abdicate the
they're letting
throne
this
on January
happen.
14th to her oldest son after 52 years. She's Europe's longest reigning monarch. Carl, back over to you.
Thanks very much.
If any, I don't know why people would still want to vote
with
Democrat.
Apple, as yet another Wall Street name downgrades the stock today, and big tech takes it on the chin. Are concerns here overblown? We'll discuss it after a short break.
There are going to be a lot of long-term consequences because of this. I mean, I believe in immigration 100%, but I don't believe in every Dick and Harry should be coming over the border without even being probed. There's too much trash out there. Oh, as long as one good person comes over the border, we don't care about the 5 million that are uneducated. ARK, got to watch ARK here into earnings for a rebound. Oh, she sold Coinbase and Robinhood stock. Roku. She made a significant purchase in Roku. How you doing, Bug?
$85.55.
85.55.
Welcome back to Squawk on the Street. China getting some positive economic
17.21.
data overnight. Let's turn to our Eunice
45.68
with the latest and some positive commentary too on stimulus, Eunice.
Yeah, that's right, Sarah. The data that we saw for the services industry was better than expected. This was for December, but the outlook overall is still subdued.
Okay,
Now, this
let's see if we can get a put here.
So that the PMI posted an expansion of 52.9. This is the fastest since July. Companies reported a pop in new customers and demand. They also said that they were hiring slightly more.
468
an
put.
Increase in business demand. And despite rising costs, they
Back to the
maintained
VWAP.
prices because of market competition. Now, taken as a whole, though, China's data has still been mixed. Even for these PMI numbers that we're getting out for December, they were contradicting each other, both on the services side as well as the manufacturing side. And then on top of that, of course, there are a whole host of other issues that have been weighing on the economy as well as on consumers, falling housing prices, for example, the weak job market. There was a bright spot, travel. Once again, China posted 135 million domestic trips over the three-day New Year break. This was higher by 9.4% from pre-pandemic levels.
They were pumping China this morning, too.
The aviation authority today said that they expect that international flights would reach 80% of pre-COVID levels by the end of this year, with an emphasis, they said, on what they hope to be a significant increase in direct flights with the U.S.
Eunice, that's important news. We've been talking about opening up trans-Pacific traffic for a while. Obviously, big implications for some big American exporters, which have already had some signs of success in delivering airplanes to China.
Yeah, that's right. And you see that the authorities here are trying to address some of the challenges, not only with the flights, trying to increase flights, but they also just announced that as of January 1st, they were going to make the visa regulation process much more simple, specifically for American tourists. So you could see that there's an effort on the part of the authorities here to try to create that bridge.
Yeah, I mean, I noticed also the finance minister said that they're going to expand fiscal stimulus in the coming year to support demand in the economy. What is the case, Eunice? Because a lot of people want to look at China as a comeback story. Certainly the market got beaten up in 2023. What is the case, and how are people feeling about the prospects for a rebound?
Well, I think that comment that the finance minister had made to the People's Daily, the Communist Party paper, was saying that, as you said, that fiscal spending would be increased this year. I think what's important, though, is that he didn't really say by how much. There weren't a lot of details. There wasn't anything that would indicate as to whether or not this would be a significant move. And that's the big question, because we haven't really seen a whole lot of movement in terms of policy that would really address some of the fundamental problems in this economy.
All right, Eunice, thank you very much. Eunice Yoon, live for us in Beijing. Still ahead, Verizon shares in the green as the stock gets upgraded to buy. The analyst behind the call joins us to make the case and tell us how much higher the stock can go from here. Dow's up 178. Tech is lagging.
We got one
again
bit, two
today,
bits.
as we have seen for all of 2024 so far. We'll be right back.
I'm set a real tight stop on the SPY here, just in case. I'll be right back. I'm gonna go turn on my water. I wish Sarah wasn't on this morning. I mean, I had high hopes for that girl. Baba. Google. Yep, there it goes. Got to get out of it.
Welcome back to Squawk on the Street. Verizon shares continuing to move higher following a second analyst upgrade this week. Wolf Research's Peter Supino upgrading the stock to outperform with a $46 price target. And he joins us now. What is there to be excited about for Verizon right now, Peter, beyond the high dividend yield?
Morning. Yeah, thanks for having me. The funny thing about telecom businesses is the narrative is never any good. Everybody has a phone. The industry seems saturated. All the carriers look the same. Cable companies are now selling mobile, but beneath that, the big three telecoms are all solid businesses. Verizon in particular has been refreshed by new management, and they're growing by selling more to the customers they have. So with all the 5G money spent, we think now just paying down debt can drive the stock nicely higher.
Why has it been such a laggard? I mean, you mentioned some of the reasons, but AT&T, Verizon, it just feels like this industry's past growth.
Oh, come on, Snooty.
Yeah, the industry is really saturated. As I said, everybody's got a phone. There are a few drivers, though, that are still enabling volume growth, leaving aside pricing and mixed games. One of those is that younger and younger kids are getting phones. There are 4 million humans at every age level in the United States. And I know from raising teenagers that my oldest kid got a phone when she was 13 and my youngest got one when he was 11. And that trend is going to play out for a while longer. Small businesses are also adding lines, enterprises adding lines for people as they want to separate work and personal. But these companies can also take price. All three of the big carriers increased their prices last year. But then to your point about the what has been wrong, over the last few years, the telecoms have had to absorb a huge incursion by the cable industry, and that's pretty well played out. I think we know what the cable companies are capable
Let's
of.
get out of this thing. I got in at 82
Meantime, I
now.
love your bit about falling capital intensity, especially at a time where the street's really paying attention to corporate capex for the year. Explain why that's happening.
The 5G network upgrades cost over $150 billion for Big Three. That's the sum of spectrum investments and also the antennas and computers to support and make that spectrum useful. That spending is almost all done. The spectrum was bought years ago. The radio access networks are 3/4 of the way deployed. That'll be ongoing through 2025. And so CapEx is falling from peak levels down towards trough levels in what we think would be 25 and 26 fiscal years. And that enables these companies to generate more cash, pay down debt, and the multiples are so low. I mean, Verizon trades just higher than the average European telecom company. In Europe, telecom conditions are much tougher than the United States. And so you just hold the multiple and pay down debt, the equity naturally floats higher, and the 6.5% dividend yields are juicy.
All right, Peter, thank you for joining us to discuss the call.
Thank
Verizon
you.
to 46. Appreciate it.
Let's turn to the Mag 7 here. Stocks on the longest consecutive decline in over a month. And of course, shares of Apple.
See, this gets me. I was listening to a video this morning about Tesla, General Motors, and Ford. So Ford F-150, most of them are made outside of the USA. So the unions are slacking a little bit there. They want to go after Elon because his cars, a lot of them are made here in the country. So I just read a headline here just now. Senators asked Tesla CEO Elon Musk, 12 other automakers to commit to neutrality in the unionization drives at the U.S. plants. So eventually, he's going to get strong-armed by the federal government. And I don't know if, I do believe that Tesla can surpass that, but it's going to be a tough road. They're going to be bullied. I'm still in my put here. I'm about ready to see if we don't hold this. This is a very bullish flag, so I'm taking a big risk. If I get a knife back down here, I haven't, well, yeah, I don't have my 1, 2, 3 unless I do that. Then I have my 1, 2, 3. Now I've got my only 2 up here, not even 2 yet. I got to have 2 bodies on that, a triangle, and maybe. So it's still in bullish pattern here. Unless we get a little correction real fast. Still ain't touched that trend line yet. I need a body to hit that trend line. And then I start getting real nervous.
Hold up. I think it's too early to make a call that, iPhone is kind of done for the year.
What is the upshot, Krish, of your proprietary data on reshoring and manufacturing? Is Apple less vulnerable to geopolitical tensions and worsening relationship between the U.S. and China?
So, Sarah, the 2 things I would say is that, like I said earlier on, we're still in the early stages of the reshoring. So it's going to take a while. It's not going to happen overnight. But obviously, diversification is good for the supply chain, good for Apple because of, you don't have to worry about geopolitics, etc. The second thing I would also say is that, we bring the example of TSM. Pre-pandemic, TSM actually had a higher valuation or traded a higher multiple compared to the last few years because as more China-Taiwan concerns kind of came to the forefront, the stock kind of got a discount. So I would say that over time, we can see a scenario where Apple stock gets a premium multiple as they have more diversification away from China. Like I said, I don't think it's ever going to become completely immune from China or any of the Asia supply chain, but at least the diversification helps. And I think it can help long term with the valuation too.
We'll see. Obviously, a monumental task that the company faces in the years ahead. Krish, good advice on an important name. Thanks. Good to talk to you. Krish.
Thank you.
Still to come this morning, what do Microsoft, ExxonMobil, Apple, JP Morgan, and J&J all have in common? They are, quote, super payers. More on what's ahead for some of those names and other dividend-paying stocks in 24 when we're back in a moment.
Let's hope it does make a bearish flag. Because right now it's not looking too good. Oh yeah, bearish flag now. Let's disrespect the 9, yes, please. Wubbits, Tubus, and a 3B down here. One more crow, and then we get out of the trade. We got inverse head and shoulders here too, at that support line. And that is the 200, am I right? No, it's the 65, and I got that in the wrong color. Oh, that's yellow. Let's make it bigger. That's what the problem is. It could have an exit idea here off the 50, but let's see if we can get one more candle. This is real strong right though. The 2 candle drop. Mirror's got a 1, 2, 3.
After a record-breaking year for dividend payouts and a less strong one for buybacks, it's a murky picture for 2024, so says Bob Bassani, with more on what we should be watching when it comes to return of cash.
And we're finally got the numbers in for 2024. They're not complete yet, but enough to give us a good idea. So the good news, Sarah mentioned, record payouts this year. I'm talking about the dollar amount, $588 billion. That's an increase of maybe 4.5% over 2023. Buybacks had a real pullback there. Do you see that? Down 15% year over year. And that's because of the banking crisis. Banks were big buyback people. They stopped doing that. And that's why you see the numbers down here. Here's the difference between why Wall Street loves buybacks. You can pull them away immediately and nobody yells about it, but you can't pull dividends back. Once you put out a dividend, people get very used to it and they scream if you try to pull it back here. The yield on the S&P 500 is about 1.5%. If you'll notice, that's fairly low. It's been low in the last few years. And the reason it's been low is because, number one, fewer companies are paying dividends. Only 80% of the S&P pays a dividend. And prices have been going up faster than the dividends have been increasing. So your dividends been going down a little bit. People always ask me who pays the most dividends here. It's more about the overall yields that they're talking about. But here's the biggest in terms of dollar amounts. Microsoft, Exxon, Apple, JP Morgan, Johnson & Johnson, Verizon is number 6 here. There are some that are very famous for dividends. People buy them for their dividend yield. Exxon is a good example. Johnson & Johnson is the classic example. Verizon is another classic example. You see they have high yields, and a lot of people own them specifically for that reason. In terms of buybacks, here's the companies that are the biggest buybacks, and this has been very stable for years in terms of dollar amounts. Apple, Alphabet, Meta, Microsoft, Exxon, biggest buybacks, and this has been going on for years. Apple has been reducing its share count for a number of years. As far what I think is going to happen in 2024, a lot's going to depend. It's all about cash flow, essentially, at this point. So we could have a pullback on the consumer. We could have a change in the corporate tax structure. We could have some shift in government spending. That could affect things. But here's the most important thing. I put this up every year because S&P puts out every year average annual total return on the S&P going back to 1926. The average return is 10.4%. But here's the most important thing. As a percentage of the total return, the price is only 62%. Reinvested dividends is 38% of the total return. This is the most critical thing to understand about long-term investing. It's the power of compounding interest. You can say, I don't care about 2% interest. I want to make 40% trading Microsoft. But 2% reinvested over many, many years compounds dramatically, and you can see it is a critical component of overall growth. So if you really want to grow your wealth in the stock market, keep the dividends, look for decent dividend stocks, but overall reinvest the dividends and they grow. And you know this, we've talked about this for so many years, Carl. The power of compounding interest is the simplest thing to understand, but a lot of people don't really act on it. And it takes patience. You have to just sit there and watch your money grow.
Kind of good
That's
for a
great
squeeze.
idea. It's terrific.
Which is why when dividends get slashed, like we get today, and one example,
Right.
it's so explosive.
Walgreens is a great example of why you don't buy high dividend yielding stocks. You don't go look at, oh, let's get the list of the highest dividend yielding stocks on the S&P and let's buy them. Some people will mindlessly say this. Walgreens had declining cash flow for many, many years.
Still
It has been
gonna-
known amongst investors.
We're still
We know
going to
about
keep
the
our
problems
hopes
that
up for the
Walgreens had.
VWAP
The price
on
has
the
been
SPY.
slashed in half. It was $40 a year and a half ago. It goes down to $20, and yet the dividend, what was it, 48 cents, was essentially the same, 46 to 48. So when the price gets cut in half and the dividend's the same, the yield goes through the roof. But you don't buy it for that reason. You buy companies like Johnson & Johnson that slowly keep increasing their dividends with steady cash flow. That's 101 investing.
Love that. Bob Hassani, lessons on investing. Thank you very much.
Pleasure to see you.
You too. Our live market coverage continues. Nasdaq's coming back a little. About to go positive here. Join the S&P and the Dow. We'll be right back.
Earnings come out on the 23rd for Johnson & Johnson before the Eastern Standard Time. Earnings conference. Hi. Hey little girl, what is going on? We're back to 85. Drop to the VWAP. Hello, retail traders on YouTube. Is anybody stuck in a stock on YouTube? Questions asked. Boom! Oh, I thought we were going to drop there. Dadgummit. So they're pumping Verizon. That's been a tough one to trade for me. I always think it's a great stock, and it had such a hard pullback all year long. I really thought it was a good one. But now we're at resistance levels. We're still bearish here on the SPY by my indicator, ready, set, go.
Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, former Barclays CEO Bob Diamond here with us, why he says the street is pricing in too many rate cuts from the Fed this year.
Plus, UBS says the AI hype is far from over, and it'll be a $420 billion market in the next few years. We'll talk about who stands to benefit.
And the technical take, will the Mag 7 become the Lag 7, or do the charts say the sell-off is a blip in the road? But first up, let's check in on the markets right now. Things are better than they looked, say, yesterday in the last few days. We lost the Santa Claus rally, by the way, that final 5 trading days of the year and first 2 in terms of returns, negative. S&P right now is up 0.25%. What's working? Well, financials are doing well today. Healthcare, industrials, utilities.
I don't think I've ever seen a really successful Santa Claus rally since I've been trading. We had the run was overwhelming to even think about Santa. Sarah.
In 2024, that's 6 cuts, but our next guest says that may be too ambitious. Joining us now is Atlas Merchant Capital founding partner and CEO, and former Barclays CEO, Bob Diamond. I do wonder if that's what this weakness to start the year is all about, just a rethink of how many cuts we'll actually get.
I think the market's ahead of itself, as you said, Sarah. I think the economic numbers are pretty strong. A year ago we had the vast majority of economists calling for a recession, and I think all of us feel that the markets have stayed in balance, both the equity and debt markets. The economy has stayed strong, labor has stayed strong, so it truly has been a good year for the economy. And I think the Fed will be cautious. I think the Fed will be patient. We have to keep in mind that they haven't raised rates for 6 months. It was July was the last rate rise. So I think thinking about this as a pause and that we've seen the peak is realistic. I think the bar for the Fed to actually change course is much higher than the markets are thinking. And if you look at the notes from the Fed meeting, the dot plot they call it, where all the Fed presidents and all the Fed governors kind of opine on their thoughts. Even the most optimistic of them in terms of rate cuts are talking about the end of 2024, not the first half of 2024. So it would take something, I think, that we don't see right now to see rate cuts in the first half of this year. I think the second half is possible.
The flip side of that argument is they should feel pretty good about inflation coming down to target. It's come down a lot faster than they expected. And the fact that we do have a strong economy, they want to preserve that.
Yeah.
And so now with inflation coming down, restrictive rates means rates rise if they do nothing.
Well, and they will be data dependent, as they said. So I think if they feel like they really have a serious target of 2%, which they keep repeating for core PCE, it's been tracking just around 2%, maybe 1.9%. So I think the Fed does feel very good. But again, I would say it's a very high bar. They're going to be patient because the signaling of that first rate cut is going to be very, very strong.
There's the real rate argument. There's also the political argument that the closer you get to an election, do they really want to be cutting in that environment? The argument would be to front load your cuts this year. Why does that not make sense?
I think we all hope that politics stays out of these decisions. The optimist in me says that the politics will stay out. From a market point of view, Carl, as we look back, the
she has a good
see
TV
right
voice.
through the elections. They don't react much. But I think we're starting to hear a lot of worry about, decisions like rate.
Well, truth be told, I wrote a love letter to Sarah once.
$2024.
Listen, higher rates are without question.
She turned me into the FFC.
A very tough period. It was 12 years. And we've definitely seen a pickup in bank earnings both in the U.S. and overseas with higher interest rates and higher deposit rates. And I think, you know, some of the things that were happening during this period, there was, I don't know, 1 to 1.5 trillion of money moved from deposits when it was zero to money market funds. I think that move's kind of over. So I think the deposits moving on, deposits moving into more market-related securities, that's probably run its course. You know, my optimism in financial services over the next year is I think there's going to be some great opportunities to invest in regional and specialist banks. It was last March when we had the failure of SVB. And I think there's going to be some good consolidation opportunities there.
Yeah, that's certainly reflected in some of the calls that we got this morning on names like Truist and I think UBS as well, looking for PEs to revert to pre-pandemic levels in some cases, even an overshoot, as B of A argues. Although, where does that leave us on commercial real estate or unrealized losses, things that we still have in our back pocket in terms of worry?
You know, I think we've been looking at this all year in terms of commercial real estate. When I say all year, I mean 2023. I'm not an expert in commercial real estate, but I think the expectation that commercial real estate is going to be a problem is pretty much in the market and to some extent in the pricing of the banks, unless we see some new data, frankly. But you know, the banks faced a lot of things. Going from 0 to 5.5% interest rates had a big impact on the treasury portfolios. We talked earlier when I was on this show about B of A had a $100 billion loss in their treasury portfolio because of the rise in rates. Every bank had that challenge. Every bank has, you know, some commercial real estate that's going to be challenged. But I think going into 2024, they're in pretty good shape. The banks are clearly safer than they have been.
I hit a couple of keys and got this on my thing.
You know, we're getting more and more concentrated in the
Thinkorswim desktop.
U.S. banks. So the top four.
I don't know what I hit.
50% of the deposits. We saw a report recently where one of the big four banks is
I think it might have,
20% of the profitability of the entire sector. Right. Yeah. So does it benefit anyone to have more concentration, more systemic risk in the big banks? Or, in my mind, you know, we should just really celebrate that the U.S. has 4,000 banks, not 4 banks, as most European countries have. And I think the opportunities for competition for the big banks, for more choice for consumers, is better in the U.S. because of the diversity of the financial services industry. And we're pretty excited about the opportunities with regionals.
Airbnb hit my support yesterday, and I didn't jump on it.
JP Morgan by First Republic?
I don't know enough about how that decision
I talked about it.
And I don't know what other competition there was, although what I hear and other people hear is that there were other banks
QQQ's at 200.
What I would say, Sarah, is in 2008, the U.S. regulators, the Fed, the Treasury, were very, very clear that too big to fail is never going to happen again, the systemic risk.
Bullshit.
And the truth is today, the top 4 banks are bigger, more concentrated.
Exactly.
Do have more systemic risk. I think they're also safer today because of the higher capital rules. And the real implication of that is some of the things that are happening with Michael Barr, for example.
When they did Wall Street reform back in 2008 or 9, I remember paying very close attention to this. And they kept saying, too big to fail. And what they did is they had the banks write up the bill. The big banks, they brought in the biggest banks, and they said they had, and they took their advice and they wrote up the bill off them. They wrote the bill. The big banks wrote the bill, not the government.
Founder and CEO.
Meantime, Eli Lilly's up today following the announcement of this new direct-to-consumer website to access drug
Looks
prescriptions
to me like we're going to break out here and might have to take a loss.
Including its weight loss products. The website's the first of its kind directly from a pharmaceutical company. Joining us with his expectations and outlook for biopharma in 2024 is Evercore ISI's Umar Rafa. Umar, it's great to have you. We've been talking all morning long about how novel this is from Lilly. Can you talk about to what degree it's unique?
Yeah, thanks for having me. Look, we have known that Lilly and many pharma companies have had pricing models out there where some patients can elect to get drug on a basically a cash pay basis, and that price is materially less than what the list price is. For example, in the case of the GLP-1 molecule, patients who are not covered by their insurance, or their insurance, either patients who don't have insurance or their insurance is electing not to cover these GLP-1s, patients can basically get it for half the price, about $550 a month. So those optionalities do exist, and there's co-pay assistance programs. All those things have existed. What Lilly's changing up now, as per this announcement, is there will be a much more direct-to-consumer out there to be able to get it even more directly than the existing method. Last point is, a lot of patients were actually getting these medicines via various med spas, and I think that's one of the practices Lilly and Novo Nordisk are probably trying to cut back on in a meaningful way, because compounded pharmacies that sell some of the GLP-1s and Mounjaro, etc., to med spas, they may not always be the safest options or done in the right way. And I think that's probably the type of market volumes that Lilly and Novo Nordisk are tapping into now.
Interesting. Both Lilly and Novo all-time highs today. I guess at this point, what do you think moves the needle after such a monstrous run in 23 for both?
Look, if you look at the portfolio offering for Eli Lilly, they've never played in the oral GLP-1 space properly. So that's one area where Lilly's going to step in as we head into the next couple of years. Novo Nordisk has had some presence with a suboptimal oral version of these drugs. Lilly has not had it. And I think that's one important direction, because Lilly will start to have phase 3 readouts on their oral version of this GLP-1 starting next year. That's one. Another important area for Lilly, which I don't think gets enough attention, is in due time, Lilly has optionality in their immunology franchise, as well as some emerging trials which could create pretty meaningful optionality in oncology as well. So as much as Lilly is squarely thought of as a GLP-1 story, there are aspects to the story beyond.
So how much is it worth to you?
Look, by my math, I think Lilly, I get to equal weight on Lilly, and my thought process around Lilly is there's a very large amount of expectations on GLP-1 related franchise growth that are baked into the stock. Investors are looking to construct the thesis meaningfully north of the types of $130 billion peak sales estimate across the category. I think sitting here now, given the size of the given the size of the drug pie in US, it's hard to see very material estimate revisions on the GLP-1 franchise alone. As soon as investors are willing and
Right now, we got a double
able
top.
to look at franchises beyond GLP-1, I start to get more excited again and step back in for sources of upside in immunology and oncology.
Finally, big week coming up for healthcare as conference season in the space takes place. Are people talking about news being made? And if so, are they pointing to specific names or threads of news?
You might even get halted here, Florence.
This conference was very big on M&A updates, but that's not necessarily going to be the big theme here, primarily because there's a very high M&A activity in the space in 4Q, especially in December. Several deals.
There's a real hard resistance.
So I don't think M&A will be the big news out of this conference, and I think a lot of the news that would have happened there have sort of played out previously already. So that's how I see it. But yeah.
Interesting. We'll see what we get in the coming week or so. Umar, thank you. Lilly, a huge story today. Umar Rafa joining us on Lilly.
Thank you, guys.
Still to come, Citigroup's global head of commodities, why he's bullish on gold but bearish on energy.
Plus, a number of chip names under some pressure today. We'll get to the news that's dragging some of those stocks down.
Okay, I'm going to show an exit idea.
Returns.
Was anybody in that put with me? Because I took a loss. I'm going to try to figure it out here. Should probably be another big mistake for selling it. I've done that once already this week. Damn, probably did too. Because if I look at the hour, we're definitely close to a resistance. Okay. You hit Control, Alt, and Delete. I think I made a big mistake here selling this. So let me see here. I'm about ready to go have lunch. It's right to my support line, VIX.
Let's turn to Mobileye today, losing a quarter of its value this morning on some news. Let's get to Christina Parts-Nevelos with that story. Morning, Christina.
Good morning, Carl. It's quite the start for the auto chip sector with Mobileye's massive guide down. The autonomous driving systems company expects a 50% drop in revenue for the first quarter of this year because of customer inventory issues. Keep in mind also 30% of Mobileye's business is exposed to China as well, and that's why Bank of America says to expect Q2 all the way through Q4 revenues in aggregate to be flat or up only mid-single digits year over year.
Oh, God.
And that's why Mobileye is having its worst day since going public in October 2022. Its fifth straight days of losses. Look at that sea of red on your screen. The dire warning is bad news for Intel since Intel owns about 88% of Mobileye. Its shares, they're coming back up. They're a lot lower this morning, barely in negative territory now. The news, though, also weighing on auto semis like STM, NXPI, onsemi, analog devices as well. You can see all in the red with STM, the worst performer there.
The
And it really
SPX.
only leaves 3 names positive in the SMH right now. This is the first negative pre-announcement from a chip company in 2024.
I think it could on the 5 minute.
Those names like onsemi and XPI, etc., as they meet with investors at
Yeah.
the Consumer Electronics Show.
I'm gonna get
in
back in
Vegas
this thing
next
again.
week. So we
Make
might see
my
more
money
news
up.
coming out of that next week.
All right. Good morning there. Thank you, Christina. Christina,
Good
Portillo.
eye there,
Let's get the outlook for commodities.
Lindsay.
This year. Our next guest is leaning neutral to bearish on oil and gas, finding value in precious metals and bracing for substantial deterioration in developed economies in the year ahead. Joining us now is Max Layton. He is Citigroup's global head of commodities research. Max, it's good to have you. Just on energy and oil, why is everyone feeling so bearish, and why is the price action so bearish in the face of what appear to be rising geopolitical threats that center on Iran, which is such a major oil producer?
Sure, yeah, and thanks for having me. The market obviously has come off over the last 3 months by around $15, generally for oil price for Brent and TI. And, you know, balances have weakened. The market was...
We've got a gravestone
not sure whether
candlestick
OPEC Plus would deliver and extend...
on the SPX on the 5 minute.
About the delivery of those
That might
cuts,
turn into an inverted hammer.
well OPEC will, how committed, well not how committed, I mean OPEC's very committed to the cuts, but whether or not people actually adhere to the quotas and adhere to the cuts, and there's a lot of doubt about that. Positioning as a result, cross-speculative positioning and probably physical positioning has come off substantially. And so we think there's a relatively small risk premium in the market for the Middle East supply risks, which has really only come in over the last 2 or 3 days. And overall, the market's roughly correctly priced for the first quarter for a finely balanced market.
Do you think there should be a bigger risk premium, though, for the Middle East? I guess is what I'm getting at.
Yeah, of course. I mean, I think I think it's about right for where we are. I mean, there's obviously a material, like non-zero risk that the situation in the Middle East gets worse and either outright impacts supply or drives a higher risk premium. But I think, yeah, it's difficult to call whether or not the market pays for that premium in the face of what is a pretty sizable second quarter surplus, absent the OPEC rolling forward those cuts through the second quarter. We've got like 1 million barrel surplus in the second quarter, so even if OPEC Plus rolled their cuts through the second quarter, you would still have a meaningful surplus in that period, and that's kind of overhanging the market together with the spare capacity.
Yeah, there was. I know there's a Morgan Stanley note this morning arguing that are just looking at the possibility that the cuts are extended for the entire year. I wonder how likely you think that is.
Yeah, I think that's a really plausible scenario. We've been talking a lot in the last few months about how, on our base case demand numbers, base case non-OPEC supply numbers, it's within OPEC's grasp to balance this market for next year and protect these kinds of prices, $70, $75 TI and Brent. And so, if it's within their grasp to do that just by rolling forward the existing cuts all the way through the year, why won't they do it, right? And that's so it's increasingly looking like that's a really plausible scenario. Obviously, they don't necessarily want to extend the cuts forward just yet, and I think that may be partly to do with if you wait, you give time for supply disruptions to occur. So all the time you're waiting, you're allowing your out of the money supply disruption option to come into the money. So and that would then allow them to ramp back up into that supply weakness. So I don't think they're in any rush to roll it forward, but if the market stays like how we think it is going through the rest of the year, then that's probably what they do.
So Max, really quickly, I mean, you're head of all of commodities research at Citi, everything from iron ore to sugar, gold, silver. Where do you think is the most opportunity for investors this year?
Sure. I mean, I think one of the really exciting areas is lithium, but it's maybe not the most, not the biggest market. So in terms of the big markets, the second most exciting, but the biggest market opportunity is in gold and silver. So we're looking for a rerun of the second half 2007 rally that occurred. A really big rally in silver, and to a lesser degree in gold when the Fed cut from 5% down to 2% during the second half. So if the market moves towards pricing that kind of world through the course of 2024, we think gold and silver will have a great year. We've got silver up to $30 over the next 6 to 12 months, which is almost 30% upside from $23 at the moment, and we've got gold up around 5% in the base case scenario to $21.50. And the reason we're not as excited about gold and silver as I am in lithium is just why don't we have more price upside given that kind of outlook? Is just because we do think Europe and the UK will kind of start to underperform the US over the next, or that thematic will come back to the fore over the next 6 to 12 months, and with that, the dollar probably strengthens on a 6 to 12 month view, and that's a bit of a headwind for precious metals. So we really like the space, but it's not maybe as bullish as it could be. On the lithium side, we do see. For the next 3 months, if you average in over the next 3 months, you're catching a falling knife a little bit right here. But if you average in over the next quarter, come the end of the year, I think that position will be up 50 to 100%.
Yeah, lithium stocks got hurt badly last year. Max, thank you very much for joining us with some of the outlooks. Appreciate it.
Still to come this morning are the Mag 7 officially becoming the Lag 7. We're going to look at what the charts may be predicting.
And then later this hour, one retailer pulling Pepsi products from its shelves, saying price hikes have gone too far. Will others follow? We'll discuss.
Price hikes have gone too far. thought about it. But I'm not going to go against the market right now. It's definitely green today. I thought we had that bear flag going and it didn't work. It broke out of the bear flag. We are at yesterday's high. Go a little higher. Okay, I'm going to give Sarah a second chance. She's so cute. That's the only reason. I had one of my videos blocked yesterday because I had Bill dance on it. I haven't played any music on here anymore because they give me a copyright thing, majigger. Let's get the rebound, Johnny. I'm going to take my time here now. I got my beach trades out of the way. That saved me. I find that first half hour of the day the easiest time to trade. And this sucker's already up 10 cents. To put. There's your 200 right there. And we're up 20 cents now on the SPX, the 47.10.
Looks like it.
Looks like it.
European markets set to rebound today after the worst day in a month for the major indices yesterday. A slew of economic data to digest overseas today. Eurozone composite PMI revised higher from its original print, but coming in below 50 for the 7th straight month. This means the region, which shrank 10 basis points in Q3, likely contracted again in Q4. Business confidence also improved in December, but growth expectations remained weak. In Germany, inflation is ticking up. CPI meeting expectations at 3.7%, rising 50 basis points from November's read. Core CPI, however, came in at 3.5%, falling from the previous reading of 3.8%. It's because of that maybe a little hotter than expected reading there. And in France, Carl, that we're eagerly awaiting the Eurozone CPI numbers that come out tomorrow.
Good job, Limzoid. Thank you.
I think 6 for the whole year is the figure we got out of Germany. Let's get a news update this morning. Courtney Reagan has that. Hey, Courtney.
Hi, Carl. Authorities in Iowa say multiple people were injured this morning by a shooter at a high school.
Oh, my God.
They say someone opened fire at the school just before classes
I'm
started.
sick of this
Local
genocide.
officials did not give many other details at a press conference this morning, but multiple law enforcement officials briefed on the shooting tell NBC News.
America's under a lot of stress right now. A lot of stress. Got another high school shooting under the Biden regime. Well, this was already happened. Oh, this is already one that's happened. Okay, Scalpy, get out. I'm out. SPX. This trend line right here, off the 9, is my confirmation. Sarah, I love you. Whoop, SPX.
As vocal as Jim Bullard, who always came out and told us what he thought whenever it changed.
It's a good question. I don't know Alberto personally. I don't know him to be a very vocal person. My guess is he'll be a thoughtful person looking at his background, Sarah.
Yeah, no, with clearly some connections already there, having worked at the New York Fed. Thank you, Steve.
Sure.
Coming up after this, UBS lays out the case for a 40% jump in AI revenue. We'll talk about who might stand to benefit the most. Plus, we'll get to the second downgrade of Apple this week. This time it's Piper when Money Movers is back in a couple of minutes.
Disney knifed after that big pump yesterday to support Disney. ESPN and NCAA reach new 8-year media rights agreement. Okay, I had my little lunch. I'll be right back. I'm gonna make some coffee and water.
humanly possible.
Want to get to the second Apple downgrade of the week. Barclays going to underweight on Tuesday. Today, it's Piper Sandler cutting to neutral and lowering the price target on Apple to 205 from 220. Valuation and broader handset and macro weakness in the first half of 2024. Those are the key concerns. Apple's now on pace for a third down week, which would be its longest weekly losing streak since September of this past year.
Meantime, staying on the tech sector, a new note from the desk of UBS grabbing our attention today. The firm forecasts AI revenue will now grow by 40%, and they say semis and software are the best positioned industries to ride that wave. Joining us this morning, UBS equity strategist of global tech.
Market once higher, Mike says.
Today, Sandeep, good to have you. Interesting that you're talking about, I guess, are we still in a method here of we're in the picks and shovels element?
We break the 200, we go higher.
Services?
Yeah, hi, Carl. Thanks for having me. I think to some extent you're right. We are in the early stages, but clearly the last 2 to 3 months we have seen broadening of AI demand. So we call that the announcements that made in the last 2 to 3 months around Copilot, some of the announcements during the Open AI Developer Day gives us confidence that the App Store movement for AI is here. So which means the demand is clearly broadening. So it's not only the infrastructure companies that benefit, but also the applications and data models actually start to benefit. So that gives us confidence why we increase our estimates significantly.
You point out if the launch of ChatGPT was the iPhone moment for the AI industry, rollouts of different applications like Copilot, for example, will make this dynamic last, you argue, through the rest of the decade. There's news today, for example, that Microsoft may be adding a button to the keyboard which would launch Copilot. First time they've done that in a couple of decades. Does that seem like the kind of thing you're talking about?
Gosh.
Yeah, exactly. I mean, you'll see more such announcements in the next 1 week at CES, and throughout this year, you'll see a lot of companies actually trying to monetize AI. So I think just the way App Store has helped the entire smart device industry to increase its revenues and bring in a lot of these recurring revenues, I think with something similar would play out with AI. So yeah, a lot of companies will stand to benefit across software and also internet companies in the medium to longer term.
But so you don't think it's priced in, the optimism to the stocks, where we see stocks like Nvidia run more than 200% last year,
Yeah,
and
I
it's
could've
one of
jumped
the
back
few
in that
that's
for
actually
$30.
monetizing this trend at this point.
Look, I think some of the companies might have priced in, but the broader picture here is that we are in the early stages, right? I mean, when you look at our estimates, we are expecting
3 big black crows, so we could have an extension down.
From 28 billion in 2022, almost 420
That's a beautiful little call right there. Could have reversed that one easily.
There will be a lot of opportunities. So if you take a step back and look at 10
Puts
years
your
back
pan
with
here.
smart devices, I think in the first 2 to 3 years, a lot of share prices have rallied, but that rally or that strength in smart devices trade lasted for 5 to 10 years. So something similar would play out. Yes, there will be periods of volatility like 2-3 days, but I think this trend is going to stay here.
When you estimate the number of revenues, who accounts for the lion's share of those revenues?
I think in the near term, I think a lot of semiconductor companies, a lot of computing companies, not only GPUs, but also other semiconductor companies will benefit at least in the next 12 to 18 months. But in the medium to longer term, if you look at our estimates, so we are expecting the applications, a lot of software companies, and potentially beyond 2025 internet companies. But in the very near term, I think at least in 2024, it's still the semiconductor companies with a lot of computing, including memory companies that stand to benefit.
I wonder how you're handling or thinking about AI skeptics. Not that they don't argue it's transformative, but there are some who continue to point to the way in which AI hallucinates, so to speak, which hurts its credibility over the long term as an information source. We had a report earlier in the week about NVIDIA asking whether or not AI is just another cycle and whether the level of investment can last, the 23 level of investment can last beyond 24. How do you think about that kind of stuff?
I think there will be teething issues. I think, again, 10 years back when smartphones came, there were issues about touch screen, there were issues about
Introducing the world's newest, silliest, and hamburger-eatingest clown, Ronald McDonald. Now, where is that clown? Oh, Ronald! Hey, Ronald! Here I am, kids. Hey, isn't watching TV fun? Especially when you got delicious McDonald's hamburgers. Ronald, you can't be on TV and watch it at the same time. Now, come on and meet the boys and girls. Oh, we've already met. I know we're going to be friends, too, because I like to do everything boys and girls like to do. Especially when it comes to eating those delicious McDonald's hamburgers. A magic tray here keeps me well supplied. McDonald's hamburgers, french fries, and milkshakes. Watch for me on TV. We'll have lots of fun. He's Ronald McDonald, the hamburger happy clown. A McDonald's drive-in restaurant is his favorite place in town.
Yeah. Ladies and gentlemen, the vintage TV commercial of Ronald McDonald. They're pumping the video. CNBC is. We're going to get to 650 this year. Jim Cramer. We got 2 engulfing candles on the hour for NVIDIA, and I seen this old resistance and this new support, which to me is a yin yang. So that's going to be, you know, if we break past that, 289, Mike. 10-4, 280, 290, 490. If I said 2, I didn't mean it. 4. For you, for you. Today's volume leader on Jim's washboard watch list is Tesla at 51 million. Nailed the bottom on that one. And then we got Mara. You'll need my briefcase then.
And I think there'll also be some consumer names that are doing well too. So one name that stands out for us is DraftKings. It's a stock that's corrected, but
God, don't pump that sucker.
Support line, and from our perspective, looks like a name that should be bought in here, Sarah.
Well, yeah, I mean that has had quite a run last year. So is the idea stick with the winners except for the Mag 7?
Well, the idea I think is ultimately is you got to go where the best total return relative strength is in the marketplace. And right now we're seeing that in many different places. There've been a lot of stocks such as DraftKings that had corrected over the short term here, but still have a long ways to go just to get back to the old highs. You could look at DraftKings, you can look at ServiceNow. There's lots of stocks. Even Celsius is a name that corrected that looks like they want to see its uptrend resume. So from our perspective, this market's going to do well in 2024, to be clear, but it's not going to be driven by the Mag 7 the way that it was before. It's going to be driven by a broader swath of companies, and that has a lot to do with the change in sort of Fed policy. We're out of the rate hike cycle. We're in a potential cutting cycle as you get into 2024. And just looking back at history, Sarah, this is where mid-small cap stocks actually perform well, is when you're in that sort of last hike, the first cut type scenario.
On that point, I know you got some views on where the 10-year goes through the course of the year. Is that chart-driven or just based on other sort of macro forecasts?
Well, when the 10-year bond yield traded up to just when it traded up into the October-November timeframe, we actually got to a point in time where technically, Carl, it was pretty extended. It sort of had reached a pretty big overhead resistance area and sort of made what we would define a little bit of a short-term kind of top. From our perspective, we think there's going to be overhead resistance that's going to come in right around 403 to 410, not to get too overly precise. I think that's going to cap the relief rally, and then ultimately, by the time you get into the second quarter, I think you probably trade down to 3.25%, 3.5%. And again, that's going to be healthy for mid and small cap stocks. And again, the large cap stocks, I think, will not perform quite as well. And also, Carl, if you look at a very simple ratio chart, looking at large versus small, it's very clear there's been an inflection point on the chart showing that it is now the small mid-cap stocks that are outperforming.
Yeah, I mean, what do you think about just the correlation that we've been seeing with bonds, with the dollar, weak dollar, strong bonds, strong stocks? It feels like it's all one big trade lately.
No, I think that's pretty logical from what we have historically seen when you go back and you look at markets throughout time. When we start to see the Fed sort of change from a tightening cycle to a cycle where they're potentially cutting, the dollar weakens. That seems to all fit together well. That should also be a positive for equity markets. It should be positive for sort of the long duration assets too. And that's exactly what we're seeing happening. I don't think it's just one trade, Sarah. I think it's sort of a change in direction that you've been seeing, and one moving from a tightening policy to...
So I'm creating a scan right now. Small cap, average volume over 750K with a relative volume strength of 1.5. 1.5 is a good number to use. You could go to 1, but 1.5 would give a better kind of breakout pattern. Take it to charts. This is on FinViz. We got ARHS. And I'm going to raise the volume up to 1 million. BTBT's on here. Cron, Hive, Hims, GoTo. Let me look at GoTo. Florence, did you get out of the GoTo? Or are you still in this one here? GoTo shares jump after Citigroup upgrade. So Citigroup got an upgrade. Citigroup just broke the 200 on the weekly. God, that's such a big run. I had 54.45 and we hit it. There's a lot of room this year for Citigroup to move. That's kind of interesting. So go to run up on upgrade of Citibank. Primary, no binding proposal letter, stories, and Citigroup target upgrades. Go to a buy, raises price target to 450. Citigroup upgrades. Citigroup upgrades go to a buy, raising it 450 from 248. $428 would be the next resistance. Sold most. Well, if we break the 396, your next resistance will be right around 428. And your support, if it pulls back, 375 has to hold. And I'll send you that chart. And you can see where the resistance is on this here, on right there, that pullback. ARQT. Looks to me like Ricky Rodriguez might be shorting coin. Probably because Kathy Wood sold it. This guy's a multimillionaire. Biggest short position ever.
So I appreciate your time. I would love to see you in tomorrow's live trading session. That's the signs of lower lows and lower highs, and there's no reason to enter the short. I just thought it would be interesting to kind of talk about it ahead of time and maybe follow up with it if I actually take the trade.
No, you didn't take the trade?
What's it called? It actually ends up
Fucking
selling out
idiot.
because if it holds above, there's no reason for me to even take the short. I just won't take it, and I'll move on with my day, right? But when it comes down to where we're at right now, with the overall economic...
I've had enough of you. You said you took your biggest short ever.
Implemented, that they can adapt and that they can go beyond clicks and conversions or find different revenue streams like a subscription model. And guys, you could even argue that those changes that Apple implemented a few years ago that were so disrupted led to a positive change for companies that could adapt because they've been able to collect their own first-party data by offering incentives, which serves them well not only in the ad market but in generative AI as well, where data is gold.
Your point about AI is good, Dee, because I know you probably noticed the Morgan Stanley desk today arguing that sentiment around Google vis-a-vis AI is withering again. I don't know if you saw this.
Man, look at that short on it. That would have paid off good.
On search. I mean, that's another threat to its golden goose, right? That advertising model that's been called the best business model of all time.
Man,
where does that
410.
go when we have generative AI? I mean, this debate has been going on for a year, right? Is Google behind? OpenAI was able to capture that moment and partner with Microsoft, but Google has been developing the foundational technology behind generative AI, but it tells me that they still have more to prove here and that they need to protect that sort of golden goose that has lasted them for decades, digital advertising, while this all shakes out in the generative AI space.
Is it very noticeable for
This gets me in my timing.
for users?
I'm gonna look at the spy and I'm gonna have a shit fit.
Right now, this change that just went into effect, it's only affecting about 1% of Chrome browsers. So very slow, and actually they've been talking about this for years. Apple did it and didn't really give a lot of the third-party companies
not too bad of one.
time to figure out what it meant. They just did it. You could
I could have got out though, real nice.
Because they had to adapt immediately, where this has been a very slow drip from Google. It's going to be going on throughout the year. We're going to talk to someone as well, an ad executive shortly, to see what he thinks about preparations. But this is supposed to go into effect by the end of this year, so it will amount to a huge change.
All right, Deirdre, thank you. Deirdre Bosa. Well, this morning,
Again,
it takes us to France, where one
it
of
never
the
fails.
country's biggest retailers is saying au revoir to PepsiCo products, Carrefour, which...
It just never fails. Every time I get into a short or a put, or when I sell at a loss, it just never fails. If I just have the patience to hold a little longer, bam. 3 huge crows here on the 5-minute. That would have been nice. It just never fails.
Companies like PepsiCo are projecting modest price increases this year just because they have been met with strong demand.
Yeah, we've gotten comments about deflation from Walmart regarding grocery. We didn't really talk about ConAgra today, where volume was down 2+ and pricing down 0.5%.
Yeah, no, and they lowered guidance as well. It was one of those where they said, well, it will take longer than we think to get the benefits of the lower inflation in terms of volume growth. So they pushed that out. They're also very exposed to some of the frozen foods, which haven't been as strong, like Bird's Eye is a big brand for them, for instance, although Boom Chicka Pop I like, which is also in their portfolio. One more buzzy story for you today. Peloton has launched a partnership with TikTok as part of a strategy to attract a broader array of customers. The partnership will create a new fitness platform that will feature short-form fitness videos, longer live classes, contents from Peloton's instructors, and collaborations with TikTok and creators. Shares of Peloton are up more than almost 8% on the news, but still down 96% in the past 3 years. Traded at 160 during the height of the pandemic. Still trying to figure out, I guess, ways to grow and stay relevant at a time where, you know, people are just not locked at home on their Pelotons anymore.
Not at all. We did get a price target increase on Planet Fitness today out of Ray J. That was sort of centered around New Year's resolutions and the timing of new routines.
How long
and fitness.
does that last?
Right. We'll see how the
I've already broken all mine.
Let's get to the judge, post 9.5.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wagner, front and center this hour. How far is far enough for tumbling tech? We asked the committee which mega cap stocks to add to, which to avoid for now as that sector shakes out yet again. Joining me for the hour, Josh Brown, Shannon Sakosha, Kerry Firestone, and Jim Lebenthal. Let's check the markets. We do have some buying going on. The Dow is in the green today. The S&P is as well. So is the Russell, and we have had some buying in the NASDAQ, which did go positive. It's hanging on as a fractional loser right now, but we're watching that closely. So, Jim, I turn to you first because we've been watching the NASDAQ lower for 4 straight days coming into today. You had to believe the buyers are going to come out at some point. Maybe they're starting to nibble on a few stocks here and there, but we haven't seen you since the start of the new year. What's your view here as we enter 2024 trading?
Well, my view, and I certainly watch the first days of the show. I watch every time I'm not on. But my view is that this is hardly unexpected, right? I mean, we knew that there at least were a lot of taxable investors who didn't want to sell in December. They're winners. They pushed off till this year so they could pay their taxes in April of 2025. So this pent-up selling in the first 2 days of the new year is not all that surprising. In terms of worrying, is this the start of something, you know, disastrous? I really don't see it. I mean, we can quibble, and I'm sure we will, about the valuation on some of these stocks. But that's not something. I mean, the valuation of Apple, what, 28 times forward earnings? Okay, maybe it goes to 25, maybe it goes down 10%. That's not a disaster. And let me summarize this by saying, if you want the sorts of returns that you get in the Nvidias, by the way, trading at 23 times forward earnings, for a stock that's growing its earnings at what, like 50% a year? But if you want the sort of returns that you get from an Nvidia, from an Apple, all these sorts of names, you've got to take the
Man, I can't
volatility
believe
that
this.
comes with it. And that volatility
That's 2
can
trades this
often
week.
produce downdrafts of 10, 15, 20%. You can't get psyched out when that happens. And this downdraft the last couple of days...
It just makes me sick when I sell them at a loss, and I don't need to.
I want to know what your view is, Kerry, on these stocks in particular. They're the most.
I mean, look at this son of a
They're
bitch.
the
Just,
most bankable names. They have been for investors. They care about them seemingly more than they care about a lot of other names. At least for the moment,
$600 down the
because,
drain.
watching the shakeout of that has been a little unnerving, and trying to wonder when the buyers are going to come in. So Tony Pasquarello, Goldman Sachs, right? Cite him a lot, and I cited him yesterday afternoon when this note dropped, but I just want to reiterate some of the comments that he made regarding mega caps and tech. The stocks are not cheap. They're widely held. So one should be a little choosy on adding length up here. Bigger picture, however, I'm inclined to keep my eye on the ball and would look to add on meaningful dips. Well, we've had some dips to start the year here. What do you think about that?
Okay, so if we look at what amount they've gone down, we could say 5% on average is what the mega caps have gone down. That's close to $500 billion of value that
Jimmy said 6 to 9% pullback from the double top, and she said 5.
go for the next few days. Then we have recovered and replaced that amount of selling by buying, which I think would be meaningful. And I take it as a positive for the overall interest of investors into buying other names. Remember, there are 493 other names in the S&P 500, plus there are a lot of mid-caps and small-cap names that aren't in it at all. So I think that he's overstating to the extent that these stocks are not very expensive. They're, they're basically market multiples.
They are? Mega caps?
Well, Google is, Meta is, Amazon on next year's earnings, I'm looking at next year, is 30 times. It has never been 30 times. This is the first time ever since it went public that Amazon is trading with a 3 in the multiple, and it could go to a 2 if earnings start to pick up. The one that's expensive, I guess, would be Microsoft. I mean, Microsoft is in the 30s, but is that very expensive for the leading AI company? And Apple is 27. We're underweight Apple and we're underweight Microsoft, but the others,
well,
I
because
don't
you would admit that. Do you think those valuations are too rich? I mean, they're both above their 10-year historical average.
Yeah, but the market is selling for 20 times earnings. So I don't have a problem with people taking some profits ever. I mean, if you have a group that's up 75% on average for the year, and Amazon up 83%, Meta up 200, Nvidia 235, go through the list. Why would anyone have a problem with taking some profits? I mean, that's what we're supposed to be doing.
Yeah, but Josh, the hardest thing with these stocks is knowing when to get out and when to get in. That's why you've had people say don't trade them, own them. But yet, from a technical
this got an upgrade from $4 to $8 ARQT
in Amazon. Respective charts have become
by Mizuho
above trend and poised for a pullback. So you own that stock. They say many names are now stretched and at risk of experiencing a deeper pullback.
God darn, man, it's already had a run.
They've added to Microsoft. Alphabet and Meta, two of our existing
oh,
holdings,
gosh.
remain firm in trend, but tactically appear ready to pull back. So how do you assess this?
Well, I think you just said the key word in the last sentence of what you were quoting, tactically. So you have to ask yourself, first of all, do you even know what you're doing in the market? Do you know if you're an investor or a trader? MKM is institutional research that's geared toward hedge funds and other more tactical traders. And they are actually trying to outperform the market on a reasonable basis. And they are trying to do things in the short term that over the long term will be additive versus just buy and hold. Most people are not trying to do that. And most people who are in Amazon, they're in it understanding that there are going to be quarters where the stock underperforms and quarters where it outperforms, but it's really hard to know in advance which is which, when is when, and they don't want to take the risk of missing out. And every time you read somebody say something like, tactically, this chart is stretched and maybe it's a good time to take a profit, every time you need to ask yourself, what if this doesn't apply to me? And what if the bigger risk for me is being out and they're wrong? So maybe the chart is stretched and it gets more stretched. Or maybe it's stretched, it pulls back, I'm busy at a dentist appointment when it bottoms, I don't get back in, and then the thing adds 15%. So you have to know if you're a trader or an investor. It doesn't invalidate what they're saying, it invalidates what they're saying for me because I don't care.
Hey, but you can be an investor and still, have a debate over whether you want to get more invested in some of these names.
I
guess
agree.
I agree. And I guess I posed this question, Josh, in the context of last year it was easy just to buy them all, right? You just buy the Qs, you buy the 7 names or whatever, and you did well. I'm trying to play off of Tony's choosy word, right? He uses that word, choosy. So if you're going to be more choosy this year, because maybe you have to be, and they're not all going to trade in tandem, which ones do you lean into, and which ones do you say, you know what? Apple just got hit with its second downgrade this week. Piper cuts it to neutral.
Yeah.
You have some concerns about that stock, technically speaking, fundamentally, revenue growth, etc. Do you need to be more choosy, I guess is my question.
Yes, I think if you were to force rank all of the Magnificent Seven and ask yourself, like, what is the setup for each of these?
Josh
the
will
first
be a little
question
bit of
probably
smartass.
wouldn't just be valuation or price action. It would be what industry group is this company really in? Because they're not all quote-unquote tech stocks, by which I mean a lot of the growth that you're going to see coming from Amazon, even though it's considered
Lenzoid, I should have never sold that at a
is going
loss.
to be cloud, which is obviously a tech business, and advertising and media. Like, that's where the growth is coming from. Obviously, with Alphabet, it's a rebound in advertising that you need to see take place, even though they are in other businesses. So I think you should not look at these companies and just say, oh, Mag 7, bullish or bearish. I do think that that's right. You can delineate between where is this company really going to get its growth from this year. When you do that, in my personal opinion, I think Alphabet and Amazon are the two best setups in the group.
No.
Doesn't mean I want to sell my Apple. It just means, to your point, there are some areas that you'd rather lean into than others. So I think that's totally fair, and I do think that that is what most investors are starting this year out trying to do. They're saying, okay, I got 50% out of the Qs last year. Is it likely that I'll get 50% out of the Qs this year? Probably not. I mean, it could happen. Nobody thought it was likely last year either, but probably not. It doesn't repeat. So it's not going to repeat, but I still want exposure to tech. What are the themes? What are the industries? Where do I want to place my bets? I think that's totally
Nice bull flag breakout
Shan, Happy New Year to you.
on CHD.
Well, what's your assessment
There's Goog.
of this market? A couple of rocky days.
We got a falling wedge.
Going today.
Well, I mean, I think there's been multiple folks here who talk.
This is what I like about TrendSpider. I can pull up like a scan. This one here, I've got any triangle in force. We've got any wedge exits. We've got a falling wedge, or we've got an inverse head and shoulders in force. Then it'll pull up a scan after it picks them up. And I created a scan this weekend. I will go back and look at it in a second. We got eBay on here. There's a couple I recognize. We got Amazon. Amazon inverse head and shoulders. I'd like to know what time frame that's in. Look at the daily. A lot of times they're done on 15-minute. Five-minute. Amazon, when it gets earnings, people are going to be surprised. So this might be just pulling back to get into that. DPZ is one of the first stocks I ever traded. We got an expansion pattern, snake with an expansion pattern, and we're about ready to break out of it. And this is on the 5-minute time frame. So it's had a pretty good sell-off right here. I got the TTM squeeze down here on the bottom with the volume profile. So this looks kind of falling wedge and a rising wedge, or an expansion pattern, I mean, with a rising wedge. So that's kind of telling you something. eBay could be ready to reverse. I used to know guys when eBay came out, they'd made a small living on it. Been in a Darvis box for almost 2 years. We got 1, 2, 3. FedEx. CCI. MRO. MRO's had a good beat up here. Let's see. To the 1 hour. Got an inverse head and shoulders with a second touch here on a pullback. And right at the money profile. So that's where all the money is right now. Triple M, inverse head and shoulders right here. Came up and touched that right shoulder line. So that could have been a support right there and missed that one. Falling wedge exits failed, falling wedge and force, falling wedge breakout. COP was mentioned earlier today. Put this on the daily time frame. There's your falling wedge. We're at the top part of it. Of course, I fine-tune mine a little bit better than this. They're using the wicks. If I was to fine-tune it, I'd probably stick it right there. CTLT. Inverse head and shoulders to the 200 already. Halliburton and Cisco and XOM's on here. Inverse head and shoulders. Put it on hour. Double bottom failed, double bottom breakout. Put it on the daily. You got a double bottom on the daily. They're pumping Bank of America. Breakout of a fallen wedge. If I fine-tuned it with my strategy, it would be right there. It'd be snake breakout, double bottom boom to double top. You got a triple top on the weekly. You got a falling wedge on the, damn, that's a good one. Now this was downgraded. That one guy sold his John Deere. A wide falling wedge. Citigroup. There's some good ones on here. AAL. Oh my. That's overbought. I think they're pumping Lilly too much, but they're definitely highly aggressive on this stock right now. It's up over 100%. I mean, this is ridiculous. It's up over 100% in 2 weeks. I'd love to short this sucker. It's just crazy, isn't it? We've seen this before. I mean, many a times, but we've seen it with the tech bubble. Something run from, I talked about them yesterday, 100 to 500 to 600 bucks, and then we wake up a year later and they're at 60. Each one of these represent a quarter. So in 3 quarters, it's ran, no way. Each candlestick's a quarter. Ricky puts out a headline, says it's his biggest short ever. He didn't even short it. I don't even want to look at the SPY today. Jimmy called the double top. Jimmy got into it right here on the third high, and it broke out, and I got out of the trade. And I didn't pay any attention to it, or I'd have got back in it. That could have been $600 from the top of that down to here. Profit. I had a lot of contracts. I've lost. I'm going to go warm my coffee up. Well, what a deep subject for such a shallow mind is mine. I just look at this trade and I just want to really short it bad. There's a big old nasty candle right there. But I'd be going against all them fat cats. And probably going against Mike's will on this one. Is his mental short ever? I guess. McDonald's short off news. What's the news? They found a worm in a French fry. Oh God, what happened here? McDonald's. You got the news? Exactly, Ricky. Is that what it is? Oh, the CEO? Well, they got a lot of McDonald's in over there. I don't see how that could be a big impact. UBS ups price target on McDonald's to $3.40 from $3.10. That was yesterday. I don't think that's big news, really. Unless it's shipping and... Man, there's one thing I loved about living in Hawaii. Is they're very short on potatoes. You know, it's hard to ship potatoes 5 days without getting rotten. So there's a lot of rice. And the same thing with meat. They've got one of the best beef ranches in the world in Hawaii. Some of the best cattle ever. I enjoyed the steaks in Hawaii, if I ever had one. And if you got mashed potatoes, it was a delicacy. They really did them up right. McDonald's would often be shy of French fries. When you go to McDonald's, we're out of stock. PayPal downgraded by Oppenheimer. And it just got upgraded because of Bitcoin. I mean, this is really freaking me out.
Already been priced in. It would really be hard for somebody to come to the story and say, oh, but what about blank? Because again, they've lost like, I don't know, $300 billion worth of market cap since the peak in 2021. So you can't really say that there are like more shoes to drop. What you can say
Exactly.
is that it's going to be really challenging for them to ever grow at the rate that they used to grow. I would stipulate that, but I would say it's a 17 multiple. It's a new CEO who has been highly successful in M&A elsewhere, who could be contemplating a strategic transaction that none of us are. And you're not really taking a huge risk on multiple to bet that something might go right. I could be wrong. I could change my mind. A quarter or two could go by where there's no progress and I just get bored of the story. But right now in the high 50s, I feel like the risk is to the upside. Like there might be something unexpected that could occur.
Now see, he's really stressed out today, Josh is. It's like he's battling, he's trying to tell you that this pullback is a great opportunity to be getting in trades. I mean, I've never seen Josh act like this. He's very forceful in his voice. And he's usually laid back, but he's showing some angry strength.
Product is growing in terms of young people signing up for platinum cards, and it's really, I think, showing traction today with millennials and Gen Zs, and we think that there's a long run.
And technically, we are at a very strong support off the 50. So we've sold off real hard here, 63 to 58, $5 dip in 4 days off the 50. I mean, this technically, this would be a buy signal to me. But I'd have to wait for the next candle. And if we get like an inside candle or a Harmony or maybe a doji of some sort, maybe a tight squeeze Friday, I'd almost take this trade and run it back up to this trend line at 52. That's a bear flag. And it's took back what? Let's do this. Let's take it to the bottom of it. I'm not going to count that candle. I mean, it's pulled back to the 68% off the 50. There's another confirmation that that could be a good trade. Technically, I think it's ready, but responding to the Houthis attack,
against the Houthi rebels for the repeated attacks on shipping in the Red Sea. Some of the possible options reportedly include strikes against rebel targets in Yemen.
No, you ain't gonna do
ESPN will
shit.
become the exclusive broadcaster for 40 NCAA championships, including the Women's Division I basketball tournament, in a deal announced today. The $920 million deal between the NCAA and ESPN is for 8 years, with 21 women's and 19 men's sports, including tennis, track and field, and men's and women's D2 and D3 basketball. Scott, back over to you.
All right, Court, appreciate that. Courtney Reagan. Coming up, big news and big moves for Eli Lilly. Shares trading at an all-time high today. The company going direct to consumer for its weight loss drug. We're going to trade that as well. Coming up next.
Well, my day's not over yet, but that looks very nice. I'm going to put PayPal on my watch list if I don't have it on here already. I got to go through this and clean it out this weekend. Dow Jones took a hit yesterday. Oh, got an alert. Finally. Go, go, Eli Lilly. No way. It's a tweezer top. It ain't going nowhere. Let's look at the put on this sucker. I'm going to play a put for the fun of it. I bet you the call ratio is high on it. There's not that many trades on this today. The calls definitely are double. We got 53,000 only in calls and 26,000 in puts. Current IV is at 74%, which is overbought. Implied volatility is way high.
CNBC.
The regular,
All right, welcome back.
50-week
Eli
average.
Lilly today as that company announces Lilly Direct, where it will sell certain drugs, including its blockbuster obesity drug direct to consumer. The stock hitting an all-time high today.
That's incredible news.
Right? You think this is really, really big news?
I do. I think it's a game changer. It's just amazing. It's a brand new drug. This isn't a drug that's been on for 10 years. We're talking about Zepbound. That's the obesity drug that was just approved. And these drugs are going to be among the biggest ever in the world. And they decided that rather than go through the pharmacy benefit managers, they would sell it directly to consumers who have a prescription. You have to have a prescription, don't forget, for $550 a month rather than $1,100, which is what insurers are paying. I think that Lilly believes the price is going to go down further. And if you have 10% of the population, 20% of the population on these drugs, you can make $50 billion, $70 billion across the world on them. And why not control it yourself? That's what they're doing. They're controlling it themselves.
If they bypass the doctor and it's over the counter, if that's what they're saying, I guarantee it, man, their sales will go through the roof.
But there are several in line who also have drugs that are going to compete with them. Novo Nordisk, of course, is number one. They've been capacity constrained. That could start to change. I think this is a more complicated story, but they're the first to do this, and it's a very clever move.
Not going to buy it at this price. I acknowledge fabulous company, fabulous product. I was listening to what you're saying. We were talking at the commercial break. I'm not sure that this actually changes the profitability. They're cutting out the middleman, right? The pharmacy benefits manager.
You're an idiot.
Fine. So the pharmacy benefits managers don't get a cut of it. They actually don't want to get a cut of it. I'm not sure they're making that much money on these diet drugs. All that said, there's competition cropping up. I'm not taking anything away from Eli Lilly. What I am saying is, at 50 times forward earnings, it is priced for perfection, and things can go wrong when things are priced for perfection.
Which one?
Exactly. I agree with that.
Well, we're also talking during the break, Vertex. Now, this is not a diet drug. I don't have exposure in diet drugs. However, Vertex, cystic fibrosis is its core business, and it's expanding into sickle cell anemia, and pain is the real killer drug that's coming up, because they've got a drug that looks like it has the effects of the opioids without the addictive property. That's going to be a blockbuster.
All right. Josh, you have a take on this space?
Look, I think it's an area where you really can look and say there's not a lot of challenge here valuation wise. The real question is just going to be, is this the year that they deliver? Is this the year that you find the stories where the fundamentals are getting better faster than the market expects? That's typically the way that I've approached these names. But I really don't have any particular horse in the race at this point in time. It's just not something that I'm personally very focused on.
Shan, what about you?
Yeah, I mean, I think we saw last year, Scott. I mean, therapeutics just generally didn't do all that well, and healthcare certainly didn't do well. I think the risk here is that there's, expectations that this hurts the prospects for other healthcare companies, particularly those that treat diabetes and heart disease. I think the other side of this, though, is that over a long-term perspective, this really should help the payers if you think about managed care, because, you know, this could be one of those trends that lowers medical loss ratios over time, whereas right now we're really seeing those escalated and weigh on some of the prospects for managed care in this nearer-term period.
All right, we're watching shares of McDonald's, too. Before we take a quick break, want to bring you an update here. Kate Rogers is going to do that for us. Kate, what do we see here?
Hey there, Scott. Yes, we do want to call your attention to shares of McDonald's. They had taken a move lower. They seem to rebound somewhat here. The company CEO, Chris Kempczinski, posting a New Year update on LinkedIn, mentioning the war in the Middle East was having a meaningful impact on business. He wrote in part, I also recognize that several markets in the Middle East and some outside the region are experiencing a meaningful business impact due to the war and associated misinformation that is affecting brands like McDonald's. This is disheartening and ill-founded. In every country where we operate, including in Muslim countries, McDonald's is proudly represented by local owner-operators who work tirelessly to serve and support their communities while employing thousands of their fellow citizens. That local community connection is the genius of the McDonald's system. As mentioned, shares were down around 1%. Now they're lower by a little less than 1%, Scott. I'm sure much more to come when the company reports earnings in just a few weeks. Back
I
over to you.
appreciate that. Kate, thank you. A note being passed around on trading desks for certain, and we're watching those shares. That's Kate Rogers. Straight ahead, top contrarian ideas for 2024. We're going to continue asking our committee members for their outside-the-box ideas, the next big opportunities this year. We debate it next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
I got one contract here, this Eli Lilly. I'm just throwing it in. I'm at that feeling like this thing has just been run up too damn much. And it scares me. Kind of like what they were doing with Apple the other day, last week, pumping it up, and then we have a big knife. So I'm in this sucker. I'm just next week, and it might be a swing. I'm with all of them. Josh is undecisive because he knows it's up too much. The PE ratio, 55? You got to be kidding me. That's just way overbought. It's great news. But man, I can't take it. I can't take it. They're bypassing pharmacies and everything in between. They still require prescription. Okay. 10-4. Because they mentioned something about hair loss a little bit ago, and I'm saying, how that can... My sister was very obese. Huge. She looked like one of them teardrops, candy things. And she had a little tummy tuck or whatever you call it. And she's half the size she was.
85-55.
But she's got diabetes real bad because she was so much overweight. This thing's bouncing good.
Continue that today. Josh Brown, Yours is what?
Let's do K-Web. So
China
basically,
K-Web.
since inception, this thing has had a hell of a round trip, and it's no secret the entire Chinese stock market is down 60% over the past 2 years. You cannot find somebody who will tell you they believe Chinese stocks are investable. That is, if you're talking about like a big contrarian swing, this is probably the biggest contrarian swing that you could take. The top 10 holdings in K-Web, which is the Crane Shares Chinese Internet ETF, Baba, Tencent, PDD, Meituan, NetEase, JD, you know the names, Baidu, Trip.com. They're in all different sectors of the Chinese economy. There are multiple problems here with China. We're all familiar with government crackdowns against large tech platforms. We're all familiar with some of the issues they've had reopening from COVID. We all know that there's an icy relationship between China and the West.
It's squeezing.
So if you think that this can never get better, then the huge discount that these names are selling for is a valid discount and should remain in place. However, if you think that things are so bad that there probably is room for improvement on the sentiment front, these stocks are too cheap to ignore, and that valuation gap should close. K-Web is 72% below its all-time highs. It's had massive rallies over the last 10 years. It could again. I don't know what the catalyst would be. I'm not positioning myself as a geopolitical expert on U.S.-China relations. I'm just telling you, you want contrarian, this is contrarian.
Okay, Shan, you want people to bet on commodities. That's your contrarian play. Why?
Well, it's so interesting. Normally, I would come on here and we'd be talking about expectations for a booming economy or meaningful supply shocks or both if you're talking about commodities. But we actually look at this in terms of a hedge potentially for 2024. A hedge against some pockets of surprise inflation, a hedge against some of those geopolitical concerns that Josh just mentioned, and frankly, a hedge against stronger Chinese growth. And so it's really interesting because I view this, if you look at last year's stock, you look at all of the selling of Chinese equities. A lot of the emerging markets flows went into anything that...
I'm up $100 on this LLY already. Now this is a 1, 2, 3. This would be a great exit idea if you took this trade with me. Ubis Tibis in the freebie. So I'm going to get it. Well, I do believe this thing's way overpriced. I've never seen a chart like it. In 1 year from 311 all the way to 627, that's 100% gain. You going to tell me some hedge manager ain't going to cut it off right here? If they're a fundamental trader, they should have never been in it this long to begin with. And that K-Web, I mean, I agree with this, Josh, on this one. Yep, we got to squeeze. If I was to go long in a China stock, it would be this one. Now, it went down because of crackdown on the internet and the gaming industry, and then they came out a week later and said, we take it back. And then again, I hear that the numbers in China looked real good in the past 6 months. Lily's really looking nice here. It's now at 710. We never did make it to the 1, 2, 3. Here's your head and shoulders right here. Inverse head and shoulders. I'm going to get out. Here's your left shoulder. Here's your right. With a 1, 2, 3. Boom, back up to the top. And we've got us got a hammer right there and a gravestone, a dragonfly doji. Look at still. Nah, just leave it alone. Don't try to overtrade it. But damn, if I was scalping, it'd be a time to go up. The 650 strike call. They got 2,088 contracts next week. MRO. Now I'm really surprised that we got, this is the ugly side of me thinking that we've helped the Middle East and Iran so much with their oil in the last 2 to 3 years, and we've gave them $5 billion in cash. We opened up their oil spigots, so they're making a ton of money. Iran is. And that's probably why they're not worried about this oil stuff. It seems to me like they would be more worried about the Middle East than they would be Russia. And oil flew during that war. They want to keep the prices down for the election year. The fat cats do. And we got a snake here in the past 2 weeks off the 51. It does like to bounce off the 51. So I'm thinking we got to break 20. We're going to squeeze out. If I look at the 5-day, we got a 1, 2, 3. We got an inverse head and shoulders. There's the head, there's your left shoulder, right. So resistance is definitely going to be that 25.59 area, 24.52 to break. Back to 24.78. Look at the 20-day 1 hour. We could drop a little bit more, and I think we did. We definitely hit that trend line. This is an inverse head and shoulders right here. There's your left shoulder, your right shoulder, your right shoulder, and your right. We got 3 black crows on the hour. So that's bullish. 3 black crows on the hour, leading out with a spinning with a hammer, inverted hammer. With a hammer. So this everything about this support level looks real. Resistance would be 24.90. Okay, 3 black crows, inverse head and shoulders. Technically, this thing's ready to bounce up. If I put this on the hour over here, and then I'll go to my RSI crossover. Where are you? We got divergence on our side. I can understand Josh's frustration right now because he's stuck in some trades. I mean, he was pumping Uber. He probably got out of Uber by now, but who knows? I wish he'd have never pumped that at the high. You got a double top on a 20-day, you don't pump the son of a gun. You get out of the trade. Yeah, I like this. But they technically want to bring the oil down because it's an election year. And we're drilling more oil than we've ever drilled here in the States, but they're not going to tell the liberals that. My friend went and worked in the oil field. He came back 5 years later with $250,000 in his pocket. It says making $1,000 a day. I know it. Linzoid, you're going to make me cry louder? How dare you? I've taught her well, haven't I? I take all the credit. Oh my God. That's what I liked about Hey Sue. Hey Sue is taking a little break because she lost a very important member of her family. Her pet. And I got all shook up when my dog died. I rolled up in a ball for 3 months. The sad thing about it, I mean, when I brought her to the doctor, and I said it's time. I went out to my truck and there was doves flying back and over, 3 white doves flying over and around my truck, back and forth over my truck. Then when I got home, I looked on the floor and there was a shadow of my dog's face on the floor, and I just broke down in tears. He started having seizures and couldn't control it. It's just a horrible way to see your dog go. I still think about him every day. He was the best dog in the whole world, and I've always had a pet. And I accepted all the other ones when they died and passed away, but this one, it was just real hard.
Up 1.5%. Apple's down about 1% again today because of another analyst downgrade, this time from Piper Sandler, who's citing some concerns from a macro perspective for Apple in the first half of the year. It follows Barclays' downgrade earlier this week. So those shares working on a 4-day losing streak. Microsoft was up solidly earlier today. It's now just about flat on the session, down marginally. Remember, Microsoft and Apple could be on the verge of flipping that market cap leadership in the overall marketplace, but keep an eye on that mega cap tech trade. And then the stock of the day, another Dow component out there, which is Walgreens Boots Alliance. It actually came out and reported quarterly numbers that were good, better than expected on revenues.
But the dividend killed them.
Profits. but it cut its quarterly dividend from 48 cents all the way down to 25 cents because it's trying to maintain, it says, its long-term balance sheet strength, also preserves some cash for flexibility down the line. Those shares down 7% right now, so an interesting story developing there with regard to the accentuating the negative on the dividend side of things as opposed to the positives on the quarterly results. Walgreens Boots Alliance, a big decliner today. Kel, I'll send things back over.
Yeah, and still only taking a few points off the Dow. It's so small now. Don Banks. So is the worst behind us, or is it yet to come? One of my next guests says we've already seen a series of mini recessions across different sectors, while the other says a broad but shallow contraction is likely ahead of us. Let's talk about it now with Julie Beal, Chief Market Strategist at Kane Anderson Rudnick and a CNBC contributor, and Jay Bryson, Wells Fargo's Chief Economist. Welcome to you both. Jay, are you the one anticipating a downturn still?
Yeah, so Kelly, if I would say it's going to be a modest downturn. I mean, I think anyone would stress that. I mean, I don't think we're looking at a major pullback here in the economy, but we are starting to see some cracks in terms of consumer spending. And, the Fed is still in restrictive territory. I think that puts some headwinds on growth, in the coming quarters.
All right, so what would you say that implies for, not that it's where you kind of have to make your calls, Jay, but so those expecting Fed rate cuts and maybe the March timeframe, are they right? But are they right because of the slowing economy?
Kelly, I think March is a little bit premature at this point. I just, if you're reading through the minutes of the January FOMC meeting the other day, I just don't think they're at that point yet. I mean, I think something would really have to fall apart in the economy where you see a rate cut actually in March. Could we see one in May? Yeah, I think that's very possible to see one in May. But March at this point, I think, seems a little bit premature for me. But once they start moving, whether it's in May or wherever, I think they start to move pretty quickly at that point to bring rates down.
Julie, what do you think is going on with the market here? Is it reassessing rate cut? I mean, is it because the data's better than expected? Is it because it's worse than expected? Is it just everyone was on one side of the boat and now we're going to the other side? I mean, notably, the 10-year yield has moved up. What do you think is going on here as we turn the page on the year?
I think looking at the minutes, it's pretty clear that rate cuts in March, I agree, are pretty unlikely. If something really falls apart, that's probably going to be what drives the rate cut, and that's not good for equity markets, right, broadly speaking. But I also think that a lot of the buying that happened at year-end was pretty indiscriminate. It's sort of like when you're at Target, on December 23rd, and you're just trying to find something for, your cousin who you don't even really like that much. It's just buy whatever you can, and now I think people are recognizing that they need to be a little bit more discerning, particularly if interest rates remain a little bit higher and longer than we're expecting.
She must hate her family.
So I think people are looking back at what they own, and I think it's really the time to be very careful and selective about quality. It's so hard to predict what's going to happen. Think of where the Fed governors are right now for 2025. You have one of them at 5.5, and you have one at 2.5, right? So they're gonna be very data dependent.
It's just funny how the wind blows sometimes. These people get me. I mean, I have a memory. A lot of traders have a very short-term memory. They really do. But I remember their excitement into the end of the year about how we were going to have one of the best markets ever. Now everybody's coming out defensively. And I was defensive back then. I was saying, this is nuts. This is nonsense. We're sitting at a 50 all-time high in the market of 3 years in a row with a triple top. I mean, any chart master or anybody that knows anything about technical analysis would know better than to predict an early breakout. It's just nonsense, especially with the outstanding run we've had. I mean, it's negligence, gross negligence, to advise anybody to hold anything at these high levels. And you've got to be selective with, like she said, with cash. You got to have cash, especially if we have a huge downturn to this year's support level. And I wouldn't be surprised if we did pull back to that peak. Or the 9. At least respect the 9 once in this last run. If you go to the yearly, we lost respect for it. And we're teetering on the 21. Now, if the 9 crosses over the 21, it's a sure thing to the 51. And I'll short the market, I guarantee it. It's not that much, it's only $12. On the SPY, I mean, it's not that much at all. 10%, 9% pullback, maybe 5, I don't know. But as long as we hold the 21, we're still going to be able to squeeze between the 21 and the 9 and go back to have the triple top that I said that we're going to have when earnings start to come out. Because I think the earnings are going to be excellent on the fact that they forecasted them and the guidance so low. I've seen it over and over again when they lower guidance because they think we're going into a recession in 2024, and they all had it wrong. Yeah, it's just too much on the Fibbies. I can see it pulling back there. It's just too much. Just like looking at Eli Lilly. They keep pumping this thing. It's just way too much in a year's expansion. I mean, I've never seen anything like it. 3 years, we were at 150. Now we're at $627. Oh God, look at this. This is nonsense. $342 would be my price gauge for this thing. Half of what it is right now. So that's why Josh don't want to take it, because it's up too damn much. Rent's too damn high. A $615 put. Don't tell me this thing's at $700. Oh, it's at $700. By the time it gets to 616, it'll be worth $1,000. I took 100 on it. Now look at it. Oh my gosh. Here it comes. Here's your inverse head and shoulders. So to have a confirmation, boom, we broke support. And that's that triple 1, 2, 3 bits. It's going lower. That's what CNBC pumps do. There's your 68% pullback right here on the day run. We'll see if it holds. If not, it's going to be a strong knife down. I might get back in them here. This makes me sick. This is 2 times now. I didn't take a loss on this one, but the SPY pisses me off. The SPX. Oh, God. Look at that. 47.10 put. I've got the best instincts of the market. $160 to $540. Sue picked that one up too. Jim, you think it's going to hold to 200 on the 5 minute? So I made a vow this day. Did I say who's? I meant Linzoid. If I said Sue. Forgive me. We got an inverse head and shoulders here.
For the economy, it could be a big one, Diana.
It could, Kelly. Yeah, current homeowners are sitting on roughly $10.6 trillion in home equity that they can access while still keeping 20% equity in their home.
For the economy, it could be a big one, Diana.
It could, Kelly. Yeah, current homeowners are sitting on roughly $10.6 trillion.
January 4th, 2024, and if you have not, Q12 print, but go to Tasty's, up solid, making new highs, $18 new highs for the day at 47.66 to 20 cents. I put this trade on when the stock was only up around. I'm going to put in Roku here because I've already looked for you Roku up around $2.40. I put this trade on when the stock was only up around $1.80 or $1.70 or so. So you might be able to put this trade on better than what I put it on for. But let's take a look at some of the metrics or numbers that I like to look at. The IVX 5-day change up 1%. We like to see that higher when we're putting on a trade because we expect volatility to contract. IV rank of 26, better, good, not great. The thing that we're looking at here, earnings conveniently located February 21st, which is just after expiration. And here's the trade I'm looking to put on. I'm looking to put on a strangle. I have it set up here for you. I put it on at $5.59. Before we go into those numbers, I do want to remind you that if you come over here and go to the follow page, even before you see this Option Trades Today podcast, if you click on Bob the Trader or just look at the top trade, you'll see that I placed this trade not too long ago when the stock was trading at 88.12. The stock is 89.09 right now, and I did it for $5.59. Now you will get the trade ahead of this podcast because you're already on the Tasty Trade platform, and I submit those trades as soon as I put them
Snake
on.
breakout,
you won't get
double
the background
bottom.
to it, but you can see here that it's a strangle at the 25 short strikes, 25 delta short strikes. Let's take a look at that and go right to that right now. I'm going to click on the trade page. I'm going to close this up for you. I'm going to go to February closest to 45 days. We like to put on trades closest to 45 days in the monthly options. That's so if we were a little bit closer on one of these weekly options, I would still default to the monthly options. You can see here that little purple line is showing you where earnings are February 21st. You can see that in February, expiration is February 16th. So these earnings will not affect these February 16th options, at least not as much as it would if it were in the following months after the earnings. Well, let's take a quick look on the chart of what Roku has done so far. You can see here it's fallen off since the early December. It's certainly way higher than where it was in late October. Let's just call it mid-range for the last 45 days. That's what I like to look at because I'm going to be in this strategy or hopefully be out of this strategy within 2 weeks to 3 weeks under that 45-day time frame. I said around the 25 delta. Well, when I put on this trade, the 75 puts had around a 21 delta. That's my short strike there. And I went up to the 105 calls, which had around a 25 delta. You can see here that it has 8 short deltas. When I placed the trade, it had around 5.5 or 6 short deltas. We like to roll up the untested side when our delta, which is plus or minus, in this case it does look to be negative delta, so slightly short position in Roku. I was really looking at the amount of credit I was receiving on both sides. I like to receive around the same amount of credit on both sides, so I'll skew it a little bit, and just to get that credit. I mean, I could certainly go up to the 110 if you're less bearish than I am on Roku, or maybe more neutral in Roku. If you certainly wanted to go a little bit higher and give yourself positive delta, you certainly could do that too. You can see how the credits change. It's all the same. It all depends on what you want to do. I'm going to stick with the 105.75. 75 strike is about $14 away from the stock. You can see here that the call is around $15. There's really no skew here on my strikes, but you'll notice I'm collecting more on the call than I am on the put, even though the call is a little bit further away, and you're collecting around 65 cents more on the call, showing you there's a little bit of call skew. So a call ratio spread might be something else that you like to put on if you're a little bit more omnidirectional than I am here in the trade. Maybe omnidirectional to short if you're looking at a call ratio spread. I was going to start to talk about what I will do with this trade if it starts going against me, because that's the biggest question that I get when I look at on the YouTube page for the questions that people ask me. I like to do something when the delta gets to plus or minus 15. So when this gets to plus or minus 15, let's assume that Roku continues going higher. I will move up the 75 put to the 80 put. You can see here that it brings in around 9 deltas. Let's assume that difference will remain around the same. So if I had 15 deltas and I roll up by 1 strike, I will bring in about 9 deltas. I'll go back to 6 short deltas, which is approximately what I'm having when I put on this trade. I did this trade for $5.59, so my max profit is going to be that $5.59. I should move this for you. I'm sorry.
I don't think I can be bullish.
59 cents.
Bearish.
My buying power effect, $890 on this trade. Relatively small amount of buying power that we're using for the trade.
We're at a solid.
You saw the last trade I did in gold, I think used around $3,000 in buying power. The probability of profit right at that standard deviation, 67%. That's right in my wheelhouse, and I get paid $14 a day in theta decay on this slightly short, let's just call it neutral trade in Roku. If we go back for a moment to the follow page, you'll notice that I've placed some trades. I've closed some trades. Gold, that trade that we just did on 12/28, took a nice 90-cent profit in gold in just a couple of days.
Yeah, GLD, I called that one the other day. I bet you Roku has a good pullback. I mean, not Roku, but Lily. Because of all the hype. Yeah, Roku can definitely fall. It's already had a fall. I don't know. I think this is a nice spot to go up. Got an RSI crossover right now on the 1 minute.
And it turned it from a $0 business to it's trying to do about $1 billion this year. So it's really stood the test of time during this. I mean, like
The fat cats are back right now. It is now 1:30 Eastern time. We should have a direction change in the market, according to my history.
We write in the note that we actually think Yeti is benefiting from this halo effect.
Yeti.
Because the
and Crocs.
associates at Dick's we spoke to kind of said that when Stanley's were out of stock, they were kind of falling back per se on Yeti. And
sure.
I think Yeti's an incredible brand and a marketing machine.
Hell yeah, it is.
Stanley has really been reinvigorated with its marketing over the last couple of years.
I looked into it. Stanley is privately held. I think it was PMI, which was then bought by Hanny a couple of years ago. So there's no real direct investment play there. But so the question would be, can Yeti retain a $4 billion valuation predicated on, yes, the cups, but also obviously the coolers were their real kind of innovation differentiation point. Maybe there again, everyone who's going to buy one has one now, and we see how fickle the market is, and the consumer moves on to the next thing.
Yeah, totally fair points. I mean, I think Yeti's done a tremendous job of stoking interest in products they've had around forever. I mean, it launched in 2006 with the cooler. So they've done a great job, and every year they launch anywhere from 4 to 6 or 8 limited edition colors. I think Stanley's kind of taken a page out of Yeti's playbook here in terms of launching limited edition colors with the rose hue for Valentine's Day, the frenzy you were talking about with Target and Galentine's Day. So I don't think this is necessarily an indictment on Yeti. I just think in the current context of the consumer environment, you have student loans resuming, you have auto loans and new car loans at all-time highs, you have credit card debt at all-time highs. It's just a tougher environment to compete in, and this is the biggest competitive onslaught Yeti's ever seen in our view.
Not to mention the Gen Z kind of analysts who follow these trends say Because of course, once Kelly finds out, it's officially over. Okay, I still have my tall UGG boots and everything else that's uncool. So they actually think there's no way the Stanley really gets much bigger than it is right now with you and I sitting here talking about. They're saying even this new Owala water bottle, that's a Tro brand, another private company, that may be the next big thing. So perhaps that bails Yeti out. But again, I don't know. I guess we'll just have to find out how long their staying power is with, again, a consumer whose tastes are changing all the time.
Agreed. I mean, I think if you look at Stanley's web traffic, it averaged 150,000 per month in January of 22, and now it's 4.3 million, a 30-fold increase. So it's been absurd. So, but it's definitely, I think the $64,000 question is this a fad or a fall? And we're leaning more towards fad here, just given the revenues and the trajectory.
All right, Brian, love that you could quantify it and give us the granularity around it. We appreciate your time today.
Thanks very much.
Brian McNamara with BCG Capital Markets. Coming up, the cookie monster. Google is about to kill cookies on its Chrome browsers, and the digital.
I think this here's the anchored VWAP.
We've got the fallout for advertisers, for consumers, and for Google itself. That's next.
So I'm going to set an alert.
Check out
This is what I'm going to do.
Allstate and
On
Progressive
Yeti.
are hitting all-time highs. AIG and Hartford 16-year highs, and the Spider Insurance ETF, the KIE, just 1% away from its record high. And by the way,
Yeti. We're at the anchored VWAP, which is right here, and that's the 50 SMA. So I'm going to set, if I can here, I'm going to create an alert off the anchor VWAP, and I'm going to put a little visible ray there. Breakthrough, touch, and bounce. And I'm going to type in anchored. On the daily. Triggered once. Triggered 3 times. I'm going to go to 20 days. So now I've got an alert set. On what you would call an anchored VWAP. And I just started adding this to my strategy. The anchor VWAP represents kind of like a pivot point. And I'm just learning it. I've heard it for years and I've just never applied it. That's what kind of what I like about using, just starting to use a trend spider more often. It's got so many different ideas. I mean, it's a different kind of. I can't follow the ticks. Let's see something here. Oh, we got a fallen wedge too on Yeti. Yeah, this looks ready. I mean, I'm serious. I think that's the one I set the alert on, ain't it? Here, let's do this. Anchored VWAP. Pinch, medium, short term. I think long term, medium, and short. You got Boeing. So go to the 15-minute. And we're just now starting to bust above. That's probably the 9. Yeah. There's the anchored VWAP right there. It's not that one. There we go. CCL, bull flag. No, it's not a bull flag, but it's a J hook. Support Florence at 1667. I'm using 7 because I don't want to use 666. That's going to be your pivot point area on the intraday at 1667 with strong buy around 1642. I'm gonna go get a drink of water and I'll be right back. Taking aspirin. This guy's got his car running outside. I'm gonna go punch him in the face. Oh shit. The shampooer. That's crazy. The guy parks his shampoo right outside my window. That's disgusting. We got an RSI crossover here on MRO at support. CCL, did I give you your support level, Miss Florence? We got to pull back. Well, maybe if we break this resistance, this is my resistance line, and that's not accurate. Unless it's on a different time frame. Yeah, it's on the weekly. So we're definitely at a support level today. Bounce off the 9 on the weekly, so stick with 1642. Knife on what? On the SPX? I wonder if I'll have issues with this monitor. It's always sticking. This looks like real good resistance to break. If we break this resistance here, 4711.49, we will go higher. That's an ascending triangle off of an inverse head and shoulders. And we kind of broke out of it. I'll get my call ready. SPX, ascending triangle, Lotto, 4720 strike. We touch one. Oh, there's one right here, maybe. No, 1, 2, 3. About ready to grab one here. Yeah, it's definitely already had a 1, 2, 3. So we got to break out here, or come back, but it would, because we still have, well, we have 1, 2, 3 there, but not quite. I'm going to give us just a shot here. Looks to me like we might be getting ready to squeeze. Break out, baby. We're right back. This is a tight one here. We're going to see if we have a snake with an ascending triangle. We had a 1, 2, 3 on the bottom, and we got to break out this top. If it doesn't break here, we could pull back and fall pretty bigger fall. Yeah, damn it. No deal. Grab another one here. We got the 9 getting ready to cross the 21. That was another thing that I thought I had going for me. Oh. Okay. Ugh. We got 2 contracts now. Now I'm in the green. We're gonna break out. We're going to say hangover in the markets due to a lot of good news. What do they mean by that? Oh God, there we go. Better get stopped out here. Looks like it wants to break out. We dropped on that. That shouldn't happen. That was the 7th dot, which usually I make a business decision after the 7th, and I'm deciding to hold on for a second in a way. Last time I was at a loss and I sold it, I regretted it. I'm not going to make that mistake this time. Looks like we got some cup and handles forming on the AMD on the 1 hour, NVIDIA, and Meta. There's another head and shoulders right here. That's a two-headed snake. Oh, thank you, guy. Ah, damn it. It looks like I've lost this one too. Magnificent. So far, I've got about a C minus here. I'm down about 100. Attempting that 2 more, but I'm not going to do it. Bounce, baby. Bounce off that shoulder. Wolf that I did in the video did pull back to my 50% pullback, WULF. Got descending pattern scan here. I wanted to look at AMC from yesterday's. I'm still in my spot, my SPX here.
single-digit units growth. We also anticipate that following a weak sort of Christmas, there will be some excess inventory left over into the March quarter, which could potentially spill into June. We also feel that it's been a long time since Apple's done a form factor change. So the phones are kind of old looking, oldish, they keep upgrading the camera, but people anticipate that. Point number 2 is really interesting. They have a lot of legal headaches all of a sudden. The watch is a problem now with the issues around Massimo lawsuits. On the services side, you saw Google lose to Epic, which could be a problem. It could come back to Apple in another form of a lawsuit. We also know that the DOJ is questioning the browser and the payments that Apple gets from Google. So all this could be a sideshow distracting to the motion. Point number 3 is Apple gets about 10% of its.
Let me, if I might, Harsh,
What's that
let
news
me
coming from?
pause there, and I'll let you pick up on point number 3 in just a second. But I want to bring Steve into the conversation because Harsh has laid out 2 very key points here.
That's
Number 1 is slowing handset sales and legal disputes that the company is facing.
Well, it's not just that. Legal disputes that Apple's facing, it's legal disputes that Google is facing as well, because Google makes part of that case that the DOJ is suing Google over is over the payments Google makes to Apple, $19 billion a year or so ago. It could be about that again. So that puts their services business at risk. That's basically a free check that Apple gets all the time. Something Harsh did not mention also on the regulatory front is what's going on in the EU, which is going to force Apple to allow users to download apps from outside the App Store, and those are all missed sales too.
So, Harsh, pick up where you left off. Let's go to point number 3, which I think is the Chinese economy. And you don't know where and how strongly it will come back and where Apple will fit in it.
Yeah, so the issue here is that Apple gets about 10% of its revenues, or phone revenues, from China. And we just don't know, how long it'll take to recover. It could be 6 months, it could be a year, it may be a long time after that. The last 2 points are easy. Valuation is running a little bit higher than the 5-year average. Stock's about 27, 28 times, trades at about 24 times. It's had a great run, and I think it's time to take some chips off the table, quote unquote, and just wait for a little bit of a pullback. I think it could be constructive.
Harsh, was this in some ways a reaction to Barclays making the same move, or if you did it on Monday, you could have had the whole market moving lower as a result? I guess to put it differently, I wonder if we should expect more of your colleagues to follow suit now.
I can't say for what my colleagues do, but we had a 30-something page report that we were working on. We downgraded several names. As you saw, we are negative on the chip sector and a lot of different areas within the chip sector. In fact, one of the few things that we like is we like memory a lot, and we like generic.
You talk like a bubble, just what I've been saying.
More. So that's another thing that's happening. But yeah, it was a long report, and it just happened to be within a couple of days of a competitor.
That's interesting. So you had really been working on this for some time. Does the chip, tell us how these two relate, the kind of weakness you see with Apple, the weakness you see with chips?
So the two are a little bit different. Obviously, the handset sector affects things a lot for Apple because, again, 50% of revenues for Apple come from the handset side. But outside of that, the rest of it doesn't really correlate. On the chip side, we are concerned about these high interest rates we've had for a long time now. And these high interest rates tend to skew the spending habits of consumers. It puts a lot of pressure on them. You have things like automotive and industrial, which are large segments of the semiconductor end market, that are finally starting to cool off. You've had a bunch of analog companies come out and say, hey, there's excess inventory in the channel. Car guys are starting to sound the alarm. You saw Mobileye this morning. So we feel like things are starting to fall apart. It could be a quarter to 2 quarters before all the numbers are reset. And so we don't like analog, we don't like handsets, we don't like consumer chip stocks. We love memory, and we love generative AI. We love NVIDIA.
I was going to ask you, what do you like, Harsh? You love memory and you love generative AI. Tell me all the things you don't like. Steve, why don't you jump in with a comment?
Yeah, we got to talk about computers too. Apple also makes computers, and the Mac business has just been in free fall for the last few quarters here. A lot of pandemic buying. They put out their new chips in the Macs that were very successful. And then today we get this news from Microsoft saying we're going to put this Copilot button on keyboards on Windows PCs. They're calling it the year of the AI PC. Don't know what that means exactly, other than
But everything that you're saying captures what we've been talking about this week, which is there some kind of real problem with tech? Or is Microsoft and is AI the new Apple, the new ecosystem?
That's exactly it.
They're the best idea right now is even to integrate it into the computer.
And that seems natural. You know, let's go back to the 90s and early 2000s. Internet PCs were the big thing, right? Now they're trying to inject this AI into PCs and calling them AI PCs. Don't know what that means beyond just, you know, putting some good chips in there. And as far as the capabilities, what can I do now with this AI PC that I couldn't do a year ago with the non-AI PC? They're not explaining that. So Microsoft actually has to do some work here, fill that gap. So the hardware manufacturers have the shell that needs to be made into whatever this magical AI PC thing is.
A button on my
to launch Copilot.
To launch Copilot, which is their AI.
And that is good, but beyond the Copilot thing, what does an AI PC mean? You don't need one of these AI PCs to run Copilot.
To go to Copilot.
You can use the computer you have right now to run Copilot. So the real question is,
What do you mean
what
by
are they going to do
Copilot?
on the software end, Microsoft, that's so special in this Windows ecosystem that makes AI PCs the big thing that they've been hyping early this year?
But I tell you, a button on my keyboard that would take me directly to a place is not a bad idea.
No,
I mean, whatever the place is.
And that's what the computer you have right now. There's a Windows key that takes you to the start menu. They did that about 30 years ago. That was a big change. This is a 30.
Oh, look at
He
that,
just popped up his start menu. So this is the next big change that they're making to the keyboard. It's interesting. I mean, I was 8 years old the last time they made a big change to this. And so now they're you know, this is a signal where they want to go with it.
You just changed my whole life.
There you go. Now you never
no idea what that
mouse.
Whereas the nerds like Steve and I were so excited when it came out, like, wow, look at
finally.
All right, Harsh, thank you very much. Happy New Year, my friend. Appreciate it. Harsh Kumar.
Happy New Year. Thank you so much.
Thank you. We'll see you soon. And Steve Kovac. Thank you.
Speaking of Apple, our next guest just increased his stake in it, even as everyone else has been backing away, and says he'll keep buying if the selling continues. Let's talk to Keith Fitzgerald, Fitzgerald Group's principal. Keith, it's good to see you again. Welcome.
Thank you so much for having me back. It's a pleasure.
Unbridled enthusiasm for Apple here.
I think this is a golden opportunity. I mean, both of your former guests are obviously extremely intelligent guys. They know their stuff, and I respect their opinions. But I don't think we're living on the same planet here. We're looking at Apple, and we're seeing a golden opportunity. You've got 240 million phones due for an upgrade. You've got a sensor platform. You've got 1 billion paid subscribers. You've got a business that is growing 30, 40, 50%. The services are sensory network worldwide at this point. They're getting into finance. This is the year they're going to hear AI and Apple.
I got it wrong again.
I just frankly don't get it. I'm perfectly happy to buy more shares here.
And when we talk about buying more shares, give us the case, Keith, that this isn't the moment that we look back on and say, nope, that was the year Apple matured. Its market cap never got back to where it once was. Although I guess they could keep buying back stock and it would do just fine.
Well, look at it this way, Kelly. I mean, and just respectfully, let me push back. You know, people have been arguing with me for years, saying, well, these big tech companies can't possibly get any bigger, can't possibly get any more popular, can't possibly get any more valuable. And that's exactly what they've done. You know, throughout all the economic weakness, I haven't heard one person giving up their iPhone because they feel inflation's getting too high or they aren't skept. They're cutting back on their groceries, all these other things. The company has an MO that is proven and proven and proven. They come in, they wait, they watch, they let everybody do their thing, and then they come in with more panache, more cash, and a better consumer offering. I think, you know, again, a pullback like this, if you're talking
I got a
about
double bottom. I added on here.
Fine. But over the
So I
next
brought my
3
cost
to 5
average way
years,
down.
I think you're going to shoot yourself in the foot.
What about some of the longer-term issues that Harsh raised in his sort of essay on the company? One is the not knowing about China and the competitive position in China for Apple where they get 10% of the revenue. That's number one. Number two, the criticism that the company has not broken through with a new sort of form factor or breakthrough other than incremental improvements to the existing product, incremental improvements to the camera on their flagship, the iPhone.
Well, I think those are both very valid concerns. And let's tackle the second one first. So, form factor, right? Do you hear consumers complaining about their iPhone? Because I don't. I'm perfectly happy, for example, personally, to carry mine. It's about the right size, about the right weight. It does what I need it to do. So I'm not begging to have a foldable phone or rolling phone or any kind of other thing like that. I just simply don't hear consumers talking about that. So to me, that's a false flag argument. The second one, talking about your criticism of the company and where it's going from here, those are very valid concerns. But again, this is a company that has a long, distinguished history of watching competitors fight it out to be first in the space, learning from that experience, and then coming in and changing consumer behavior the way they do every single time they release a new product. I think we're going to see that again.
You also bought Microsoft, Palantir. I remember talking about NVIDIA last year, Keith.
Oh,
What else?
Pelotar.
Oh my goodness, well those are at the top of the leaderboard for sure, and I was fortunate enough to get that right, because this is a super tough business, but I'm not giving up on any of those companies. I think they're all, again, within the context of what we've been discussing with Apple, Kelly. I think they are absolutely viable, must-have companies that people 4, 5, 10 years from now are going to kick themselves if they don't start accumulating on the buybacks.
And what about people, and maybe you're the perfect person to talk to about this, the valuation, NVIDIA, Microsoft, it's not that crazy. We're talking about, I don't know, around 30 times, but they've also been on historic runs. They're well loved. Everyone owns them, and so on and so forth. So I don't know if you could just address that and the broader stumble we've had here to start the year, especially in the NASDAQ, if that worries you, or it sounds like it's just a buying opportunity.
Well, again, it's a buying opportunity, but, I don't take these moves. I'm not cavalier about this. We do our homework. I have a tremendous background in nonlinear science, and I was king of the propeller heads when I was growing up. But this is an interesting point you raised. Is it really expensive? Accounting regulations are set up to value manufacturing and hard goods. They don't recognize or capitalize digital expenditure and investment appropriately. So what you're seeing today is a shift in the way the world looks at these things. I would submit that accounting valuations, PE ratios, any of the classic metrics no longer apply, because you cannot amortize or expense the digital expenditures because they don't come into the balance sheet or the P&L for several years into the future. That's very different than making a widget, than making a Peloton bike, than making an oil rig. So to me, this is an opportunity time. I'm less concerned with valuations than I am with growth.
All right. Keith, good to see you. We appreciate it today.
Thank you.
Keith Fitzgerald.
All right, coming up, Lilly's launchpad to customers, the drug maker going direct to consumer on weight loss drugs, what investors like you need to know. Plus, further ahead, a power player in solar. The CEO of Sunrun will join us live from the Goldman Sachs Energy Conference.
I gotta stretch my back, it's starting to hurt.
At a fraction of where they were in 2021, under pressure from noted short seller Carson Block. All that and more when Power Lunch comes back.
Right now I'm in the green. Oh my. I got a lot of contracts. That would have been good if I stayed with that put on Eli Lilly. That's the line we got to break, the 51, or the, what is it, it's VWAP?
Welcome back to Power Lunch. Shares of Eli Lilly are up today after they announced their popular weight loss drug, Zepbound, can now be ordered directly from the Lilly website. Recently, weight loss drugs have become wildly popular, with companies talking about shortages, warning of fake versions entering the market. And my next guest says Lilly's service could improve access and lower drug costs for consumers. Joining us now is Dr. Shad Marvasti, a practicing physician trained in primary care, public health, and integrative medicine. Dr. Shad Marvasti, welcome to the show. We appreciate it.
Thank you very much.
Okay, so have we ever seen something like this before, by the way?
I don't think we have, and I think it's interesting, the strategic plan here behind this move by Lilly, especially when you think about the potential impact it could have on the pharmacy benefit managers and the kind of system of distribution and access to pharmaceuticals. So I think in that sense, it may be really an interesting testing case for them and for the market to kind of see how people react to it. They've cut costs, they've increased access, and they've kind of provided this direct-to-consumer outlet, which post-COVID era, we've seen that to be a really important thing, and combining with telehealth services, could be potentially impactful in terms of changing the landscape on how all these things are done.
Is this a threat to the PBMs? I mean, when they do something like this, I think, well, why hasn't everyone always sold drugs this way? And are they elbowing the PBMs to the sidelines as we see a lot of pressure, regulatory and innovative from Cost Plus and otherwise, coming to that space?
Well, I definitely think it puts the PBM on notice. When things like this start happening, these are disruptions that occur in the system, and with the medical industrialized complex being the way it is, and how we saw things pre-COVID before we really pushed the envelope in terms of what was possible from a telehealth perspective and access perspective. I think this whole idea of bureaucracy in healthcare, as high of a percentage of GDP that we spend on healthcare, more than any other nation in the world, really begs the question where PBMs and other entities, that are kind of middle managers, really serve a role in the future as we're trying to increase access and efficiency in terms of getting medications to those who need it most in a quick and cost-effective manner. So I think that this definitely is something that begins to question the current, status quo of this, and I think we should question it, because that's how improvement and change happens.
If I get out right now, I won't be down that mad, but if I drop below 40, I'll be
weight-reducing
ouch.
drugs. In other words, would I, the consumer, receive a prescription from my doctor and then upload it to Lilly's website, and they then send me a kit?
So now we got a triple bottom.
Myself, I guess. I don't know. How would it work?
Yeah, they created a platform where ostensibly they're still leaving the decision about this to the physician who's
with a descending flag,
and they're going to either connect with a telehealth partner who will do a video consultation.
So this is the last chance.
This interview right now, or connect you with a local doctor as part of a network that they've tapped into, and then from there they should be managing the care. And I think that's a really good point that you bring up. With these medications, these GLP-1s, just like any other medication, they have side effects, and you can't just have an episodic kind of care, encounter where they're just going to get a medication prescription and then you're off and running, and I'll see you in 6 months. These are side effects, and you need to manage that. So there needs to be that continuity.
Tesla pulling back.
If you don't have that continuity, you're not getting good care, and you also need to be objective in terms of determining who gets this based on objective medical criteria. So I think all that's critical, and then also guiding the patient with the education in terms of how to administer the drug, all the things that you would get, standard if you went to your doctor's office. But, this kind of cuts out that whole process of getting that initial appointment, which is very difficult to get, both for obesity management and also because of our chronic shortage of primary care physicians, which is a big problem with the American healthcare system.
Kelly pointed out an hour ago on her prior program that Eli Lilly is up something like 1,100% since 2013 and has had 7 or 8 years in a row of positive returns. Let's cut to the question of how big this drug Zepbound could possibly be, or its correlates in the medical armamentarium. How big can they be? I was talking to a physician a couple of days ago who said the benefits of these drugs go well beyond weight loss per se. They go to questions of inflammation, cardiovascular health, even cancer treatment.
Absolutely. I mean, I think there's, there's a new era with these GLP-1s, and I think that there's many different implications for a lot of the chronic diseases of our time, as you mentioned, cardiovascular disease, cancer, diabetes, obesity. So they really do provide relief for the, 34% of Americans who are obese, the 11% of Americans who are diabetic, and, cardiovascular disease is the number one killer. So I think it is a game changer in terms of what these provide, but I also would just add the cautionary note that we need to concomitantly prescribe food and lifestyle prescriptions alongside these medications.
Exactly.
Because if you don't make those changes, which are a really underlying causal, component.
That's the first thing my doctor did to me, my new doctor. She gave me a food plan. I went in there for, I forgot why I went in. And then she found out I had high blood pressure. So then she put me on some kind of dietary plan, which didn't make no difference in what I was already eating. Well, looks to me like I got to get out of this trade. Sometimes I think when the market's down like this, it's not good for me to trade at all. It's not going down much, so we'll see. I'm way out of the money now, though. Goddamn puts. The puts are at 1770 now. I'd be up almost $12,000. Right there, all the way back down to a double bottom. Hell, we could get down here to 46.96 if we don't start turning around. From that move there to that is almost $1,500. I'm not going to sell. Can I get back to 60 and break even? We got 2:27 right now Eastern time. Yeah. down about $500. No, I'm down. Oh, better than that. No, 25. Moving. Breakout. I really regretted selling at my loss yesterday. I just don't want to do it. I'm going to talk myself out of it. I got one thing I can look at that I haven't looked at yet. And I can't see it on this chart, so I'll put it on another one. Charts suck today. This platform. Yeah, I think we're going to head on down eventually. I'm having a hell of a time with this platform today. I'm still on the 21 on the daily.
Today, multiple bomb threats have been reported in Mississippi, Arkansas, and Florida. And a child started the fire at Miami Dolphins star Tyreek Hill's mansion yesterday. That's the word from fire officials who say the kid sparked the flames while playing with a lighter in a bedroom at the house. Hill's agent said crews contained the fire to one room, but there was extensive water and smoke damage to the home. Officials say everyone in the home at the time made it out safely. Kelly, back over to you.
So scary. I always think,
Why would anybody send a bomb threat?
I don't know. Someone gets in the drawer.
This country is so upset.
Still to come, solar stocks in the political hot seat. Some run down 15% in just a week, down 28% in the past year. We'll hear.
This was one of their biggest sector pumps this year, solar, at the end of the year. They said solar was going to rebound. No, Jimmy's still in. It'll probably have to take me a good loss. I did this yesterday and we had one of the best runs. And we were right about here, so. Kelly, I love you. I look at them puts and I just want a ball. $10 times what? $1,600. And I got 20 of these. It'd been 16,000. 1,600 times 10. Yeah. Breakout. If I take it to here, I'll be happy camper. That means I'll probably get about 80 cents, 90 out of them. Doo-dah, doo-dah.
Asset.com.
Welcome back to Power Lunch, everybody. Solar stocks having a rough start to the year and getting hit hard today, following a pair of downgrades of Sunrun and Enphase Energy by KeyBank on valuation concerns. Sunrun, one of the biggest losers in the space, down 6% today, but the stock has rallied in the past month on some optimism about the Fed cutting rates this year. Let's send it over to Brian Sullivan, who has an exclusive with the CEO of Sunrun to kick off our coverage of the Goldman Sachs Energy and Clean Tech Conference in Miami Beach. Brian?
Tyler Matheson, thank you very much. Yes, we are joined by Mary Powell. She is the CEO of Sunrun, also a former utility executive, so she comes at it from both sides. Mary, we chatted here last year. It's good to see you again.
Oh, it's great to see you
so
too.
They came in on the interview. I want to talk about solar and storage, but they came in on the interview with, talking about big moves in stocks. And how frustrating is it to be a CEO of a company? You're just trying to build out solar, storage, capacity, etc. when every 5 basis point
We're at the
movement in
21
your
on Sunrun.
sends your stock up or down 10%. Why is that?
I mean, Brian, we're up, over 60% over the last 3 months. And the fact that the Fed has indicated that, likely the rate hikes are over. And in fact, we could be looking at some decreases in this coming year. Yeah. It is actually a significant tailwind for us. Basically,
lower rates are a tailwind.
Yeah, for sure. Lower cost of capital. When we look at the future, we've looked at a cost of capital. We've structured it around a higher cost of capital. So we're actually doing much better already just in the last few months with what has happened with rates and with the outlook for 24. So we're feeling.
Do you understand my point? This, the
it's not down that much.
Down 0.25%, your stock goes up 50%. There's a lot of things that are happening that are not based, I'm assuming, on the pure fundamentals of Sunrun's business.
100%. And what we stay focused on at Sunrun are the pure fundamentals of Sunrun's business. And that's why we've been very clear with our investors that we are about generating cash. And that's what we're going to be doing in 2024. And that we've already guided to generating $200 to $500 million in cash generation as we exit 24. So we're feeling really good going into 24. We also have, you have hardware costs coming down, you have the ITC adders flowing in, the Inflation Reduction Act.
What is that? What is
the Inflation Reduction Act adders, the incentives for low and moderate income households across America. Those are starting to flow into the economy in 2024. So we see a lot of great things happening. But most important, Brian, like when we spoke a year ago, I said we were going to make 2023 the year of storage. And guess what? We did. We did. We actually had over 100% growth in our storage megawatt hours over the last year. So I am so excited about our position going into
100% growth.
Yes.
So it does.
Yeah, in storage.
Because
yes.
I'm sure a lot of people think of you primarily as a residential storage, a residential solar company. We're going to put solar panels.
I used to clip my nails when I was in I Love Stocks. And Vegas would say, Jim, are you clipping your nails? That's very unprofessional.
That direction. In fact, one of your programs is called Shift.
Yes, exactly.
Amazing how I just worked that in
yes,
there.
you did. And in fact, that's what we talked about, is there was a policy shift in California last year that we really leveraged.
That's how we led our interview last year, by the way. It was not a good thing for you.
Exactly. But it really, what we did is we used the year, we used the change that was happening to build a much stronger platform for growing as a storage
Very
company.
good.
So we called it the year of storage. We led a storage first strategy. At the beginning of the year, your typical Sunrun customer was attaching storage at about 15%. So 15% of the customers were also
Oh, this is a
buying
hard one
storage.
for me.
You know, at our last earnings call, I said we're already up to 33%, and we were selling at a 40%, which is so significant, because not is it only more value for the customer, it provides a much more valuable energy experience, but it's way more valuable for our investors and for the company in the context of our
I know
bottom line.
my colleague Kelly in chilly, in frigid Englewood Cliffs, New Jersey, has got a. I'm not gonna lie, guys. It's 70-something degrees down here. It's not terrible, Kelly.
Yeah, no, we're chilly in more ways than one, Mary. The company has been accused by short seller Carson Block of overstating your subscriber numbers by 20% based on what you tell investors versus the EIA. Can you explain that discrepancy and answer his claim as well that you are overclaiming tax credits as a result?
Yeah, so we've always welcomed healthy debate, questions, and we've responded to every single inquiry with detailed responses. And what I can tell you is we work actively with the EIA. We go over in depth how we report, and we've had them confirm that we're doing things the right way. So, you know, again, Muddy Waters has it wrong. We've responded in detail, but we always welcome any and all questions, and we've been in that situation ever since we started Sunrun, where you're always going to have people asking and wondering what is going on, why you're doing things the way you do. So again, we've responded. They have it wrong. EIA has confirmed the way we're doing it.
And his latest sort of analysis was after you were asked about it in the earnings call in the fall, and he said that the reasons given by the company didn't hold up to his scrutiny. He says you could solve the matter by releasing in each quarter the number of subscribers that generate GAAP revenue for the quarter versus the number for which you claim or effectively sold tax credits. Would this be something that investors could maybe expect any more transparency on in the quarters ahead?
Oh, we've been very transparent. As I said, we've responded with detailed responses to every single request, and we feel very comfortable in how we're reporting data. And you know, what our investors have told us is they feel the same.
From the macro side, very quickly, because as I noted, Mary, you are also a former utility executive. So there's been this weird dichotomy, and I heard from some high-level people in D.C., by the way, so hopefully they're watching this right now. I got some angry tweets or text today, which is, we've seen natural gas. I'm going to ask you to take your Sunrun hat off for a second, if you don't mind. Natural gas and coal prices have come down year over year, but in a lot of places, electricity rates are still on the rise. People are getting notices, I'm up 14, 21%. As a former utility executive, explain the lag. Why are utilities slow to respond, and why are rates still going up, which probably is good for your business, by the way, while commodity costs are falling?
So there's a number of factors that drive what happens with utility rates and what customers pay, and it's also different depending if you're in a fully regulated state versus a deregulated state where you have different components coming on your bill. But simply put, I mean, one of the reasons I fell in love with distributed generation and the kind of work that I'm doing now in solar and storage as a utility executive was because I saw it as a way to control the cost of the grid. And one of the things that I love about where we're at, particularly with the amount of storage we've been selling, is that we now have over 1 gigawatt of stored clean energy capacity
That you can
that
put
we
back
can
into the
use
system.
and help and put back
You can
to the
actually use
system.
your customers to push it back into the system, and a gigawatt,
100%.
I think is probably
Yes.
fair to say, about a small nuclear plant
Yes,
of
yeah,
electricity.
exactly. So, and when you think about the pace at which we're scaling, that gets very powerful. But back to utility rates, there are so many pressures. Just climatic events alone are putting so much pressure on transmission costs, distribution costs. So yes, coal and natural gas can fluctuate, but the base inputs to what's driving up rates, I see no end to. I mean, as far as I can see, I see those pressures happening.
There you go. I hate to end on that note, which is very inflationary. Mary Powell, Sunrun, shifting more to storage. Really appreciate you joining us. Thank you. Have a successful conference, Mary.
Thank you so much. Always a
Appreciate that.
pleasure.
So there you go, Tyler Matheson. You just heard it. I think your electricity rates are going up, and they're going to keep going up.
All
Back
right,
to you on
Brian,
that
thank you very
good
much.
news note.
Brian Sullivan and Mary Powell, we appreciate your time today. Quick programming note, folks, don't miss a special last call tonight, live from where Brian is now, Miami Beach, and he's going to speak with the CEOs of Chevron, Royal Caribbean, and many, many more.
Sunrun
That's
has
at
the
7
Tesla
p.m.
Power
Eastern Time
Storage
tonight,
Pack.
a special edition of Last Call, live from Miami.
Still ahead, model behavior. Struggling EV maker Fisker is adding dealerships to its business structure to help boost sluggish sales. We've got the key details when Power Lunch returns.
Yeah. Can't believe how stupid I am sometimes. These things are almost at $2,000 a piece, the puts. $18,000 on that one if I'd have held it. And now I held this one and I'm down 800. There was one time when I was down almost $1,500 on a trade, and I held it, and then by the end of the day I made it back plus 200. But the emotional I went through on that trade was flashbacks right now. We got a 1, 2, 3 in the trend. I don't even know if that means anything right now. Who knows? We'll know here in a second. Tall. China. That's down. UDE is China. Education stocks. What is it? UED? I thought it was UED. UED. UDE. Fuck.
Welcome back to Power Lunch. A lot brewing on the auto front today. So let's get right to it with our Phil LeBeau and run through several topics. Phil, starting with our first story, and welcome to you. Tesla's market share slipping in the U.S. and China's BYD passing it in worldwide sales. But also, we're hearing reports about some short selling against BYD, and that's increasing lately as well.
Ooh.
Yeah, and we'll keep the BYD short selling. I mean, there's a lot of factors that are going into this. I want to focus first off on the EV sales here in the U.S. And yes, Tesla's market share has slipped. It's down to 55%. But keep in mind, two of their models, the Model 3 and the Model Y, are more than half of all EV sales here in the United States. They dominate that category, and so as you take a look at shares of Tesla, keep in mind that we will hear from the company coming up in 3 weeks. That's when they will report the fourth quarter results, and we'll hear from Elon Musk, and perhaps we'll get an update on a refresh of the Model Y.
All right, let's move on to topic number 2, and that is Ford sales out this morning. Last year, it sold more trucks than cars, more hybrids than EVs. What say you, Phil?
Look, in the fourth quarter, you can look at this and say, well, their overall sales were up only 0.8%, and their ICE vehicles, internal combustion engine models, were down 3.4%. But look at the growth in EVs. Look at the growth in hybrids, 55%. And when you look at
What they sell, Tim?
remember, the F-150 is still the straw that stirs the drink. It is the most profitable vehicle. It is the most popular vehicle in North America. And so for Ford, this is an interesting thing that's happened here in terms of EVs and hybrids. Increasingly, I hear from dealers saying when people come in, they look first at an F-150 hybrid if they're looking at an F-150, then a gas model, then the Lightning.
Interesting.
I suppose on that note, we should move along to this news that Fisker, Phil, a surprise announcement that they're going the dealership route instead of direct to consumers for their sales. What are we to make of this?
Well, they'll still do direct to consumer. They're not giving that up completely, but they also realize they've got to get their product out there as much as possible. And in an increasingly crowded EV market, a dealer who can also sell your product can do nothing but help you. If you are Fisker, they would like to have about 100
FSR
dealerships between North America and Europe. The first ones will be announced later on this quarter. How much it moves the needle remains to be seen, guys. But if you are Fisker, you've got to do whatever you can, short of advertising, in order to get people exposed to your product.
Let's talk a little bit. Let's go back to Tesla and zero in on two things. You pointed out that their market share of in the U.S. has fallen to 55%.
Yep.
Has it done that principally because there's a problem
Keep
with
going.
Tesla, or because the competitors have gotten more traction?
More traction from competitors, more offerings from other from the competitors, more EVs are in the market. It's only natural you're not going to be able to hold 67, 75% market share, which they've had over the last couple of years. Look, Tesla sales are actually growing. This is not a case where Tesla's market share is slipping. It's a case where there's more offerings out there, and as a result, you're just not going to be able to have as much of the pie.
And then question 2 is,
If you guys shut up and quit bashing Tesla, they'd be number 1.
you said has started now to outsell Tesla worldwide.
But that was just in the fourth quarter.
The
fourth quarter was the first quarter where BYD globally sold more vehicles, electric vehicles, than Tesla. But for all of 2023, let's be clear, Tesla is still number 1 worldwide by about 250,000 vehicles. So they still have a lead there. Now, what happens over the next several quarters remains to be seen.
So is
BYD has
are most
momentum.
of BYD's sales in China, or are they really globalized?
In China,
They're in
you
China,
idiot.
but they're expanding. They're in China, but they're expanding.
Yes,
All of the
correct.
Chinese automakers are expanding. Why? Because they've got capacity that needs to be used. And if your market is slowing down, because the
BYDDF has its own shipping department now. They bought a big, huge freight ship. And I think they went to Australia, and Australia's doesn't want any bugs going in on the island. Same thing with Hawaii. And when I moved to Hawaii, they had a snake on the island. They said got loose. Boy, everybody just went nuts. They inspect them ships big time.
Crypto investing begins with Grayscale.
Begins with who? So I'm looking a lot better here. I grabbed some more, and I've got a lot of contracts on the SPX. I want to see if I can get it right up here and get out of this sucker. And if it drops from here, I'm at shit creek. which they could be taking profit. That's an ugly candle right there. That was an interesting interview. Phil LeBeau actually was kind of nice about Tesla. I want to see what they mean by hangover.
Asset Management's Chief Global Strategist. Happy New Year to both of you. David, looks like you rightly predicted job openings being weaker here. So what does that say about labor market tightness, inflationary pressure, implications for stocks, even beyond these first couple rough trading days?
No, we expected to see a decline in job openings. In fact, they revised the prior month up, so it wasn't anything significant. But the key point about job openings is it's still well above the highest number of job openings we ever had before the pandemic. So we've still got plenty of job openings out there. All that's happening is the economy is gradually normalizing. And this may be the last leg on the long road back to normal, but that's really what's going on here. So I think we're looking at moderate economic growth, but we had a lot of good news in markets packed into the fourth quarter of last year, and I think there's a little bit of a hangover from that going on in the first few days of the new year.
Yeah, maybe a little bit too much.
We have 5 more minutes to Power Hour.
You sold Expedia and Airbnb, speaking of eggnog, in late December. How does that fit in, if at all, to what we're seeing these first couple of trading days?
Well, it's a couple things. One, you're looking ahead to what's going to happen this year, and I agree with David. I think we're continuing to see growth slowing, but moderate. Consumers healthy, spending will continue, and that impacts directly on the travel issue. As we know, there's been incredible pent-up demand that we have seen, whether it's in airlines and entertainment and hotels. And right now, it looks like those trends are going to continue well into 24. So the question, and I was not sure about it, but I took profits in Airbnb and Expedia because those are direct plays on that. And I think travel trends will normalize. I think probably not till later in this year, so I may have left some money on the table. But the fact is, when I bought these stocks, they had a double in a short time, and I said I'm not going to be greedy, particularly because given the overbought condition, the big run-up we had into year-end, 9 straight days in the Dow, ending up 24%. I think what we're seeing this first few days, and it'll probably continue for a bit, as the market has discounted a lot of rate cuts this year. So I think the selling, the mega cap techs and the stocks that had big profits is not unexpected. And so
why didn't they say this shit? I was saying it. Why didn't they say this stuff when we had that run up? I was saying this is ridiculous. I've never seen anything like this. I'm not holding long. I mean, in the 20 years that I'm trading, now they come out after the fact and bring these people on and talk this smack. I wish I had someone in there talking this smack during that run up. Because it was overbearing. It was ugly for me to watch. You're up 24% in 9 days. I mean, that's ridiculous. It really is. It's unusual. It's something that I've never seen. And when you see stuff like that, you just got to spit it out. But they were hopping on the train going, yeah, let's have more. No mention of the double top, all-time high. They're always lagging indicators, in my opinion. And right now I'm lagging. I'm about ready to sell it for small, a lot less loss than what I had.
let's get to our market panel. Barbara.
I don't want to listen to him no more.
Asset Management's
Sophie is up from the $8. It looks like it might have pulled back some here. There are a lot of people trapped in this stock. I've seen one guy lost almost $250,000 on it. Hey, Sue's here. Doo-dah, doo-dah. Always clean this gym. Yeah. You're talking to him. Yeah. It's P.O. Box 775, Springfield, Missouri. Excuse me? 65801. 65801. 2320 Beaver Mill Road. No. I'm having difficulty with Ford right now. With that car that they sold me. Excuse me? 65804. Springfield, Missouri. I want that stuff mailed to my post office box. Because I don't ever check my mail at home. I've got everything that goes to my post office. Yeah. No, I wanted to talk. Go ahead. sold me a car that smokes. It's lemon. And I've been back and forth with him for almost 3 weeks about this car. Well, I don't know. Yes, I've been talking to the dealership. And the one that put me in another car. This one smokes. I took it home and smoked. I've been on there since. I've had lack of sleep. And I'm trying to figure out how to work this out with them. They sold me a lemon. Yeah. But I don't know what to do. I'm really hurt straight with this car, and I want to get it straight with them. Okay, what else? Email address is washboardjim@aol.com. Yeah. If you want to have your customer service talk to me about what Ford's doing, Jim, you can. Okay, let's do that, Jim. Okay. Yeah. 25 what? 2559. Okay. Okay. Not online, Tom, yet. I just need the bills mailed to my post office box. And, okay. No, just, I gotta try to figure out what I gotta do here with the car. Because I can't make, yeah. Okay. Yeah. No. So I'll be billed. Okay. $2:07 is about the time to start moving. Break out. This has been the toughest trade I've been in a long time. Come on, do it. Break the 200 and I'll be a very happy guy. I should go ahead and sell it right here. I got more at 20. I can get out almost even, be happy, and walk away. I think I'm going to do it. It's the best thing to do. We got another inverse head and shoulders. Then we got 3 white soldiers. Well, this one looks like anchored VWAP. Dib-dib-doo.
I don't know.
I think it's an amazing
Small
story
caps
idea.
edge higher.
Comp, I think -6 online, -4.9 in the store. Can't pay the dividend with the current cash flow. Have all this capex. Don't add new stores. I mean, it's got everything wrong with it.
32%.
Is that on the real estate or is that on the consumer weakening?
It's not even a macro call. I think if you get the consumer weakening, that'd be frosting on the cake. I think the cake is they're subscale in grocery and beauty to Walmart. They're comping -5 in the physical stores, aren't adding new stores, and comp -6 online. Find me one real business that's comping -6 online. So I think it's more that. And they just, in order to deal with the stealing, they've got a problem. I think I read in one of the reports their CEO saying the way they're going to deal with the shrink or stealing is they're going to work with the Minnesota legislator. If you got a better short idea than Target CEO working with the Minnesota legislator, I'd love to hear it.
So you don't buy buy the reasons why that stock's up more than 30%.
No, they put up better margins when they reported, but the growth algorithm for all physical retailers is you either need to comp at your existing store base and or add new stores. You can't have negative on both and be a sustained business.
How would you answer that question?
It's a microcosm for me. I don't mean to pick on that one. There are others like it, but I don't want to. I'm most negative on physical retail spaces in America.
What about you?
Unfortunately for me, I still maintain the concern surrounding energy. And the reason that I have the concern surrounding energy is that there's a tremendous amount of supply. You've seen globally countries have responded to the pressure that their consumers are feeling through energy prices being higher in the early part of 2023. There's an abundance of supply, and the speculative positioning is still overweight.
Well, that's not good. You got like a lot of stocks in that space.
I'm well aware of that, and that'll be
reminding
addressed. That'll be addressed.
Reminding our viewers.
That'll be addressed at the end of the month. Okay. We may or may not move in a particular direction. Let's see what happens.
Let me stop you for a second, just to remind people too. We've been talking about energy for a long time. Okay?
Yes.
You had said this last quarter of 23, was make it or break it for these stocks.
Yes.
Turned out to be maybe break it. which is what you're talking about, because they certainly didn't make it.
Well, potentially it did, because it really didn't go anywhere. So, you know, and you're hearing Adam talk about fundamentally, energy seems to be, I think you would agree, right, in a good position.
He loves energy stocks.
It's in a good position over the next 12 months. But you have to acknowledge that price is not responding in the near term to what
We hit resistance on the XLE.
as we move forward in the future as it relates to supply, demand, and balance. Right now, the supply, demand, and balance
it's
is
a
clearly
resistance.
where we are oversupplied.
So is he going to make a mistake by rebalancing out of energy?
It all depends on investment horizon. You know, I'm saying we have you know, something like 19% of new vehicle sales are EV or hybrid. I think 8 or 9% of the installed bases, cars are born, then they die. They last 11 to 14 years depending on where you live. If you look at that installed base plus other consumption, it looks like peak oil demand 6, 7, 8 years from now. At that point, you need 107 million barrels, and we can't currently produce that with the capex that's out there. So we're going to be 4 or 5 million barrels short, and oil prices are going to go way higher. Now, I don't know if that's 2 years, 1 year, 3 years, but that's the game I'm playing with cheap stocks with low expectations. But tactically, sure,
But you know what's going to happen. You're going to rebalance out, and Murphy's Law is going to show up.
He's suggesting that I'm going to get out of energy. I didn't say I was going to get out of energy. Did you hear that, Adam? You didn't hear that.
I heard some political
I know where this is going.
But I think it's a rising thing.
I know where this is going.
If you have viewers who want to know,
he's losing his patience with energy. You're suggesting that you should be leaning in.
I'm saying if you want to, if you're asking me, do I think energy outperforms 1, 3, 5, and 10 years? Yes, and by a lot. Do I have any idea in the next 3 to 6 months? No, I don't.
All right, we're going to leave it there. Thank you very much.
Yeah.
Joe, you keep us
richer and skinnier for 2024. Those are the what I'm looking for this year.
For yourself?
Yeah, skinnier and richer.
There's a mirror right there.
Yeah.
Look at that.
Starting here.
Right behind
let's look a year from now.
Right behind the
Let's
laptop.
look a year from
We
now.
have 1, 2, 3 triple top on the
Happy New Year.
Adam Parker, thanks. Joe Chernow, you as well. Let's
on
send
the
it to Christina
all-time
Martinez
high.
now, who has more on that. The big moves
And
today in
then
the
Cindy
chip space we
Triangle.
mentioned earlier, Christina.
I thought you were going to say richer and skinnier, but no.
These
A
are
Chinese
old
driver
trend
assistance
lines from
company,
years
Mobileye,
ago.
is having its worst day since going public in October 2022, or since October 2022. It's down about, 25% right now. Mobileye expects a 50% drop in revenue for the first quarter of this year because of excessive customer inventory issues.
That
They
one
have
got
weighing
spanked.
on Intel, since Intel is a majority shareholder of Mobileye. You can see shares, though, barely in the red. But the brunt of the impact is really just hitting auto semis like STM, NXPI, on semi, all over about 3% or more. And this is the first negative pre-announcement from a chip company in 2024. It could be isolated to Mobileye or set the tone for auto-exposed names like NXPI, on semi, ahead of upcoming earnings. Shares of Microchip are about 1% lower right now and on downgrade from Piper Sandler citing weak auto and industrial markets. Separately, the Biden administration today announcing Microchip is the second recipient of the CHIPS Act funding. It's going to receive about $162 million to help expand, modernize equipment, and increase production of mature chips used in auto, industrial, and defense industries. And they're going to do that on American soil. Scott?
All right, Christina, thank you. We'll see you in just a bit. Christina Partsinevelos. We're just getting started right here at Post 9 on Closing Bell. Up next, trading the Mag 7. Apple, second downgrade this week. The broader tech space is struggling to gain traction as well. Corian's Amy Kong is back with how to play that sector right now. Owns at least a couple of mega caps, so she'll tell you next. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC.
50% off.
All right, welcome back. Shares of Apple, they're falling after the company's second downgrade this week, this time from Piper Sandler, citing iPhone sales and its valuation. The rest of the Magnificent Seven also slipping to start the year, as you know. That index down 3% year to date. Let's bring in Corian's Amy Kong to further discuss. Happy New Year. Welcome back.
Happy New Year.
Okay, so top holdings include Alphabet, Apple, Microsoft, and NVIDIA. Are you getting a little nervous?
In the short run, of course, there's likely to be room for some of these stocks to slip, and we've already started to see that into the new year. But longer term, we do think that they have good fundamentals, good growth prospects, good cash flow, which I think is very key in this kind of market, and so we are long-term holders.
Do you feel like you have a good handle on, I know you have to sort of judge all of these individually, what their valuations should be, in quotes, right? Many of them are trading well above their 10-year historical averages, whether it's, Apple at 28.5 times or somewhere around that, but you get the point of where I'm going with that. You have in your mind, like, okay, I think this needs to correct to this level, and then I think it's going to be fine?
Yeah, it's a great question. We think about price to earnings ratio in an absolute term, historically speaking. We also look at PEG ratios, which is very important, especially names like NVIDIA, where the PEs are very high, but from a PEG ratio perspective, it's a little bit more moderated. And so in general, we are comfortable buying into these names, not now, but in the past, buying into these names, knowing that the growth is likely to grow into the multiple. But again, my point being the cash flow and the balance sheet being so robust, in our opinion, these are really key attributes to have in this kind of uncertain market.
Would you urge people to sort of sit back and just relax for a little bit, watch these things settle out before adding new money? Because, the last couple of days, I'm looking at Meta, for example, which you don't own, but Meta's green, and at a couple times, I don't know, yeah, NVIDIA's green. Yesterday, it was Microsoft and Alphabet were green, so there's a little, putting toes back in the water there, but would you suggest just sort of sitting back and relaxing for a little bit?
Yeah, that's spot on, Scott. We are pausing on any new dollars going into this group of stocks. In general, the market, after this great burst of optimism from last quarter, is now sitting at a price to earnings ratio of 20 times this year's earnings. It is a little bit high from an absolute standpoint, a little bit high from a historical standpoint, and so we need to see earnings grow into this multiple, and so we're really looking for opportunities outside of the Mag 7 at this point, and so healthcare, maybe financials, could be areas of interest for us for the time being.
Do you feel like earnings are going to meet the moment and grow into the multiple? I mean, obviously that banks on the economy remaining strong enough, margins holding up, revenues and the like?
Yeah, it's another great question. I think for the moment, the market is expecting almost an 11% growth from 23 to 24 earnings. The next couple of weeks, even months, will be very key for us because management teams are prepared to talk about last year, which we think will be okay, but really the focus will be what's going to happen this year. And I do think that there will be some adjustments to the 24 numbers. So from my perspective, it's going to be very important to watch what that's going to look like. And we do think management teams will lean more conservative.
What about rate cuts? What are you sort of expecting, right? The market's expecting one thing. Maybe the market's a little bit ahead of itself with, 6 at least cuts starting in March. Does that sound too optimistic to you?
It feels a little optimistic at the moment, considering where the valuation levels are. I think the Fed is doing the right thing by trying to take back a little bit in terms of the minutes that were shown just more recently. In our opinion, I think the key is really to make sure inflation is getting back to that 2%. We haven't gotten there yet.
Merck's all-time high
and stay there. I think the Fed needs to be very careful not to declare victory on inflation too prematurely.
So then, on that note, you obviously aren't expecting that many rate cuts.
No, we're not.
How many do you think are realistic, and what do you think that means for the trajectory of the market in 24?
I can't tell you at the moment because the inflation data is still coming in, and we haven't even gotten back to 2% yet, which is their long-term target. I think the Fed is not trying to say we want to get near 2%. They want to get to 2% and stay there at a sustainable level. And for us to really think about rate cuts, we do need to see that data continue to flow through. So I think for the moment, maybe between 1 and 3 is reasonable, but 6 is obviously, from our perspective, a little bit beyond what we're comfortable with.
What kind of overall year do you think we're going to have then in stocks?
We think that it could be a positive year. Certainly, we don't think it'll be a repeat of 2023. Considering that earnings are likely to be positive from a growth standpoint, I don't know if 11% is where we're going to get to, but if it is positive, we do think the market should have a reasonable year. Another aspect to think about is the fact that it is an election year, and not to say historical performance is an indication of future, but historically speaking, when there is an incumbent candidate rather, running for president, the S&P has landed in positive territory for the year. So that's something to keep in mind as we walk through the next couple of quarters.
It will be fun to watch, and I'm sure we'll do it with you. Love to have you back soon. Thank you.
Thanks, Dad.
All right, Amy Kong, again, Corian partner. Up next, mapping out the market. Top technician Jeff DeGraff will find out where he sees the rally heading from here. Made some pretty good calls last year, that's for sure. He'll tell us the two sectors he's betting on in 2024 just after the break. Closing bells coming right back.
Yeah, this is Jim Howard. Could you send a message to the general manager of the place, whoever that is? Okay, nobody wants to talk to me. I just stuck with a car that smokes. Okay. I've never had this, about 3 other cars up there. Nobody's taking me for granted. I spent $17,000 over and got a car that smokes. Well, do I need to go up there then and walk into somebody's office?
It's been a volatile session for stocks. The major averages trying to hold on to their weekly win streaks, but there is more technical trouble brewing in the charts. Is there, or is the rally's momentum set to get back on track? Let's ask Jeff DeGraff. He is the founder and chairman of Renaissance Macro. Welcome back. Happy New Year.
Happy New Year, Scott.
What do you make of this early trading?
Well, this couple first week or so, I think you did have some tax loss selling that helped to create that vacuum that gives bulls the advantage. But I do think longer term, you hit on it a little bit. 9 straight weeks of gains through last week is pretty unusual. It's happened roughly 20 times in the last 100 years. And that usually implies stronger gains ahead. And I think it's really just a reflection of some of the breadth indications that we've talked about, 20-day highs, a percentage of issues above their 20-day moving averages. Those are indications of bull markets. So when we start the year, we just did our outlook call this morning. The first thing we look at is just saying, hey, look, are we in a bull market, bear market, or really undetermined? And it's pretty clear to us that we're in a bull market, and frankly, we have been for at least 10 months, and really kind of nailed that home with the breadth thrust that we saw in the fourth quarter.
But what if part of this was built on, a shaky foundation, so to speak, especially towards the end of the year? Seasonals, positioning, growth is slowing, the Fed's probably not cutting as much as the market thinks. All of that together, does that weaken the case that this is a new and about to rage bull market?
I don't think it does, and I certainly am sympathetic to the idea that the Fed's probably not going to be as aggressive as maybe the market's pricing in right here. But I don't think you can disconnect that concern with the reaction that we've seen from equities, and that's everything. Forget the Magnificent Seven or even the S&P 500 for that matter. I mean, we've seen really good thrust indications out of the microcap, the Russell Microcap Index, the small cap index. If you really look globally,
they really want to move this around big time.
The global markets are acting much, much better. So whatever's out there, whether it was a concern that the Fed was going to overstep their boundaries, or frankly, global central banks were going to overstep their boundaries, that's coming off the boil, and I think that's going to give us some latitude to move higher. The other thing to keep in mind, because
these are penny stocks.
Is, the triple
ATXI, I noticed on the scanner this morning.
Most, all the credit indications that we
on
look
that
at
FinViz
say that there really isn't a whiff of credit concerns or recession in these markets, and so I think the Fed has done a good job at engineering what's going to prove to be most likely a soft landing.
What if rates get back on the boil, though? So look, we went from 5 to 4 on the 10-year. And I don't know, we're still a little concerned on
that's some old trend lines there too
of inflation. If the Fed doesn't cut as much as the market thinks, which you say is likely, if inflation doesn't come down now quick enough towards target, we could be in an area where we get a little sticky for a while.
A little, but I think that's kind of reaching or grasping for.
Walt, I used to trade that one.
Look at the data underneath the surface. It's pretty clear that it's moving in the right direction.
SSKN, I know. I used to trade this one here.
I think that's. I think we're in much better shape.
This one had one hell of a run at one time. I remember that.
A year now that we've been in better shape on the inflation
AFMD
consensus, and we're still in that camp. So
I've traded this about 5 years ago.
The real question is real rates for us, and as long as real rates stay roughly below 200 basis points. That's plenty of ammunition for the equity market.
I think penny stocks are going to start really kicking ass.
And that does start to
MOTS.
The equity market forward returns historically. And
that ain't right. It's had some splits.
So I think we're okay. Can we take the 10-year yield back to 4.25? Absolutely. Will that have a consolidation impact on the
$5 million offering on the 19th?
Will it dislodge or derail the bull market? I don't think that happens.
I mean, lastly, it may put more pressure on tech, NASDAQ, and some of these mega caps. How much further do you think that needs to reset, correct? Pick your word, but come down?
Well, I think what's interesting is when we get this breadth that's starting to expand, that money has to come from somewhere, and it's coming from somewhere, right? So the concentration that we had in the Magnificent Seven, I think, ends up not being necessarily a liability for those names, but I do think they probably underperform. One interesting
Damn, here's
thing,
a good one. Invax.
Some of the work that we've done.
Someone asked me about Invax a couple weeks last week.
Of the pricing from sectors, styles, commodities, etc., is the most similar to the 1995 path when the Fed first cut rates. What's interesting is all the other paths don't look anything like that, but in the 1995 path, the minute the Fed actually cut rates the first time, tech was doing very, very well, outperforming up into that point. And then it actually ended up peaking on a relative basis for the next 6 to 12 months after the Fed actually cut rates. So that might be the curveball here. You can drive a truck through the variability on some of these studies, but I do think it's interesting that the concentration, the enthusiasm, the sentiment, if you will, that's embedded in tech may actually end up proving to be a liability when the Fed cuts rates, because it really just kind of buoys a lot of other things that have been under pressure. And one of those areas that we think is really set up bullishly for 2024 is healthcare.
So the market can withstand a bit of a period of upset for mega caps?
I don't think it's going to be that big of a problem. I think results in a consolidation. But as long as the breadth is there, I think it's fine.
All right, good stuff. We'll see you soon, Jeff. Thanks.
Thank you.
Jeff DeGraff. Up next, we're tracking the biggest movers as we head into the close. Back to Christina Partsenevelos, of course, who is standing by with that. Christina.
Yeah, of course. Well, EV battery maker QuantumScape getting a vote of confidence from one car maker. And can TikTok save Peloton? Investors seem to think so. Details next.
I got to do a lot of homework on the mid caps and the micro caps. Here's H-band. This is a bank, regional bank. It's already had its big bounce, but these people know right when to get in it. Blue. It'll eventually pop. Rig. Used to trade this one in and out all the time. Signature Bank. Sells 20%. I better look at the SPX here. See if I can recoup some of this money into close.
Dreams. All right, we're 15 minutes from the closing bell. Back to Christina Partsenevelos for the stock she's watching. Christina.
Peloton. It's a big day for fitness equipment maker Peloton. The stock is surging 14% right now after the company announced it's partnering with TikTok to bring short-form fitness videos and other content to social media. And new battery test results is charging up QuantumScape stock. The electric vehicle battery maker is up nearly 50% today. Well, let's say 45% right now. A Volkswagen subsidiary announced that it had completed a test of QuantumScape's solid-state lithium battery for electric vehicles, and the results were encouraging. Vote of confidence, and that's causing the stock to soar. Scott.
All right, Christina, thank you. Up next, Netflix shares are higher. We'll find out what's behind that move, why one firm thinks there could be further upside for that name in the year ahead. Closing bells right back.
Because Disney ain't no good. I heard almost all their movies were a flop this year. That's what I heard anyway. Let it be. Can't believe I didn't trade this trend right today. I figured but we started off real strong and it psyched me up. And I had the puts, man. I just can't believe this. I had them twice. I sold them earlier here. And then I had them there, and this thing, I would have made someone's salary in a day. Very, very upset. It could have been a lot worse, though, that's for sure. Any kind of loss for me is a sad loss. And I don't make them very often. And I even had 10 hours sleep yesterday. Hey, June.
NBC.
Quick programming note, do not miss a special last call tonight. That's live from Miami Beach. We're going to hear from the CEOs of Chevron, Royal Caribbean, and many more. Starts at 7 o'clock Eastern time. Up next, Walgreens in the red today. We'll tell you what's weighing on that name, how it could impact the drugstore chain in the year ahead, that and much more when we take you inside the market zone.
You had the puts too? No, it's not too bad, but it was about $800. Look at that knife. Look at that. Oh, God. I don't even want to look at them puts now. I mean, that's really going to tear me up. 20, oh shit. $28.55. So that'd have been 10 times $2,600 on the second batch. And the first ones, that'd have been another, well, I'll just lump them all in that one. $28,000. This ain't good. I don't think this is good. We have the 3-day rule, and we just really lost it right here. We're getting to that 21 real fast, I bet. We're to that 9, to that top. And the 21's right there.
Closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus Walgreens slashing its dividend. Bertha Coombs has the details for us there. And Julia Borston,
I'm gonna short this sucker for the rest of the week.
is bullish on Netflix this year. Mike, you first though. Whatever's going on in the market, it's still unsettled. It's trying to figure out what it wants to do as we begin this year.
We're hesitating. I mean, the last time we had a multi-week rip through November, and then we knew we were overbought. We knew we had to kind of take a pause. It was the most pristine and painless sideways move we had. It was not really a pullback. That was early December, thereabouts. It's maybe a little too much to ask. You get 2 of those in a row where basically you barely notice it on the chart in retrospect. So, you know, we're like not even 2% off the highs. The way I'm thinking about it is we have undone the post-Fed meeting leg of the rally. 47.07 is where we closed December 13th. We broke just a little bit below that right here.
No, we have not.
Take some of the sentiment and positioning stuff off the boil. You look at the weekly National Active Investment Managers tally.
Off the 21, yeah.
You're starting to see put call ratios go up. So people are bracing for something. It's unclear if it's a specific thing or it's just a, hey, we spread the news, the soft landing is probably here, and nobody else needs to be convinced of it yet.
You heard Jeff DeGraff, I think, not too concerned from a technical standpoint, certainly.
Yeah, if you lean on
the
trend
spot.
and the market
Netflix.
behavior itself, in terms of what it's told you and what that tends to indicate for the future, you're pretty comfortable that
we're not even close.
This dip will be likely bought. And I don't think I'm with him about. I'm not really concerned about micro studying the Fed expectations and the Fed funds futures and if it's going to be March or not. All I know is the investment grade corporate yield has gone from 6.4% to 5.2 in less than 3 months. That helps no matter what else happens with the Fed.
Yeah. So Bertha, I'm looking at Walgreens here, which is down to more than 5%, all on the dividend cut.
Yeah, it's come well off of the low, Scott. You know, its results for the quarter actually came in well ahead of expectations, driven by strength in pharmacy prescriptions and Boots UK.
It's just not good news.
But CEO Tim Wentworth, just 2.5 months on the job, says he's focused on getting the company's finances on a stronger footing, stressing, quote, that everything is on the table, starting with slashing that dividend from 48 cents to 25 cents a share, about 48%. First cut in more than 45 years for the company, which takes the yield down from 7% to around 4%. Wentworth told me the sale of Boots UK, which was long rumored, He's also on the table as he focuses on
Nailed my
bringing down the
support.
company's debt in the wake of acquisitions to build up primary care and specialty health
this ain't-
services, which he's still very
This
much
is not a healthy stock at all.
Bertha Coombs, thank you very much for that. To Julia Borston on Netflix.
This is not a healthy stock.
Call from
Period. Look at the crash it's had in 2.5 years. I mean, I can understand why now he wants to cut that dividend. That's horrible. That's more than horrible. And we had a triple top. So it was maybe a good thing to buy the dip when it's ready. Less than a minute.
Market, and it's kind of like the stuff we liked before is still working. We're just kind of pulling it forward into the coming year. You know, free cash flow, it wasn't long ago that they just went positive. It's like a 3% free cash flow yield if you buy into their definition of it. Similar to Amazon, Meta is like 4.5, 5. So that gives you a frame for how profitable the business is now showing itself to be. See if they can, you know, continue to expand that.
You mentioned a little while ago, the last time we went through something like this and had this really just easy sideways move was, you know, mid-December. We really didn't have a lot going on. Like, okay, we had some data come out. We had a Fed speaker sort of set us in the right direction. That kind of turned things. Now we got a lot of data. Tomorrow morning's jobs report and earnings. Earnings are coming up real quick.
Yeah, earnings are definitely going to be the thing. I think that you always hesitate during earnings season, but I think once you get the mass of reports in, it's going to tell us if we were right to
Okay. What's that? Okay, I'm going to talk about history when I have a bad day on how to overcome it. So I got to figure out what I did wrong. And I already know what I did wrong. I psychologically reversed my strategy, counting 3 days down. And we've hardly ever moved at all, but we did break my major support level at 4712. Pretty big. So there's no other choice but my first incentive when I first did the video, once we hit this double top, was to take it all the way down to right here. And I guarantee that's where we're going to end up. And if I'd have been smart, I could have probably made at least 30,000 today by holding that put. And I was in the put earlier, and if I even would have held that one, and that was a lot cheaper, could have probably had a $50,000 day. Just today. And it happened twice last week where I had trades and I sold them too soon. And I had one go up about 1,700, and then I had another one go up about 24 from a $200-300 level. And I just get in and get out, and I make $500 or $600, and I'm happy. They were on the megaphone patterns. There was 2 of them where we had megaphone patterns that I traded. Now this here sell-off here kind of has me a little bit like we broke a real strong support. But then I got to think about the earnings that are going to come out. It could just turn this market completely around because of the forecasts were downgraded, and some of them weren't even given guidance. So we're just down like we've had a humongous run, like they said. I mean, they're saying it now. They weren't saying it at the end of the year, where we had week after week of just. And then this last one, when they said 20-some%, I'm going, what? So Wall Street's going to try to convince you just to hold it and wait. But I see it's definitely coming down and hitting this here wick at 4,600.7. And that's only $80. That's only an $80 drop. And we've already had $7.95 to almost $115, $110 drop already in two trading weeks. So it's really not that much if we just go ahead and hit that top and then run it back up for a triple top break while earnings are in play. That's my guess. If you put the Fibby on here, so I'll come in here with clear eyes and a strong heart and can't lose tomorrow. So that Fibbies won't line up with that at all. That support level. And we had a double top right here. So that's a triple top break. So yeah, I'm going to stick with that number, 4607.30. But I got to wipe this all off, watch some good stuff on TV, and get a smiley face on in the morning. It's not good to take this when you have a red day to bed with you. Because when you come in the next day, you're going to be thinking about yesterday. And so I guess kind of write it off and not think about it. And I think that's the only way that you can psychologically get over something like this. That's about it. There's nobody out there that can do 100% every day. That's why I like to get in and out of these trades fast and collect my money and walk away, because if I don't, I'm going to end up with holes in my pocket. I know a lot of people that's lost a lot of money because they were hyped up about swinging into 2024 like it was going to be easy. And I said, no, it ain't going to be that easy. Not once you hit that double top all-time high. You've got to consolidate such a run. I mean, this is this is a huge run. 700 points, think about it. 700 points. 600 and some points. So almost 700 points in a matter of 9 weeks. Not even that. Each one of these represent a day. It took 4 months to get it down there. It took half that to get it back up. So I'm going to write a book about this. Wish everybody a great day, and we'll see you tomorrow. I'll do AMD. I've got this here previous high for support. there's a spinning top, and we consolidated within that spinning top. So if we hold this trend line, and I think I did that on the yearly, not even on the yearly, might have been a 20-day. Yep, 20-day. So I think your support should hold right around 130.59. That's going to be our second support. That's head and shoulders. That's a triple top break on the weekly time frame. You got 1, 2, 3. So that's the first pattern I see is a triple top. If we respect the 9 on the weekly time frame, the 9 EMA will start to consolidate. Now, like they're saying now that tech is in a huge bubble, and I believe it. Last time we saw tech in a big bubble was during the middle of COVID, and we had a big crash. It dove all the way down. Had one heck of a run. Cup and handle. So it's going to come back to that cup. 130.59 doesn't hold, then we're going to have more drama, and we'll drop down and hit the 21, which is right around 115. Another $15 dip. That's how important that 130.59 is. Earnings are going to come out soon. Let me see when AMD's earnings are coming out. I'll show you all my money I lost today. What is AMD's earnings? Why is it so hard to find it? Does anybody know when earnings are coming out on this thing? Fourth quarter. Yeah, I just can't hardly think. Usually it pops up here and tells me when the earnings are. January the 30th. Looks to me like they're going to be up. So that's good news. Consensus 77. Last year's was 69. Strong buy. So that's kind of puts me in the happy land. So let's see if we hold to 130.59. That's the major support level. And if that doesn't hold, we'll take it all the way down here to the 21. And that's your second support level right in there. Right around the 120 area. $116.79 to $121.77. But I'm bullish on this. Just everything's going to pull back, and they're telling us to get into small cap and mid cap stocks, which are down huge. Everybody's piled into these magnificent seven. That's the big issue. Is this market run's only been in a few stocks. You thought it would go to 140 first? Well, we were there. We were there. We'll see if we hold this support. Who knows? We got higher highs here out of the snake. We've got an expansion pattern. Just not looking at the 1 hour time frame. So we can still do it. I wouldn't count your chickens out yet. We got the 9 crossing the 21 on the 1 hour, and that's big. So yeah, we'll just have to see tomorrow if we have another red day. This was kind of a flush out at the end of the day. So that's it. Everybody have a great day. I'm going to have a better day tomorrow, that's for sure. I might do a recap of today.